India stops buying from Russia. Let's go across to Sapna Das, who is joining us with more details on this. Sapna?
Morning, that's right. What we are going to understand is that, oil prices could harden significantly if, India halts its imports from Russia. It's also, the fact remains that India buying Russian oil is also critical to maintaining price stability. As we are aware that China and India are the top buyers of Russian crude. So basically close to 2 million barrels per day of these 4.5 million barrels per day that Russia exports. 2 billion barrels per day comes to India. So that's like over 44% of what Russia exports. So, we can understand how critical it is, the kind of imports that India has from Russia. 2 million barrels per day of oil supply is not a small amount. So basically, also the fact that Russia produces 9.5 million barrels per day, or nearly 10% of the global oil demand. So, the fear here is that if the Russian oil goes off the market, this could, have a major impact on crude oil prices. So, giving the example of Brent spiking to $130 in March 22, when the Russian sanctions had come in post the Ukraine war. So that is one example. So had India not purchased Russian crude in vast quantities and had not stepped up its buying of Russian oil, there was oil prices could have gone actually even beyond 137. So the same argument is being given at the moment. The same claim is being made that if we don't continue buying the way we have been buying from Russia, this could really harden crude oil prices. This is something that we are to see how it pans out.
Sure. Thanks for that, Sapna. But do stay on with us because the government is looking to invite financial bids for IDBI Bank, strategic divestment between October to December this year. And they are hopeful of selecting winning bids by March FY26, says Deepam Seki Arunish Chawla. And Sapna, tell us more on this development as well.
Absolutely. So, it's been like almost 3 years since the IDBI preliminary information memorandum has come out and the initial bids have been called. So, given to understand that India will be calling the financial bids for the bank disinvestment by the third quarter, which essentially means by December. It could also be possible that the bids are actually called for by around October, earlier than December. This could also be a possibility so that by December, Jan, there is some clarity in terms of the financial bids coming in. And as government is clearly indicating, Secretary is on record saying that by March FY26, the actual successful bidder for IDBI bank transaction is likely to be in place. So this is exactly what is expected. They've also indicated that all the due diligence that was ongoing for IDBI bank that has been completed. That means basically all your SPAs, everything has been signed. All of that is under the belt. That's one aspect. Second, also in terms of your other OSSs like LIC and your public financial institutions, government has said very clearly that they'll be doing some kind of stake dilution. So in terms of that, the merchant bankers and legal advisors are in place. However, what Secretary indicated very clearly is that they're going to be there for the next 3 odd years, which means the government is not giving it as to when the transaction will happen.
Sure.
Particularly LIC, a lot of people have been asking. So starting from now,
sure,
for the next 3 years, anytime.
All right. Thank you so much for that, Sapna. But we now have Manisha Gupta joining us with all of the updates from the world of commodities. Manisha, what are you watching out for today?
Well, Mama, thank you for that. I'll start with the crude oil prices because we've seen a third straight day of decline come in for this one, even as the U.S. is pushing for or threatening 100% secondary sanction on Russian crude buyers. OPEC clearly sees an opportunity within this because OPEC Plus is increasing its market share in the global market. They're looking to increase production by 547,000 barrels per day in the month of September. This is after increasing 548,000 barrels per day in the month of August as well. So clearly, OPEC looking at increasing production, increasing supplies as well. And the prices in crude also seem to be holding around that 69.70 mark. What we also have seen is some gain come back in gold and silver prices after the U.S. job report shows a not very effective or a strong number. There is a 75 probability of now a September rate hike, and that is what the markets seem to be weaving in. The only one thing that I don't see doing quite well in the commodities is the copper prices. We've seen 24% of decline in the previous week, and we've started nearly a percentage point lower today as well. Base metal prices continue to be under pressure. Other commodities seem to be doing well.
Well, thank you so much for that comprehensive roundup, Manisha. But moving on, the Enforcement Directorate has arrested Viresh Joshi, former Chief Trader and Fund Manager of Axis Mutual Fund, in connection with a 200 rupees crore front-running scam. He was taken into custody on Saturday and has been remanded to ED custody till August 8th by a special court under the Prevention of Money Laundering Act. But with that, it's a wrap on this edition of Power Breakfast. We're leaving you with the GIFT Nifty indicating a positive start for our own Indian markets. Don't go anywhere. Pasar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. A fresh new week, Monday morning. We are coming to you from the CNBC-TV18 Moti Oswal studios. Markets have been drifting lower. The big question is, are we in the late stages of a correction, or is this the beginning of a sharper fall? And we'll sort of try and put a lot of perspective over the next 2.5 hours around this particular question. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, morning.
Hi, morning folks. Yeah, I mean, Monday blues or Monday reds, we'll have to figure out, because those global cues have not been very supportive. And our market has been, at the downside of the range. In fact, it broke the range when we ended on Friday. So let's see.
Well, that's right. 9 to 9:30, you're going to be focused on the screen with regard to what's going on in the markets. And at 3:30 odd, 9 to 3:30, you're going to be focused on markets.
Action.
3:30, hopefully our boys can pull out something out of nowhere. We need to pull 3 wickets down. I'm backing my boys. 3:30 to 4:30 is going to be a very, very interesting phase when India takes on England.
Only two passions, Nigel. Broadly, cricket and stock markets. I mean, I think that is true. It's really, I think, out there, right? And we will track that starting 3:30. But, well, we've got to get to 3:30, right? So let's just sort of begin with telling you what you need to know as we start another session. So the big story, of course, turned out to be Friday's jobs data, which is the unemployment numbers and the job addition, actually, which came through. And what it has done is the weak jobs report has sort of, in a way, opened the door, it's lit a sort of clearer path to rate cuts by the Fed. So far, it was looking very iffy. Economy, etc., was looking very strong. The jobs market was looking good. But Friday's number, I think, changes all of that. And it was pretty... the moves which came on the back of this were pretty large. So the number, 73,000 jobs added versus consensus of 114,000. So this was basically half of what the consensus said out there. By the way, you know what the lowest number in terms of estimate was for jobs addition in the month of July? 0. So it was not as if everybody was around this 114,000 number. There were those who were expecting no job additions as well, 0 job additions. But in any case, the actual compared to consensus is what matters. 2-month revision, the prior 2-month revision basically knocked out about 258,000 jobs as well. So the numbers were revised lower. And to boot, you also had the ISM manufacturing numbers which came through, especially the employment component, which looks weak. The number itself sort of was weak. It's at a 9-month low. And it's a pretty closely watched sort of data point. Now, U.S. equities saw the worst day since May. The S&P was down about 1.6%. NASDAQ was down a little bit more. But remember, you had Amazon, which lost about 8-9%. And that, I think, at the margin sort of pressured the market as well. Outsized impact on the NASDAQ, of course. The 2-year, and this, of course, is in response to market pricing of rate cuts. The 2-year fell 27 basis points. That is, it's a very, very large move. The 10-year lost about 10 basis points to about 4.2%. And if you look at the difference between 2 over 10, that steepened substantially, indicating much more in terms of rate cuts. Markets now pricing in 90% chance of a rate cut in September, and it is now fully pricing in 2 cuts this year. So rate cuts, etc., are back in the table. I'm not going to go into detail. There were specific Fed governors, etc., who said that, it's almost that it's wrong to wait and that the labor market is changing, it's weakening, etc. But market itself is pricing this now. Now, the other bit, of course, was the shock move of President Trump firing the head of U.S. Labor Statistics Agency. And he basically said that the labor market data was politically motivated, it was colored, it was wrong. And really, it sent shock waves and brings into sharp focus once again what President Trump may not do with regards to the Fed chair himself. He tweeted actually later saying that, well, like the labor market, the labor data head, maybe Fed chair Powell perhaps should also step away. Oil prices, they were down about 4%, just under $70. Over the weekend, OPEC Plus has agreed to boost oil production by 547,000 barrels per day. It follows a similar increase in August, and it basically just unwinds the cuts that we've seen since 2023. So oil prices not very much moved, still around $69.5. There is the RBI policy meeting on Wednesday, day after tomorrow. And they are seen holding rates because there was a 50 basis point cut, which was seen as front-loading a lot of what the RBI wanted to do. We'll see. Commentary, etc., will be important in any case. And I think because of these 25% tariffs and the hit to GDP, which is about 0.2 to 0.5%, depending on who you ask, expectations have risen that maybe, the central bank and both on the fisc and monetary side perhaps need to do more. As I began by saying, the question here is, are we at the beginning of something sharp, or are we in the last stages of a decline here in India? And that question, I think, comes from the fact that the market here has been doing nothing for the last 1 year, whereas US markets especially have been doing very, very well. So if US starts, and it looks like it's starting a bit of a dip, a bit of a decline, will we fully participate to the same degree as what the US does? Or have we already sort of paid the price over the last many months of underperformance and some decline recently as well? The other bit is seasonality. That is, both August and September are not great months. You look at data for the last 10, 15 years, both these months generally on an average, for what it's worth, turn out to be slightly lower months, more often than not. Just the levels, Nifty broke the low of 24,598 on Friday. The next zone of support for the index stands at 24,300 levels. Nifty Bank almost back to previous lows of 55,547. And here the next supports are the June 13th low, which is 55,149, and then 54,956. GIF Nifty will give you a quick sense of how we're likely to start, and then we will pick it up from there. 68, 70 odd points higher this morning. Surabhi.
I was just thinking, Prashant, listening to you, and it reminded me that Trump is quoting a lot of controversy with the ladies, right, over the weekend. Because it was the head of the Statistics Bureau, Erica, who was fired, and that created a furor. But then in the last, I think, 12 hours, it's been about the White House press secretary, right? Miss Levitt, and the kind of comments that he's made, and they've not gone down well with a large section of the crowd out there. So anyway, controversy is never far away from the US president. Let's talk about markets now. So across Asia, there's a mixed reaction coming in. Some of the markets like Japan, for instance, are still falling quite a bit. And Japanese markets were down even last week as the trade realities, the fact that these are higher tariffs, they're here, and they start getting collected from the 7th of August. That starts to hit home. But then you have some of the other markets like Hong Kong, for instance, which are not doing too bad, flashing a little bit of green. So it's a little mixed, bit all over the place. Let's see if we start on the upside, considering that we've already lost so much over the last month. Remember, the Nifty is at a 1.5-month low after the decline, and the implied open is telling us it will probably take the positive side, and then let's see what happens from there. Talking about, of course, those cues. So it was the US market saw a collapse on both sides, financials and technology. Financial stocks, large banks were down between 2 to 4%, and tech shares fell across the board. Amazon, of course, was the biggest headline, down 8% on that. Earnings. Actually, the quarter that they reported was okay, but their guidance for the future quarter, the spends on AI, that is what the market got a little nervous about. On the jobs data front, I just want to place the numbers, the final tally post the revisions, because it's quite dire if you look at the numbers themselves. 73,000 is what we got for July, but after the revisions, look at what happened in May, just 19,000 jobs. June, just 14,000 jobs. So that's what really has caused markets to get a little nervous along with all the trade issues. Let's come to the flows here. Like I said, FPI selling has been consistent. The market is not even at the lower end. It actually broke the trading range last week with the Nifty having a close below the 24,600 mark. So the flows now, again, selling continuing. FI has sold off cash market stocks worth nearly 3,400 crores. Domestic institutions are buyer to the extent of almost 3,200 crores. That left that net sell of almost 200 crores, and that really showed up in prices in the way we closed on Friday. Now some, internal cues, local cues as well. We've got the GST numbers in. It's looking better than the previous month. The gross numbers show the GST collections for July are up 7.5%. But net of the refunds, if you look at the net number, then that's not that encouraging. Net of refunds, GST collections have grown only 1.7% in July. So keep that in mind. A lot of the India-US trade negotiations, overtures, they'll continue to dominate the headlines. And here's the latest. Sources are telling us that Indian oil companies will be increasing their US imports substantially over the next couple of months. In fact, the talk is that, the increase is going to be as much as 150%. Right now, US's share in our crude import basket is 3%. It's already gone up to 8% in July and is expected to inch up further. So will these overtures help, bring down that 25% tariff number? We'll see. Earnings. Now, that's, of course, the most critical aspect for the market to focus on. Here's what Motilal Oswal is saying, that the companies that have reported so far, 38 Nifty companies, the growth is 7.5%. They've already cut their FY26 EPS by about 1.1%. And there are lots of earnings reactions on the radar today. ITC is a mixed bag. The cigarette volume growth is great, but the margin has been hit big time for ITC. So watch out for this one. A couple of, giants, MNC giants on the capital goods fronts like ABB and Honeywell. Numbers are not that inspiring. There's a big margin compression for both ABB India 600 basis points and 400 basis points that Honeywell has reported. So watch for this. Federal Bank is a mixed bag. MCX is not looking too bad. Sequentially, there's a lot of improvement with MCX on a number of parameters, and we'll talk about that as we get to our top 10 segments. But plenty to keep us busy, including those earnings today. Nigel.
Well, the Nifty structure actually has got punctured because on a day-to-day basis, you're seeing that we end closer to the low point of the day, and the intraday charts as well are a little bit worrying. So the structure is punctured, but it could possibly be that bounce, long-awaited bounce, is very, very close, or it's in the offing as well. Why do I say that? Well, the FI short positions in percentage terms, they are at the highest that we have seen since March 2023. And the RSI has now come down to around 36. Remember, a few trading sessions ago, it was above that 50-odd mark. We normally get into an oversold zone when the RSI comes down to around 30. So keep that in mind. Let's focus on the first point, though, with regard to the short positioning. Percentage terms, we're at around 91.4%, which is the highest we have seen since March 2023. And from there, we did see a bit of a bounce. So the hope is this time around as well, it plays out that. In absolute terms as well, in Friday's trading session, the FI net short positions, well, it went up by close to around 20,000 contracts. That's just in Friday's trading session, while the client long positioning as well went up by close to around 10,000 contracts. The FI net short positions, remember, they see peak levels of closer to around 2 lakh contracts. So we are some distance away in absolute contracts, but in percentage terms, we're already at around 91.5% or thereabouts. Moving to the PCR, that's the other indicator that had moved to an oversold zone, and on that day we saw a bounce from the lows. It's at around 0.75. Normally it moves to around 0.65 and then sees a bounce. So today, intraday, since we're seeing a lot of call writing, if you see that mark, the combination of the shorts, the RSI, as well as the PCR moving down to sub that 0.7 odd, it could give you an opportunity for a tactical rebound just in an intraday. So keep that in mind. Call writers continue to rake in the money. They are writing aggressively, eating into the premium. 24,800 call, 24,700 call. Massive open interest built up. And now the 24,200 put, that's opening up. So there was a mix of activity, but there was some buying as well. We're seeing, looking at taking a bit of a position and buying 40 rupee premium, pocketing that, and looking at the Nifty declining. That's what the put buyers would be thinking. Levels that we're looking at, near-term resistance, 24,850. That was a bit of a support that's got broken. So near term, that's going to be the level. And on the downside, the 100 DMA now comes into being. Before the 200 DMA is closer to around 24,000 odds. So in the near term, the 24,400 mark, you don't want to see that getting punctured. Well, the Nifty Bank, well, that's broken down after leading, the up move. It's trading below the 20 as well as the 50 DMA. So these are the resistance zones for the Nifty Bank. You'll want to see it get past that. But the IT index, that's the one that I'm going to be looking at. And is it forming a bit of a bottoming showing? Why do I say that? Because if you look at the IT index and you compare it with the NASDAQ, on a valuation parameter, it trades at a discount. Now, the valuations have got to a discount of around 20%. Normally we see it bottom out at around 30%. So that's one data point if you compare the discount with history with the NASDAQ. And the other point you're looking at is the IT index with the Nifty. And out there, the valuation premium has come down to around 15%. Normally, it bottoms out at around 14%. That's what an HDFC securities note did say. So both these two data points drop that question, is tech bottoming out? Finally, the stock that I'm going to be looking at is PNB Housing Finance. You had that big resignation that came in on Friday. The stock got knocked down. Some part of the street believes the reaction was excessive on the downside. They put in a temporary management as well in there. It moves into the F&O ban. That's a stock we'll be looking at as well.
Oh, absolutely. We'll slam dunk on PNB Housing. So we'll see how it copes up from there. Well, let's get started with the equity call of the morning then. We have Chetan Sheth of Nomura saying that no taco on tariffs and weak US non-farm payrolls data amid stretched positioning and valuations imply near-term risk of unwinding and profit-taking in stocks. He says with tariff rates all set, all focus will now be on how these affect the global economy and earnings picture in the second half of 2025.
Okay, well, Sanjeev Prasad of Kotak Institutional Equities says that the first quarter of FY26 earnings season shows continued weakness in consumption, muted IT services demand and weak loan growth for banks. He says aggregate earnings were broadly in line with their estimates and consensus expectations. However, a muted outlook across sectors resulted in further cuts in consensus earnings expectations. Well, Matt Auden is with us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here on the program. Thank you for your time. So that question, which is whether we are here in India, whether we're in the late stages of a decline or at the beginning of a sharp fall, because it looks like in the US, for no other, data has been weak, jobs data, ISM, etc. lately. But earnings season has been absolutely solid. I was looking at the latest number, 65% of what is reported on the S&P has beaten expectations. And the Magnificent Seven, the large US tech companies, I mean, the beat there, earnings there have grown 22% year on year. So those seven have outperformed the rest of the 493 by a huge degree at that scale and size. What's your sense, Matt?
Hey, good morning, Prashant. I'll start with the second part of your question first about the U.S. and earnings season. And there's this bifurcation, like, once again, between economic data and what's happening in the stock market. And I think what we lose track of is that the market itself doesn't necessarily reflect what's happening in the real economy. But the other point I tried to remind investors is that while the data has deteriorated, number one, it is not pointing to a recession. So I think we need to take that off the table, that while the data is weakening, it's not pointing to a recession, it's pointing to a slowdown. But again, the data has also been very volatile, and we haven't seen a significant tick up in unemployment. And when you look at earnings, not only have earnings in the US been incredibly strong, especially for companies up and down the value chain connected to the artificial intelligence trade, you've also seen aerospace and defense trade incredibly well. You've seen certain parts of the consumer continue to trade well. The credit card processor saying the consumer remains in good shape and they maintain their guidance. So that gives me the ability, at least for now, to look through some of the weakness and believe that I think things are going to be all right. But you have to pay very, very close attention to whether any of this volatility and the negative numbers turns more into a trend. You come over to India. Earnings season has not been as bright as earnings season in the US. You haven't seen significant earnings increases, but I think India is closer to the bottom of this earnings trough it's been working through. And India is also not as connected to US tariffs. In fact, if you remember back to April, India was actually kind of a ballast in many ways to the challenges that the US and other more trade-heavy countries had in connection to how the US market was trading. So I think we've forgotten about that. And I think, given the incredibly strong GDP growth that India has been experiencing and will continue to experience going forward, I think that should give investors confidence that we're probably towards the tail end of a sell-off. And if you do see any sort of deeper correction, it's likely going to be very temporary and a very good buying opportunity for long-term investors.
All right, Matt, you've always been keeping the faith, always taking a positive view on India most of the times. And that's interesting perspective to look at, that maybe we're at the fag end of this whole disappointing season. So tell us, anything that stood out for you in the season, your usual favorites like stocks like ICICI Bank, I think Interglobe, we've spoken about them. Anything new coming to mind when you're looking at companies and stocks here in India?
So India has always been interesting to me also for the payment infrastructure that exists. So names that I really dove into when I was over in India back in June included Jio Financial, which is a name that's really been finding ways to integrate artificial intelligence into the way it extends loans and also enters into partnerships with different clients. That's a name that's reported very encouraging numbers and I think has some tailwinds as the flywheel effect between all of its businesses starts to go in place. And this is one that has held up in spite of the Indian market coming down. And another name that has done quite well is Paytm. That's a name where a lot of analysts have been very negative about its ability because it's an expensive stock, but it's been expensive for a reason because of its integration into the payment system and the ability of management to clean up expenses and also start to increase margins. And as I'm looking at opportunities in India, one of the key things, and I'll include the US and really anywhere in the world in this, is how are margins holding up? It's not just how much is the top line growing, how much is the bottom line growing, but are companies able to defend their margins? And in these cases, these companies are, as are some of my perennial favorites that we've talked about before.
Okay, all right, Matt, quick question. If you're putting in fresh money today, market-wise, India normally, I think it has close to 10% weight in your portfolio. Would there be incremental allocation to Indian markets post the recent underperformance?
Yeah, Nigel, that's a great question. And I would say right now, given all of the uncertainty, I haven't been actively adding too much risk into my portfolio. Like I said, I think we're towards the tail end of a correction. The technicals don't look wonderful. So I'm not at the point where I want to put more fresh capital to work. And that's anywhere across my portfolio. But if we do start to see a washout, some of the names that I'm going to be adding to, I've been actively looking at aerospace and defense names. This has been a global theme. I've had a lot of success in European aerospace and defense and some smaller cap US companies tied to helicopters, aerospace. You look at a Hindustan Aeronautics, also tied more to the helicopter segment of the market where the Indian government actively needs to build more helicopters. They don't have enough to get to the minimum numbers they've established. I think that's the name that looks very, very interesting. It's also had a bit of a sell-off lately, and so I think that's one where I'd be looking to add money should we see a little bit more pain in the market.
Oh, interesting. So HAL, Hindustan Aeronautics, is a new name that's cropped up on your radar. We'll remember that one, Matt. Always a great conversation. Thank you so much for joining in, and you have a great week. And we'll, of course, connect again soon. With that, let's quickly move on and talk about what else is lined up on the show. Plenty of conversations coming up ahead. At 8:35, we'll be speaking with the management of Transformers and Rectifiers. They've reported a good start to the year, solid Q1 numbers. So we'll get a conversation going. At 9 a.m., we're speaking with the management of Narayana Health, get a lowdown on their Q1 performance. At 9:20, Shreyas Devalkar of Axis Mutual Funds joins in. He's our market master of the day. At 9:30, it's more earnings calls. The management of Tata Power joining in to talk about their performance. After that, we have Gaurav Pandey of Godrej Properties chatting to us at around 9:40. And at 9:50, we'll be speaking with the management of Federal Bank, talk about the slight increase in asset quality issues that have showed up in the first quarter. By the end of the show, in our special segment, Lata will be in conversation with CNBC-TV18 Citizens Monetary Policy Committee to discuss the expectations from the RBI this week.
Time to slip in a quick break. A lot of stock-specific action to track. We'll get to that on the other side in our special Top 10 segment. Hero MotoCorp, ITC, Tata Power, JK Lakshmi Cement, Delivery will all be reacting to positive news flow. On the flip side, ABB India, MCX, Honeywell Auto, Federal Bank, LIC Housing Finance will be reacting to negative news flow. Take that break, get into further detail on all of these names.
Welcome back. So, very interesting play across Asia. Some of the markets, particularly the Chinese markets, mainland China and Hong Kong, are actually up. The Japanese market is down. Some markets still making up their mind if what the worst of the trade dislocations, if that's all priced in, you move on, or whether the equity market has just begun to take note of it. So let's see. Implied Open is telling us that we'll start positive at least because we've had such a long string of down days. and a really tough last week. So that's a nice gap up that the implied open is at least indicating. Let's see if we can hold on to that. Well, lots of stocks and earnings as well to track, and our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, good morning to all of you. Well, I guess what, not earnings. We'll start with the monthly sales numbers. Sudh's telling us about Hero Moto. Looking better than Bajaj, would you say, Sudarshan?
It's much better than Bajaj Auto, and three factors that might have worked for Hero MotoCorp. First, rural sentiment has been improving, and like all the other company, export segment continues to do well. And third, the scooter segment has firmly outperformed the motorcycle segment. And on the back of these positive factors, total sales of the company have increased by 21%, and domestic sales too have seen a jump of almost 19%, with export sales rising by almost 64%. Come to the segment-wise, motorcycle sales have seen a growth of 19%, but the sales are below estimate. But if you look at the scooter segment here, the sales have jumped by 64% versus estimate of growth of 20 to 25%. What about the commentary and going forward? Commentary is positive as well. Company is saying that retail activity has remained stable, and with upcoming festive season, volumes are expected to move higher as well. So going with green for Hero MotoCorp.
Okay, all right. Thanks a lot for that, Sid. Well, let's hop across to Mangalam. He's here to tell us about ITC. Hey, Mangalam, morning.
Good morning. So ITC reported a mixed set of numbers. If you look at the revenue, it was a very, very strong growth that came in, but the EBITDA not so much. So, if you look at the numbers, so close to 19,750 crores what the company posted on the top line. What is it that the street was working with? 17,650. So that's a big beat coming in out there. But then as you go lower, the EBITDA at 6260 crores is lower than street expectations of 6,300 crores, and as a result of which margins at 31.7%, much lower than street expectations of 35.8%, and the net profit too followed lower than expectations. So going with mixed, but there are a lot of green shoots in these numbers. Cigarette volume growth, coming in at above 6% as against street expectations of 3 to 4%. So that's a multi-quarter high, led by 6 to 7% revenue growth in the cigarette business. Agri revenue, that grew 39% versus street expectations of 20-25% because of higher realizations in tobacco, and also, because of the favorable policies when it comes to exports. FMCG margins, while they're down year on year, they've improved quarter on quarter. And if you take the notebooks business out, the revenues have grown 8%. So that's a mild positive as well. What's not good is leaf tobacco inflation has impacted cigarette business margins by 220 basis points, and competition intensity will keep those margins in check. 180 basis points decline in FMCG margins year on year, so it's still not out of the woods. And paper business, 38% decline in EBIT out there. So that's something which is weak. Still going with a green on the stock for two reasons. One, the management says that they've seen a recovery in urban improvement sentiment. And secondly, the current crop cycle has seen lower prices versus last year. So going on from here, margins may improve. The stock close to 52-week low, trading at 22 times, may see some support.
All right, no, that's a big one. Thanks very much, Mangalam, for that. Tata Power reported earnings as well. Vivek has got details. Vivek, morning.
Well, good morning. Amidst the backdrop of muted power demand, low coal prices impacting the Indonesian coal mine profitability, and also on the other hand, what's actually done well is the newer line of businesses like the solar module, solar cell business. Amidst that backdrop, results are marginally above what the street was anticipating. Now, the key to watch out for will be the resolution as far as the Mundra Ultra Mega Power Plant is concerned. Looking at the numbers, revenues higher by close to 4.5%, coming in close to the 17,294 crore mark. EBITDA higher by 15.5%, margins are expanding by over 250 basis points, and profitability higher by 6%. Now, what is it that the company said in the conference call? Remember, like we had highlighted earlier, post the expiry of Section 11 Mundra, UMPP plants, all of the plants are currently under closure. However, the management has said that they are hopeful of signing supplementary PPA with all 5 states in the month of August itself. Along with that, the company has maintained the capex guidance of close to 25,000 crore, muted spends as far as Q1 was concerned, close to 3,700 crore. And lastly, the Odisha discount is something that's done really well, 2.5 times year-on-year increase in PAT. This is mainly on the back of improved AT&C loss reduction. So overall, going with a mild green, but remember, the core business is something that's still under a bit of weather.
Okay, all right, we'll keep that in mind, Vivek. Thanks very much. In fact, and we'll discuss all of this and more with Mr. Praveer Sinha. That's an interview coming up at around 9:30 a.m. Okay, with that, let's head to Vamakshi, ABB India. Just like ITC, there seems to be margin issue here as well. Vamakshi, fill us in. Good morning.
Well, absolutely, Surbhi. Weak set coming in from the company. When we look at the revenue, that saw an uptick of almost 12% on year-on-year basis. This is more or less in line with what the street was anticipating. The operational performance was very weak. Keep in mind that the cost of goods sold rose by almost 21% on a year-on-year basis, and this in turn, drove the kind of contraction that we saw in the gross margins. The gross margins were down almost 460 basis points. Other than that, the other expenses saw an uptick of almost 25%, resulting in an EBITDA margin contraction of around 600 basis points, and the net profit declined by 21%. So largely revenue was in line, but the operational performance was below what the street was anticipating. Now take a look at the some of the segments, how have they performed. Extremely good growth seen in the robotics business. The revenue grew by almost 180% on a year-on-year basis. Other than that, motion and process automation was subdued. Electrification saw good growth. Now the order inflow this time around was weak. It declined by almost 12% on a year-on-year basis. This is the second such instance that we've seen in the last 10 quarters. The order book, though, rose by 6%. It came in at 10,064 crores. Other than that, the company has also said that the board has approved appointment of a registered valuer to carry out valuation of the robotics division. They will be incorporating a new wholly owned subsidiary to house the robotics business as a separate legal entity. However, no decision on divestment of this to either the global parent or a third party has been taken for now. But overall, a weak set of numbers for ABB.
Okay, all right. Thanks a lot for that, Vamakshi. Hopping across to Gaurav. Gaurav, Federal Bank, those asset quality issues are plaguing it, looks like. Tell us more about the past quarter.
Well, yes. Federal Bank, when we look at the results, credit cost is something which is actually causing the pain here. And let's look at the numbers first. Advances growth, deposit growth, both was more or less in line with what the street is expecting. In fact, when we look at net interest income, that increased just by 2%, again in line with what the street is expecting. Other income, actually that led to the growth in operating profit. It was actually stronger than the street's expectation, but what remains weak is the credit cost. Now that was specifically led by fresh slippages in the agri-MFI business and business banking. When we look at fresh slippages that have increased almost by 50%, and specifically if we look at agri-MFI, the slippage increase has been at over three times on a year-on-year basis. In fact, in business banking also we have seen around 24% increase on a year-on-year basis, and that led to credit cost which was actually at around 0.65%, higher than what the street was expecting. Now management is guiding around 0.55% of the credit cost for FY26, but once again, given the quality of the book, it was not something that the street is expecting. When we look at the ROAs now, that have reached to 1%. In fact, net interest margins, they have come down to by around 18 basis points, and now management says that another 5 to 10 basis point of fall is what we can see in second quarter because of the rate cut impact. So overall, there is some pessimism on the ROAs as well. And as a result, when we look at the brokerages now, they have also cut down their target price. We've got Investec, IIFL, Nuvama, Nomura, all of them, they have cut the target price. In fact, Nomura has also downgraded the rate to neutral. So definitely a pessimistic view coming up from brokerages as well. And as a result, we will be watching out on this stock today.
Okay, all right, Gaurav, we'll keep that in mind. Thank you very much for that. In fact, we'll discuss some of these issues with the Federal Bank management. Mr. Venkateswaran joining in at around 9:50 a.m. Okay, let's go back to Manglam. Manglam's watching out for delivery. Tell us more, Manglam.
Well, if you look at the stock price move 2 days ahead of numbers, you would say that the street was sussing out good numbers, and that's exactly what this company's gone ahead and reported. 5.5% revenue growth, no great shakes out there, close to 2294 crores. But look at the EBITDA. It's jumped by 50%, over 50%. 97 crores has turned into 150 crores. And as a result of which, the net profit has surged by nearly 67%. 54 crores has turned into 91 crores. What has led this growth? Express parcel volumes grew by 14%, revenue grew by 10%. And out there was some compression in the margins, but held around that 16% mark. Part truckload, which is a higher margin business for the company, has actually seen a 17% revenue growth and a margin improvement from 3.2% all the way up to 10.7%. And the key trigger for them now will be after the integration of Ecom Express, increased volumes from there. And as we move towards the festive end of the year, the next few quarters are seasonally strong for the company. So expect the stock to be well bid.
All right, delivery in focus there. Mangalam, thanks very much. Stocks done well over the last 2 quarters when numbers have started to come through. MCX is the other one that we're going to focus on. And there's Honeywell Auto as well. Back to Vamakshi. Vamakshi, morning.
Good morning, Prashant. Well, a weak set of numbers coming in from MCX as far as the street expectations are concerned. When we look at the numbers optically on a quarter-on-quarter basis, they look quite healthy. The revenue is seeing an uptick of almost 28% quarter-on-quarter. The EBITDA too has expanded by almost 51% sequentially, largely driven by lowered employee expenses, IT expenses, as well as other expenses. And the margins have expanded by around 1,000 basis points to 64.75%. The EBITDA revenue as well as the margins have, however, come in below what the street was anticipating. The net profit, though, more or less in line given the kind of growth that we've seen in the other income, which is up almost 12% quarter on quarter. The operational metrics, they also look healthy. The average daily turnover for the F&O segment, saw an uptick of almost 25% quarter on quarter, and the premium turnover grew by almost 29%. Keep in mind that the board has also approved a stock split in the ratio 1:5, so therefore might see some support coming in from that announcement. But overall, when you look at the numbers, a slight miss as compared to what the street was expecting. Honeywell Automation, the operational performance was quite weak. The revenue growth came in at 23% above what the street was anticipating, but the gross margins contracted by almost 700 basis points. Given the kind of rise we've seen in the cost of goods sold, the EBITDA margin contracted by 410 basis points, and the net profit saw a downtick of almost 9% on a year-on-year basis. So weak set coming in for Honeywell, so going with the red for both MCX as well as Honeywell.
Going with green for the JK Lakshmi Cement, those numbers look pretty okay. The revenue growth was close to around 11%. You had the EBITDA number jumped up by close to around 40%. So on a sequential basis, margins were more or less flattish, but on a year-on-year basis, there's a sharp improvement in margins. Remember, most of that top-line growth is because of higher volumes, because pricing didn't move too much. And on a sequential basis, one of the rare entities which reported realizations were actually softish because they have exposure to North India as well as to Gujarat. The PAT number as well saw a big balloon up, backed by better operational performance. Finance cost was more or less flattish, but effective tax rate was actually lower. So that's what boosted the bottom line. On a per ton basis, the EBITDA number for the last couple of quarters is holding closer around that 1,000 rupee per ton mark, which is a sharp improvement on a year-on-year basis from around 740 rupees. The company currently market cap, the total capacity is around 16.4 million tons. They're talking about 30 million tons. And for that, they have charted out a path as well organically. We'll have to keep in mind and see whether or not there is some inorganic plan in mind. But going for green on the back of better operational performance. That said, let's wind it down. LIC Housing Finance, Gaurav, how are the numbers?
Well, yes, LIC Housing Finance, when we look at the numbers, here also we saw operationally weak quarter for the company, and this is again because of the credit cost. So let's look at the numbers first. Net interest income increased just by 4%, while operating profit increased by 7% on a year-on-year basis. But what remains weak is the provision. This number was a little bit high, and as a result, profit increased just by 5% on a year-on-year basis. When we look at some of the ratios now, net interest margins that have declined almost by 20 basis points to around 2.66%, and this was because of some of the pressure coming up because of the repo rate cut. When we look at the slippages, those were high. Seasonally, usually these slippages are high in first quarter, and as a result, credit cost was at around 25 basis points. It was a bit higher than what the street is expecting. When we look at the loan book growth, that also remained a little bit of weak in terms of numbers because it grew only by 7%, whereas disbursement grew just by 2% on a year-on-year basis. But on the flip side, this was something which was anticipated by the street already. What remains a key thing to watch out for is that the net interest margin guidance and credit cost guidance on the call today, but definitely as of now, weak set of number is what we saw from LIC Housing Finance.
Okay, all right, got it. Gaurav, thank you very much for that. With that, that's all. That's our top 10 list of stocks, plenty of earnings, plenty of news flow to go over. There's also, of course, the all-important headline that's coming from the oil market. It's actually a little positive because oil prices fell, last week. We have Manisha joining in with a roundup of all the action from the commodity universe. Manisha, good morning.
Morning, Surbi. Well, absolutely. We've seen the crude oil prices decline for a third straight day today, and that is as U.S. pushes for peace deal between Russia and Ukraine. The deadline is 8th of August, which is this Friday, and Trump has also threatened 100% secondary sanctions on Russian crude buyers. In the light of all of this, we've seen OPEC start to act and react. OPEC Plus has increased their production for the month of August by 548,000, and they're looking for September at a 547,000 barrels per day. So clearly, OPEC looking to take that market share in case there is some supply concern coming in from Russia. So that immediate supply bump is what is really bothering the markets right now. What also has seen a bit of a decline is copper prices, down 24% in the previous week, and we've started this week as well on a weaker note. And not just copper, if you look at zinc, aluminum, steel has continued to pull down back from its highs that we saw a couple of weeks ago. So metals also not doing well. The only thing that I see doing well is the gold prices. The U.S. jobs data, the way they came in on Friday, have led the market to put 75% probability of a September rate hike. That led to gold prices gaining 2% on Friday. It's trading nearly half to 1% higher even now.
Yeah, absolutely. Everything changed after that non-farm payrolls data. And we saw the moves in the commodity markets as well on the back of that. Thank you for that, Manisha. Well, let's see how the commodity complex plays out today. Well, we are on to earnings as promised. And the first company on our radar is Transformers and Rectifiers. And the company's actually done very well in the first quarter. It's been a solid start to the year because look at the revenue. Revenue's jumped almost 64%. And the margin's been sublime year on year from a 13% margin last year. Now they're almost touching 17%, which is what the company had guided that they'll eventually get to that range of 17 to 18%. So let's discuss this performance and more with Mr. Satyen Mamtora, MD at Transformers and Rectifiers. Sir, good morning and thank you so much for joining in.
Good morning.
So the numbers really say it all, right? What a solid start to the year.
Yeah, it's been a very good start.
So I just, for the benefit of our viewers, I just want to reiterate what you've said in the past. I think in the past you've said that this year you could do almost, 3,500 crores in top line.
Yes, that's correct.
And you were talking about 17 to 18% margins. Now that you're almost at 17 already, do you want to increase that guidance?
No,
Just tell us more.
I think that is a fair, fair place where we should be in terms of margin. Plus, see what's happened, it is the margins have also increased because our productivity is constantly increasing. We're constantly improving ourselves and developing ourselves in terms of the production. So the margins also have increased in terms of that. So yes, the margins would still remain at 17 to 18%, but 3,500 crores is looking good this year. So we should.
So the margin expansion, I mean, I just want to understand, because you're saying it's sustainable. What will keep the margins here? Is it a change in the mix? Is it different pricing? Is it different geographies you've entered? Because it's a very big improvement from last year.
So there is no change in the mix. We already have orders worth 5,500 crores in our hand, which the margins are already, we are aware of. The next year, the orders that we are taking, we are also taking at approximately the same margin. Plus, we're constantly improving ourselves. Mukul has joined us as the CEO. Now he's also helping us, develop. So, there is a constant evaluation in terms of the production and how we are doing it. So, we may look at a capacity utilization of 80-85% in the next few years.
As of now, what is the capacity utilization levels? And you have a facility that's coming on stream, I think the Moraiya facility.
Yeah, the Moraiya facility.
That would increase capacity by what, around 40%?
Moraiya facility will be around 22,000 MVA.
On a base of?
37.
So it's going up by more than 50%. Yeah, all right. And what is the current utilization levels of that 37,000?
Current utilization should be around 72%.
72%. And for this additional capacity that's coming on stream, you already have visibility in terms of execution, in terms of tie-ups, that's already in place?
Yeah, all that is in place.
So 80, you said 85% capacity utilization by the end of this year, right?
Yeah, we should be reaching there. We should be reaching there.
Mr. Mamtora, across sectors, when we look at it, transformers and transmission and distribution is one area where most investors we speak to can point to, and there are very few now, where they say, well, there is still strong revenue growth visibility over the next couple of years.
Yeah.
Do you have that? I mean, so in terms of inquiries, orders, not what you already have in the bag in terms of visibility?
Yep. So we'll be closing at around 8,000 crores order book by FY 1st April 26. And there is a visibility. We have approximately 18,000 MVA orders, not orders, but inquiries in pipeline, which will fructify in over the next couple of quarters. So yes,
18,000 MVA.
MVA.
Okay, and is there a way to tell? I mean, in terms of market share, etc. What is the, I mean, it's a seller's market. It's a seller's market right now.
It is not exactly seller's market, but it is a market where you can, if you have good quality and if you have good reliability, you can command some respect.
We had the management of KEC, of course, slightly different line of work recently, and they said that lots of orders coming in from the Middle East, for example. He also said that initial inquiries coming in from Ukraine, etc., because the grid needs to be rebuilt in many of these countries. Anything of that sort? Or is very early?
We at TNR have decided that we will restrict ourselves to only 10% of our total turnover in terms of export. We want to restrict ourselves to 10%, not beyond that. And in that, whatever comes, we are exploring those.
Which are the on that? Which are the main export markets for you? I don't know if you do anything with the USA.
So
there's a FTA because there's so much changing on trade. I don't know if you want to revisit that. Just
So
tell us.
Australia is one of our biggest market.
Okay.
Africa is one of our biggest market.
Okay.
South America is one of our biggest market. Russia, we have been supplying some transformers too.
Okay.
So, and we have some relation with Ukraine in terms of, because we had a technology transfer tie-up with ZTR in Ukraine. So we have some relations there. So that can also develop.
All right. Final question, sir, before you go. Debtor days had reduced. That's what you mentioned in the past. And the working capital days, we're looking at bringing it down. What is it at? And I think the target was 100, 110, 120 days?
Yeah, the target is still remains at 120 days, 110 days.
Okay.
And we are at currently 135, 137 days.
All right, great. Thanks a lot for coming down and detailing those numbers. It appears the last quarter's numbers were good and your visibility for the remaining of this fiscal as well is quite solid. We look forward to that and we'll track you on all these numbers. Thanks a lot for coming down. Time to slip.
Just a quick one on that point about, actually it's true, right? I mean, count the number of sectors, not companies, and there are outliers everywhere. But 15-20% steady revenue growth. Transmission distribution, hospitals maybe.
Yes, for sure.
Right?
Yeah. And
15-20%. And I think AMCs, because SIP flows are very, very solid, even if the market goes for a dip. I mean, that money is sticky.
Yeah.
Apart from that, maybe BF banks, some NBFCs, but then you got one or two everywhere. But as sectors, if you think about it, I mean, actually you'd struggle. I mean,
double-digit growth, not too many.
Just make one point on the capital marketplace. Last week for BSE expiry and NSE expiry, the volumes were almost the highest we've seen in multiple expiries. So the volumes in the futures and options space suddenly came back.
And that's raised the doubt whether Jane is back. But Jane is not back. Jane is
Without Jane.
Without Jane.
All right. Well, let's slip into a short break. Come back. Prakash Diwan is waiting for us. He'll give us some fundamental stock talk. Don't go anywhere. Welcome back. As promised, Prakash Diwan, our market expert, joins us on the show. Good morning, Prakash. Hope you had a good weekend. Well, one stock which was in focus in Friday's trading session was PNB Housing Finance. Stock ended down close to around 18%. Part of the street believes the downward tick was very, very exaggerated, and maybe it provides an entry opportunity. Would you concur, or would you say there's still too much uncertainty? Your take?
Good morning, Nigel. So I think, yeah, it does create a lot of uncertainty, especially given the continuity of what the management's strategy has been for growth. But eventually, organizations are always bigger than individuals, and they find solutions. It's one of the well-run businesses within the HFC space. But to be fair, there's so much available as alternatives that to say that if this is not working out, it's probably end of the road for PNB Housing Finance. It's a bit drastic. So I would believe they'll find a solution. It does offer an entry point if you like the business overall. Don't take this event out of the consideration. But remember, there have been some issues in terms of the PE exits, the kind of rethink that has come in ever since Carlyle got into the space. So there are other issues which probably overweigh rather than just the exit of the management. But HFC as a whole is offering enough opportunity. There's so much available in terms of newer business models, slightly newer names, not yet fully matured business models, but I think the valuations also give you that comfort.
Hi Prakash, good morning. Since we're talking financials, Federal Bank stock is often loved by a lot of people, but again, like a lot of the other BFSI names, once again, even here we have some asset quality issues, a little spike in credit costs, etc. How would you look at it?
Good morning, Surbi. So I think this is par for the course. You have an organization that's kind of in the throes of growth expansion on all fronts. I don't see any reason why would kind of one quarter is what you take away the growth potential from. You have certain things which probably are not in place, and we've got used to good parameters from some of these names regularly, and one of these quarters you could be in for some disappointment. But remember, April to June is also a quarter where most of the banks would probably focus more on strengthening their systems, processes, balance sheets, and it's not something which is growth-led. But the real growth, as and when it comes, the system growth as it develops. See, right now we just had about 7.5-8% credit growth for the system. Once this goes into double digits, you'll have a lot of opportunities for smaller banks like Fed to repair wherever the damage is. So I believe it's a good entry point if you really ask me, though there have been downgrades and all of that. But if you take a slightly contrarian view, you'll probably start seeing value from a longish perspective if the market gives you that opportunity based on these earnings.
All right, Prakash, we'll leave it. We'll actually take a quick break, actually. We'll come back. More coming up with regards to specific trades. Mitesh and Sudarshan are coming up after this break. Okay, welcome back. 6 minutes to go for the market pre-open to kick off. Sudarshan, Sukhani and Mitesh are with us with what they'd want you to do as far as specific trades go. GIFT Nifty still holding on with a 70-odd point pop. Gentlemen, good morning. Good to have both of you here. Mitesh, how things looking? I mean, on Friday, the Nifty broke the previous low. The Nifty Bank is also very close to doing it. How's the setup?
Good morning, Prashant. So, I have been calling for a test of 24,550. I think we did that. This 24,550, 500 is a mild support zone. So is 55,600 for the Bank Nifty. And both the indices are right now placed there. I would at least expect a bounce back. And I think the GIFT Nifty is kind of indicating we might start slightly positively. Let's see how the strength of the bounce back is. The overall structure is not very positive. So maybe this bounce back will see some kind of selling at higher levels. I don't know those levels as yet, but I think, closer to about 24,700, 750 zones, I would want to see if there is some shorting possibilities. Broadly till then, I think it will take the stock specific bias, but I believe that eventually we might break below these levels and go slightly lower.
Okay, a bit of a rebound and then maybe an assessment once again, whether that is a opportunity to sell. Sudarshan, morning. What about you? Where do you stand?
Good morning. Well, the idea was that the Nifty should drift towards 24,500. I think it's almost there on Friday. So we'll assume that that leg of the downtrend has worked out and has come to a strong support level. Now, whether this support will hold or not is something we'll find out in the next few days. So today's trade is close your short positions if you still have them. If you haven't closed them on Friday, assuming you have them, close them, wait for a small rally. If you feel comfortable after a 200 or 300 point rally, renew your short positions at higher levels. The worry is something else. We've reached a support level, true. But Prashant, the seasonally weak months are still ahead of us. So what will happen there? Therefore, the markets may again seek lower levels. That's what my anticipation is in September or October. So be careful. For the time being, close short positions, look to renew shorts on a decent rally.
Okay, all right. Got that. Let's get to individual stocks. Mitesh, you go first.
Morning, Naju. I have a mix of buys and sells. On the buying side is Asian Paints. That's one stock which after months of underperformance is now showing signs of picking up. So from a trading point of view, I'll look at a first target of 24.80 and recommend buying with a stop below 24.10. Similarly, Dabur is a buy with a stop at 529 for a target of 546. Dr. Reddy is on a mild pullback, say around 1230, 1235. Sell with a stop about 1252. Look for targets of around 1185 here. And Bharti is something which might turn weak if it starts trading below 1875. So on that breakdown, sell with a stop at 1896 for a target of 1830.
Okay, all right, got that, Mitesh. Thanks for the calls. Sudarshan, hi, morning. What about your stock list for the day?
Yeah, good morning. Given that I'm suggesting closing long, short positions today, I have an all-buy list, although, of course, it's in a very defensive area. Asian Paints, for me, also is a buying opportunity, stop under 23.80. Britannia is a buy with a stop under 56.80. And then the list goes on with FMCG. Dabur is a buy with a stop under 523. And finally, Lever is a buying opportunity with a stop under 2,500. Go for defensives, close your short positions, and watch the market.
Okay, all right, gentlemen, thanks very much for that. There's 2 minutes to the pre-open. Coming back to both of you a little later for more. We'll take a break. We are back and we'll have the management of Narayana Health to talk about their first quarter earnings. Stay tuned.
Welcome back. Well, we've got about 14 odd minutes before the rates kick in. In fact, the pre-open levels and the pre-open rates will start coming in right now. Let's wait for them to settle. ITC is a stock, obviously, that we'll watch out for. It's been a very, very mixed performance by ITC because while the cigarette volume growth is looking very good, the agriculture side of the business has done really well. You've got that margin impact playing out in the quarter gone by. That's the first rate we're getting on ITC, about 5 rupees lower. Prakash, how would you look at this one? I mean, glass half full, half empty. What's the call? You're on mute, Prakash.
Sorry, Surbi, but I'll have to disappoint you on this one because I have an open position. It wouldn't be fair for me to speak on this.
Okay.
But the glass is half full for sure. That's
okay, half
that's
full
it.
with the caveat that you have a position there on ITC. Prakash, very quickly, between Hero, Moto and Bajaj, you were discussing this with Sudarshan earlier. I mean, in the morning he was telling us about the numbers. The monthly sales numbers for Hero are definitely looking better than Bajaj, though they might be a little below the street's estimates for the month gone by. But what's your sense? Bajaj has kind of fallen off the radar. It's been a string of disappointing, sales numbers several months now. Your call on both?
So, Surbi, interestingly, what Hero has done is sometime back, about 6 months back, they started changing their strategy to focus on exports as well. And look at what they've done. I mean, they've done a Bajaj on the export side. Yeah, and that resilience that this builds for them while they continue to have a good footprint in the domestic market, especially in the lower price points, vehicles. It's going to be a very good balance. But if this gets repeated and the strategy kind of deepens, then you'll have a re-rating of Hero, which hasn't happened in years. Bajaj has already got re-rated and is kind of consolidating, but Hero is probably ripe for that. But you'll have to wait to see whether those numbers kind of continue. It's not just one-off because exports also is a very challenging environment at the moment. But I think there's definitely a lot of change afoot, and that kind of brings Hero to a priority in terms of allocation if you had to put some money into the two-wheeler space.
Prakash, we had the manager of TRIL, and I was just sort of thinking that sectorally, if you had to identify buckets where there is steady 15-20% revenue visibility, it is of course that space which is transformers, T&D essentially. I was thinking hospitals maybe, and by the way, we have a hospital company coming up on the other side. Narayana is joining us. Maybe AMCs within the capital market space. Anything else comes to your mind, Prakash? Any other pocket? I mean, there will be individual names here and there, of course, everywhere. But as a sector, anything else?
So I think the other sector that's probably showing some amazing changes in the internals is cement. Of course, it might not qualify for that 25% kind of growth because it's a very mature industry. But I think cement is showing very clear signs of a turnaround, and things would only get better after this quarter. So let's not undermine that. We've not talked about cement in the same vein as banking and defense and all of that, but there could be a re-rating that's underway for sure.
Okay, and what do you like in cement? We have the JSW Cement IPO as well. That's finally going to come into play after many, many months. They have the presser today, so we'll get the pricing. But what do you like from the cement pack?
So, Nigel, I continue to like Dalmia. There is a lot that's happened, and now things have kind of started turning out to be more favorable. Amongst the bigger ones, I think Shree Cement is one of the under-celebrated ones. It's just not been making any kind of news. But the internals are very clearly far more robust, and their balance sheet always kind of comes to the rescue. Though they had some leverage, which is very manageable as compared to the historic trends. But I think from the larger ones, from the top three, if you look at Ultratech and the ACC, Ambuja combined, and then Shree Cement probably has the makings of a fairly strong outperformer within that space. So I would go with that.
Okay, all right, Prakash, we leave it there. Thanks very much for joining us. Let's welcome in the Narayana Health Management. They reported a strong performance in Q1, highest ever quarterly revenue in Q1. And Sandhya J is Group CFO at the company, is now with us. Sandhya, good morning. Always a pleasure having you on the numbers. Just a quick word, Sandhya, on margins. I think at the end of the fourth quarter, you said margins should stabilize around 25%. For Q1, just around, just under 24%. Stick with that number overall, 25 for the year?
Good morning. Thank you for having me here, and it's always a pleasure. So our margins story is a sum of the parts kind of story. I think we are still trending quite healthy in terms of our hospital business margin. We have expanded the domestic business margin by about 70 bips, and Cayman has been fairly consistent. Now, the reason we are seeing this dilution in the margin is because we are investing in our integrated care business. So the total between India and Cayman, the total dilution in the margin that has come from the integrated care business is almost 28 crores. The positive part is that it has given a very healthy addition to our revenue portfolio. So we've added about 59 crores of revenue from that book of business, but that is causing the dilution. So we're still holding that our margins will be consistent, but we will have this little bit of dilution coming in from the integrated care business until the revenue catches up to the fixed costs that happen with every new business.
Hi, Sandhya. Good morning. Good to see you. In integrated care, at what level then of revenues does it start breaking even? I missed that point. What was the revenue in the past quarter?
For the integrated care business, for Q1, we've about 59 crores of revenue we've generated between India and Cayman.
Okay, and at what level does it turn, EBITDA accretive? As you said, at any business, as you venture into it, it takes time for it to break even. There is some fixed costs. So at what level does all of that cost break even and comes up to speed?
So we are looking at a horizon of at least 2 to 3 years, because the way the integrated care business works is that it's a cohort model. Each clinic breaks even at about 18 months time frame, but then we are adding new clinics. So which means that while we have broken even in one segment of business, there are new clinics which are coming on and which are going to be burning cash. So in all, from an India point of view, we have set aside about 450 crores for the integrated care business, 400 to 450 crores. Now, it will take 2 to 3 years time for it to be in a state where it is coming to break even, not because individual clinics are taking that much time, but because that we will keep expanding also and investing behind this vertical.
Okay, all right. No, got that. Sandhya, so I know it is, actually it is too early, right, to ask you about what kind of, on pricing, I mean, you take that one hike beginning of the year, which we saw in January, too early to ask about next year. We're just beginning H2 of this year. But I mean, is the pricing environment stable for that 8-10% kind of a price increase? You know, the big fear, Sandhya, is that hospitals as a business, right, overall, has continued to do very well. And there is strong demand for quality healthcare, etc. But a lot of investors, there's only one concern, which is, of course, valuations and the price you pay for when you're buying these companies, these stocks. The other one is, at some point, will the government step in some way with regards to pricing? And there's so much angst, right, on social media, etc. Narayana, of course, is at the lower end of the pricing, etc., compared to other chains. So absolutely acknowledge that. But, you know, and by the way, it's not new, right? A couple of years back, we had that in parts. There was some standardization of these costs, etc. Never really went anywhere. In any case, health is a state subject. Any thoughts you can offer, Sandhya, on this?
It is a very delicate subject, like you rightly say. But the fact is that there are a lot of costs to cover. I think somewhere that perspective also we need to understand all our equipments are imported. And we have the foreign currency impact also which come. And healthcare is a very manpower intensive industry. So we take impact of minimum wages, we take impact of annual escalations, and of course, we do try to automate and simplify, etc. But still, it's an extremely labor-intensive industry, and that cost pressure comes. And for larger hospitals like us, we also have significant costs which go into infection control, which go into quality, which go into maintaining a standard of care which is at international levels. That's why India is an international tourism destination, because of the quality of care that India offers. So it is not a very straightforward understanding that because people are more ambitious in terms of their margin expectation, and that is the reason why the pricing pressure is coming. The pricing pressure is coming due to a multitude of factors. The other aspect we need to see is that the industry cross-subsidizes a lot. For example, 35% of volume of the patients we deal, maybe by value it is about 19%, but by volume it is about 30-35%, are on government schemes, which are extremely subsidized. Our price recovery on these schemes may be less than half of our price recovery from the other customers. So some amount of cross-subsidization effect also comes in the industry, which is in a way good, because the people who use the government schemes come from segments of the society who cannot afford care otherwise. So therefore, it's very nuanced, this topic of cost of healthcare. And even I cannot comment on whether the government will intervene or not, but any intervention has to take this holistic picture into perspective before any action is taken. Just coming back on the question you asked about our own price increase, we take low single-digit price increases, which of course we took in as on 1st January. Though we've seen a healthy ARPOB growth, mainly because we lost our Bangladeshi volumes, which was a low ticket price business for us. So those were reasonably discounted procedures. And because we're substituting them with a little bit of domestic volume, so some amount of positive mix impact has come in. That's why we have seen a reasonably healthy growth in our revenue ARPOB and revenue per patient. But overall pricing, we have to see how it evolves. And yeah.
Okay, all right. Sandhya, no, absolutely very, very important subject there. And thank you for your views and your perspective on that. Good luck with the rest of the year. So that's the call coming in from Narayana Health. Stocks down 1% in pre-open. Very quickly, Sudarshan, 910, what's the call?
Well, it's Asian Paints. Consider buying Asian Paints with a stop under 2380.
Okay, and Mitesh, what about you?
Yeah, I'll go with a buy on Tower for targets of 546.
All right, gentlemen, thanks very much for that. Let's look at some stocks. Federal Bank, 5% lower in pre-open. And we've also got delivery, of course, tracking that as well on the back of earnings. Deliveries up about 2.5%. Manglam's here with more on delivery specifically. Manglam?
Well, I told you that, the delivery EBITDA actually increased by about 50% and the net profit increased by 67%. The company has given out some guidance as well, so let's put that out for our viewers as well. On e-commerce, they believe that the industry can be reasonably projected to grow upwards of 15%. And the acquisition of Ecom Express has enabled the company to go ahead and gain market share as well. And Express Parcel Service EBITDA, which had fallen to close to 16% in the first quarter, can be between 16 to 18% or 17 to 18% by the end of this year itself. On part truckload, they expect that, the business can steadily grow at over 20%. And the steady state EBITDA for them could also be between 16 to 18%. Remember, the number in the first quarter was close to around 10%. So that's a big upside that the street can see out there. And on supply chain solutions, they believe that this business could be around 1,800 to 2,000 crores with 12% plus service EBITDA margins over the next 24 months. So that's a positive. And finally, CapEx, the company said that the CapEx as a proportion of sales has been coming down from over 6% to around 5%, will maintain at around 4% in the next 3 years, along with Ecom Express integration costs that may not exceed 300 crores as guided for earlier. And the net working capital days also will reduce by around 8 to 10%. So on all parameters, the company has been talking up performance and they believe that there could be some improvement from here on. First quarter, seasonally weak, but good performance coming in. Let's see where the stock goes from here.
I think we've got market open coming up. Mangalam, thanks for that. Just a few seconds and we'll be, starting a new week of trading. What do we have? First rates. It is actually flattish, right? I mean, 24,580 on the Nifty. The Nifty Bank is just about making up its mind and we'll have the rates coming up there. The Sensex is up about, so it's as flat as they come, 5 and 15 Nifty and Sensex respectively. And the Nifty Bank is up about 0.25%. 55,740 is where the Nifty Bank is at this point. We've got mid-cap index, which is flattish. The small-cap index will come up on your screen and that'll give you a sense. It's, again, nothing on at all. and that's what's coming through. So out of the gates, you've got, 1,150 stocks higher and about 630 stocks lower. That's the broader market breadth. 2:1 clean, but this is just the first, within the first 1 minute as we're looking at it. And more up than down, and I can spot a bunch of financials, right, which are gaining. And you've got some IT names which are lower, Infy, Techem, HCL Tech, and a few others. So, but more up than down. That's the story at the word go. 46 points higher on the Nifty, 24,600 plus. Subi.
It's hard to find stocks that are doing more than 0.5% move on the Nifty. It's that kind of a morning. On the upside, it's the financials. Shriram Finance, Bajaj Finserv. These stocks are up about 1%. Tata Steel is having a good morning as well. 1% up on Tata Steel. There's Trent, which is seeing some traction this morning, 0.7% up on Trent. Asian Paints, which was a long call from Sudarshan just a while back, about 1% higher on Asian Paints as well. Then there is Eicher Motors, there's BEL. These are the early gainers. Even Hindalco actually is up and about. So both Tata Steel and Hindalco having a positive start. ITC is a stock that we should focus on. And ITC is having a bit of a wobbly start. It started positive, now it's cooling off a little bit. And just about a 1 rupee gain on ITC. Remember, margins have fallen quite drastically because of the increase in tobacco prices, tobacco inventory. But otherwise, the tobacco volumes are very good for ITC. Talk about what else is lower. Not too much actually on the screen. Eternal is down. Infosys is down about 0.5%. And there's some selling in Tech Mahindra and HCL Tech. So not a big list of losers actually. Incremental gains coming in for more stocks on the Nifty as we start off. Nigel.
Well, a few stocks that are calling for attention. PSP Projects, that one, in fact, was down, I think, close to 17% in pre-open. That's pulled back a little bit. I'm not sure what's the news flow out there, whether or not the street is anticipating some kind of large trade, because that's down close to 12%. So that's one stock on the radar. The other one is PNB Housing Finance. That con call just got, finished, and commentary seems to be reassuring a little bit. So that stock has opened up with a gain of close to 100%. Remember, the stock is in the F&O band, so you'll require some positive news. Then the shorts could get trapped on the short side. Otherwise, in fact, they've been riding on the gains post that resignation coming in at the top. Stock was down more than 15% on Friday. Sarda Energy, I think that's gapped up. You have SKS Power that's come into their fold. Now, more than a metal company, it's actually a power company, because SKS Power has started contributing big time. And that's why the EBITDA number has scaled up. The street likes it. The float as well will be a little bit limited because the promoter entity has close to around 73% or thereabouts. And then you have a lot of, few institutions as well, that institutional holdings around 6%. So float is relatively lower and the numbers look good as the SKS Power acquisition is working out well for them. Jaiswal Nico, that's the other one that's opened up on large volumes. That's up close to around 3%. The reason is that ARC selling has now been absorbed. Close to around 5 crore shares were pending, and that got sold out going by the BSE disclosure. So now the entire 25% has got sold in the month of July. We are back to fundamentals, and delivery from here on will be important. But I think Federal Bank, that's the one that's reacting on the downside. It was down, I think, 3% in the open. Now, in fact, it's cut its losses a little bit.
Yeah. No, absolutely. And, it's 70 points now? About 0.25% on the Nifty. 24,640 is where we are coming at in terms of the start. So now it's like kind of sort of in line with what the GIFT Nifty was indicating earlier on. But there are lots of individual movers which we will continue to pick out for you as we go along. But let's sort of also continue having this conversation on markets. Shreyas Devalkar is head of equity at Axis Mutual Fund. Is with us. Shreyas, good to have you with us here.
Good morning.
The broader market, Shreyas, I mean, take the NSE 500 group of stocks, for example, has been flat for a year now.
Yeah.
Right? A lot of dispersion within, but at a broad level has been done nothing for a year. What's your sense? Has there been enough time correction or not really? And although the problem is, even as that has happened, earnings expectations have continued to move lower. So where do we stand, Shreyas? At the late stages of this decline, sideways at price action, or something more here?
Yeah, sure. Good observation that you are making on the 1 year underperformance of broader market. And more important is, since you are highlighting NSE 500, it is earlier it was only about a large cap, but it is, if you look at the headline indices of mid and small, even there you are seeing that consolidation.
This consolidation, if you notice, if you go into further details, then the way I look at it is the success rate. So how many in the flattish market, actually the market from peak is maybe 4-5% down or 5-6% down. In this market, how many stocks are positive? Absolutely positive, because of the end of the day, equity is about the positive returns. And then if you notice that, then you will notice that in the large caps, broadly 30-35% stocks are positive. In mid and small also, that ratio is somewhere around 35%. So what in other words, what is also highlight is it's not only about headline level market consolidation. It is also about few stocks are delivering positive returns, and that success rate is around 35% odd. And most of the stocks are giving a negative returns on a one-year basis. This consolidation was warranted, no doubt on that, especially because of the higher valuation. One may always go back to earning decline or decline in the earning growth expectation, obviously not an earning decline per se, but that expectation cut was about to happen. Because when there is a sharp rally, generally the expectation run very high. When the multiples are at 50, 60, 70, 80 P, then in that situation, the room for error is very less. And generally the expectation of growth, it turns out to be very high, upwards of mid-teen and plus. Now, this kind of growth in an overall global scenario, it's not very easy. And when all the experts are predicting GDP growth rate, which is around 6.5, when everyone is predicting the growth rate of the global growth rate also lower, in that situation, it becomes very difficult for companies to outgrow the nominal GDP growth. And that's where, since the returns are converging to nominal GDP growth. So on a one-year basis, they are lower than nominal GDP growth, definitely. But on 2-year, 3-year basis, as the returns start converging to nominal GDP growth, I think that is when I would call out that yes, now the consolidation is behind us.
Yeah, absolutely. And we need to see that growth start to pick up, so it starts showing up in corporate earnings as well. Shreyas, great to have you on. So tell us, across your portfolios, I mean, when you talk about the growth play, I mean, obviously some funds are going to be more value oriented, some will be, based more on a momentum philosophy. But if you talk about pure alpha and pure growth, then which are the segments, the sectors or the themes where you still have clear visibility over the next year, year and a half?
So if we go by even these results, and though it is not over yet, it's maybe 30-40% over by now. In mid and small cap, it is not over yet, definitely. Broadly, the trends which were on for some time, they continue. I have not seen much difference in the trend across the sectors. Now, since you talk about the momentum where it is expected to continue, you just take the trends in the broader segments like electronic manufacturing services, where the trend has been good. And in the recent result season, the few companies which came out with the result, it tend to continue. On the capital goods side, one observation was the deviation was especially that earlier capital goods growth was broad-based. Now it looks like that is more concentrated in power T&D, and it doesn't look that broad-based, especially on the margin front, because the sector also has seen a lot of margin expansion in last 2 to 3 years. So on both margin as well as the growth front and order inflow front, in capital goods, the growth looks now more getting only in the power T&D capex spend than the broader market. The other part of the growth thematically has been in the travel tourism space. It has been in the hospital space. In all these segments, probably there are no earnings surprises, but I don't think there are much disappointments as of now in these spaces. If you take even in this retail growth, that is the retail industry, that is consumer services, even there, I don't think there are much disappointment, which includes quick commerce, which includes food delivery, which includes retail and travel tourism. So this is the pack on the consumer side, which has had a good traction There, I don't think there are much issues. Only on the consumer or high-end discretionary, the autos, which has showed slowdown. There, we are not seeing even now in the recent monthly numbers. There are not much revival.
Yeah, absolutely, Shreyas. I mean, and thank you for listing out some of those sectors, because this is just what we're discussing internally as well, in terms of where is the growth visibility. And you mentioned Power T&D. We were speaking to a T&D company, Transformers and Rectifiers, just a couple of minutes back before you joined in, and they've done really well. On power specifically, while you like T&D, any sense on the integrated players? And those stocks have not really taken off. I know you can't talk stocks, but I'm saying, large companies like NTPC or even Tata Power, and we'll be speaking to Tata Power in the next couple of minutes. The market doesn't seem to be taking a liking to the integrated large players, and it's only focused on the distribution segment. Why do you think that is the case?
So there has been always, so it's not only now, if you go back, so it's power is end of the day is infrastructure play, right? So earlier there used to be road, rail, and so on. Historically, if you see that as far as the wealth creation is concerned in the stock market generally distinguish between the asset owners and the capital goods companies, right? When it comes to both multiples as well as the wealth creation opportunities, there are reasons for it, because end of the day asset owners are balance sheet heavy and so on, and that's where their growth rate you cannot just extrapolate compared to the balance sheet growth, and it comes with the cost of obviously equity dilution or the debt creation. So in that sense, market has always distinguished between the two. So whether it is in earlier eras, it used to be rally in the companies which are asset owner in the road space or in metro space. It's a similar thing is happening here. So now generally in the initial part of that theme, the asset owners do well by way of re-rating, but when it comes to the continuity, then one need to look at the valuations in the asset owners, and that's how the differentiation in the stock behavior starts in this.
Okay, all right. Shreya's final question before we let you go. IT, the Nifty IT index actually has been a relative underperformer. But I was looking at two data points as put forth by HDFC Securities. One is the valuation discount to the NASDAQ is at around 20%. During COVID, it bottomed out at around 30%. So that's, expanded quite a bit. And the premium to the Nifty valuation itself has come down to around 15%. Normally, we have seen it bottom out at around 14%, and the peak has been 50%. So that's the valuation argument. But do you think, at current reckoning, IT is forming some sort of a basing out process where you want to buy stocks for the longer term, going by the recent underperformance that you've seen in tech?
Sure. Actually, on your valuation argument, I would also add one more metric of valuation, which is a DCF-based valuation. If you do a DCF-based valuation, then also not many sectors you will get a limited downside. So IT on the DCF-based valuation also, if one try to do with the current expectation growth rate of mid-teen to not mid-teen, it's a mid-single digit to high single digit. Broadly, this kind of valuations look good on that front as well. But now in IT, the trouble is on the indecision at the client end. And with that trouble, this indecision is getting too much extended. What we have observed in the recent result season also, though some companies are reporting, a deal flow in this quarter, but net deal flow for the industry is not as good. So there are gross deal flows. So where someone is losing, someone is gaining. So what is happening here is there is a consolidation, internal consolidation, which is playing out because there is no net deal flow addition for the industry. In this context of this winter consolidation, the real trouble is there are 2-3 sets of companies now in the market. So one company is, so without naming, some set of IT companies, what they are doing is they are trying to use their margin or balance sheet for some deals, while some companies choose not to, and they are focusing on free cash flow to PAT, which is the traditional metric. And with this differentiation in the strategy, you are seeing the rotation in the same deals going from one to other. In this situation, market generally reads through this. So there are companies you will find lesser growth, but then your free cash flow profile is very, very intact. while there are companies which are seeing good growth, but then those metrics are not intact. So all in all, since their overall deal flow is not that great, until the time that situation comes back, it's very difficult to be positive on that. Definitely, valuation is a good argument to have, and on that front, as I concur with you that even on 2-3 metric of valuation, the sector looks very attractive.
Okay, all right. Take that point, Shreyas. Good conversation. Thank you very much for joining in and sharing that perspective with us this morning. Appreciate it. So that's the view coming in from Axis Mutual Fund. Quick check on the market. And it's looking fairly steady, actually. 100 points higher on Nifty, so not too bad.
UPL, I don't know if you guys highlighted, right? I mean, it opened lower, sharply lower, hit about $670. And then it has bounced significantly. Actually, on the day now, which is from Friday's close, it's up 6.5%. So that's turning out to be, at least in terms of larger mid caps, one of the big movers which is coming through. I mean, I think we've been highlighting some of the others, of course. Delivery, MCX is the #1 volume-led gainer now after earnings, right? About 5% higher on MCX and so many others which are showing up.
Yeah, and absolutely. MCX, when the improvement in the performance is quite heartening, though some will argue it was below market estimates. But nonetheless, there's decent improvement. Their margins are almost back to 65%. So, on the road to recovery. So it would appear if you look at MCX's Q1 performance. Well, let's continue with the corporate earnings and corporate conversations then. And Tata Power is the next company on our radar. The stock, I think, opened slightly lower this morning. The first quarter performance is largely above street estimates. And we have with us Mr. Praveer Sinha, Managing Director and CEO of the company, to give us an outlook on the business now. Mr. Sinha, good morning. Thank you very much for joining in, sir. So first, a broad brush question, right? I mean, this has been a strange summer. Power demand, those headlines that we were used to every year, right? That peak power demand is shooting through. It actually didn't happen this year. In fact, it has undershot even the government's estimates, peak power demand during the entire summer season, which is why the government has removed that Section 11 as well, which was directing all plants to keep operating, right? And after that, even your Mundra plant, that's been shut down. So let's start with the broad overview. The fact that this has been a weak summer, could that weigh on the performance in the coming quarters as well? And what is your plan with respect to Mundra now that the Section 11 has been removed and the plant is in shutdown mode?
Good morning. Thank you for having me on your show. I think this has been a very strange summer, but so also has been the previous years when we had very high temperatures. So I think the impact of climate change is for us to see and understand that things are not going to be the same year after year. We'll have peak summers and we'll have very heavy rains. So we need to be ready for that. Having said that, I think we expect that this year the demand of power will be very muted. We do not expect a very high demand, unlike previous years because of a longish monsoon. But we do expect that the demand will possibly pick up to the last year level in the months of September, October, when the monsoon gets over and the heat is there and the humidity is there. So that's what is our expectation. As you know, that we have a very diversified portfolio. So it's not just dependent on the consumption, but it is also dependent on some of the other services that we provide. Our existing capacities, all our coal-based plants, they are very, very competitive and they are in merit order. So all of them actually are operating at full capacity. We didn't have any challenge as far as the existing. Our transmission distribution continue to do well. Our Odisha discoms did very well, and you have seen that their performance have improved tremendously.
Absolutely, sir. And we'll get to all of that one by one. Absolutely, Odisha has been, shining bright in the performance. But just to complete that picture, so one important, takeaway is that you're saying that though demand is likely to be muted for power this year, your plants are working at full capacity. So, I'm guessing if you could just give us the PLF range as well, blended PLF range, and also specifically that question on Mundra, what do you have in mind now that Section 11 has been revoked?
So, as I mentioned to you, that our plants are very, very competitive, and that's why they continue to operate at very high PLF and availability. All of them have more than 90% availability, and we get paid on basis of availability and not on basis of PLF. So that takes care of our existing operations in generating plants. As far as Mundra is concerned, it was operating under Section 11 till 30th June. Thereafter, since the demand reduced, the Section 11 was not extended. We have been in discussions with all the 5 procurer states. What is important to see is that Mundra is a very cost competitive plant compared to many other procurement that these 5 states do. In merit order, it stands out. Also in terms of the power that they procured from the exchange, the tariff of Mundra is much lower than the cost at which they are procuring. So it makes a business sense for everyone to have settlement which will ensure that this plant operates. We are in very, very advanced stage with all the 5 states, and we do expect that within the month of August, we'll be in a position to close most of the issues with the states and ensure that it becomes a win-win for everyone, because if the plant operates, it gives very competitive tariff to the procurers, and to us, we are able to operate the plant in a much more financially sustainable manner.
Okay, all right, Mr. Sinha, good morning. That's good to hear. So in the month of August, we will hear some PPAs, etc., being struck, right? We will with these 5 states. It's been going on for a long time, and hopefully we will see that this month now. Just one thing, sir. You said, what is your now? Have you revised your estimate for power demand overall this year? You began by saying you're expecting a muted demand.
Yeah, so we were expecting that in summer we'll have a peak demand of 260 gigawatt. That did not happen. Monsoons came around 15th of May. And we only saw very few days where it reached 250 gigawatt. And since then, it has been mostly in 220 to 230 range. We do expect September, October, the demand to increase because once the monsoon is over, the humidity kicks in, and that leads to increase in air conditioning demand. But definitely not to the level of 260 that we were maybe in the range of more like 240 to 250 range. So that's what we expect. But I think many of our plants which are operating at very, very cost-reflective tariff, they will be in a position to operate at full capacity.
Okay. Just very quickly, Mr. Sinha, what is your renewable energy capacity at the end of the first quarter? And could you give us a guidance for F5 for the full year?
So we have about 5,600 megawatt, and we expect to add another 1,600 megawatt in this financial year. So as you are aware, we normally do our own projects as well as we do third-party projects. Most of the third-party projects will get over in this quarter. And thereafter, all the capacity adds will majorly be for our own utility scale projects.
Okay. So now coming to the DISCOM business, I mean, given the success that you've had with Odisha and losses are coming down substantially over there, what's the progress with UP? I think you've already shown some interest there, but what stage are we at in terms of bids?
So UP, the bids are expected, that these things go through various approvals, including the regulatory approval. And I think UP Power Corporation has been in discussions with the regulator to finalize that. We do expect that within August, the bid documents should come out. It has gone through a huge amount of consultative process between various stakeholders, and we should be in a position to bid in those projects.
Okay. So finally, before we let you go, I mean, I just wanted to get your view as a large market participant on a big regulatory change that we're seeing in the whole power chain, right? I'm talking about market coupling becoming a formal reality, and no single exchange is now going to have dominance on the way the power trading market is playing out in the country. From a Tata Power perspective, and a lot of it for you, it's all long-term PPAs, but I'm just trying to understand if there's anything that you do sell onto the exchange? And just in a more general sense, what does market coupling mean for spot prices, the day-ahead prices, in general, even the term-ahead market for that matter, in terms of power rates, if anything?
So basically what we see is that there are three players in the power trading. Of course, there is just one who is the biggest amongst all of them and does nearly 90% of the trading. What is also to be seen is that overall, not even 10% of our power is through the exchange. And to that extent, I think there is a necessity to make it more deeper. As a country, we should have at least 20-25% of our power being channeled through the exchanges. I think if the market coupling takes place and everyone works very closely with each other in a collaborative manner, there is an opportunity to extend the trading of power that takes place and make it more deeper. I think all these are steps towards making the power markets more cost reflective and more reflective in terms of the demand supply. So it's a good step. I personally feel that this will take some time to stabilize, including some of the other initiatives on futures that is coming in and some of the derivatives in power futures. So I think we should take it more positively than getting too apprehensive about these type of changes.
Okay, and very quickly, sir, are you looking at buying out the partners in research and power ventures?
Well, we keep on discussing many opportunities, and that, of course, is also true for the resurgent. So these are always under discussion, but we can't say anything unless it gets firmed up.
Always a pleasure talking to you, Mr. Sinha. Thanks a lot for joining in. We look forward to chatting up with you as the year progresses. Moving from power, let's move to real estate, and we have the management of Godrej Properties who's joining in. Remember, the booking value declined for them, but the collections were up on a year-on-year basis. The management is saying that they're on track to meet and exceed their FY26 guidance. We have with us Mr. Gaurav Pandey, the Managing Director and CEO at Godrej Properties. Hi, Mr. Pandey. Good morning. Thanks a lot for joining in. Well, tell us, what's the outlook for the entire year? Sales have seen some pressure, but what will the full year number look like, going by what's in the pipeline?
I think we've had quite a good start. I mean, the guidance is about 32,500 crores of sales during the year and about 21,000 odd crores of collections. And it's largely kind of capitalizing on the cycle per se. So we've got a very robust pipeline of launches across the key micro markets and the cities that we operate. And our endeavor, if we get most of it right, we'll comfortably exceed our guidance.
All right, Mr. Pandey, especially for NCR market, which is an important market for you, what is demand looking like? Do you think it's oversupplied now?
That's a great question. I mean, it's so funny. Just 6 to 9 months back, there was so much negativity about NCR. And as you rightly said, again, it's become a sort of hotspot. I think we've got a great amount of land parcels in NCR. In Gurgaon, we have probably one of the very significant bets we've made in Golf Course Road, which is a heavily land-starved micro market. We've done some launches, but have a series of launch pipeline coming in Gurgaon, largely in Golf Course Road. In fact, one of which will hit within this quarter in Sector 53, a very, very exciting project done on a sort of a very unique Japanese concept. And then we'll have more launches like during the year, another 53 sector, we have a 7.5 acres of another parcel. So good pipeline, Gurgaon, great pipeline also in Noida. We have a series of launches planned in Greater Noida. We have a retail launch. First time we're going to come with a big bang retail launch. An asset class we've not really captured the opportunity. So while we've done some small amount of retail, but this is going to be something really transformative from a scale perspective. And then we again have series of launches in Greater Noida and at the residential launch in Godrej Golf Links. So yeah, we good pipeline. I think market is quite exciting. Yes, it is a very different side of the cycle. The quality developers will benefit more. And I think this from being euphoric to being more product specific is the kind of transition, as I would say, NCR is saying, which is very healthy, I would say, from a long-term perspective.
Got it. All right, Mr. Pandey, final question before we let you go. What is the outlook on cash flows and collections, especially since you're looking at expanding? Will it involve land buys as well?
I think a very strong balance sheet now, thanks to the very timely qualified institutional placement we did last year. About 6,000 crores we raised last year. And this is by far the largest QIP in the real estate sector. And through that, of course, we strengthened the balance sheet, but we also seen great operating cash flow. Just last quarter's Q1 performance, we were about close to 940 plus crores, 947 to be very specific on operating cash flows. And we have huge amount of dry powder coming up from both balance sheet strength and the operating cash flows in the coming quarters. So yes, we have enough and more to fuel our growth. But the good thing is the good work that the team did in the previous 4 to 6 quarters. We have a kind of a launch pipeline, sort of inventory of about 1 lakh plus. To be very specific, 1,14,000 odd crores is the kind of inventory we hold right now. And the fresh inventory, which is kind of the acquisitions we've done in the last 3 odd years, give or take, we have about 60,000 crores of inventory. So BD agnostic, we have enough and more to do great growth. But yes, there are great opportunities we're seeing in many micro markets where we are able to sell faster. We want to strengthen our presence in those markets. So yes, we will also acquire many more projects. In Q1, we've done a sort of a blockbuster BD quarter. We did about 5 acquisitions with a cumulative BV logged in, which is the booking value logged in of 11,400 crores spread across markets like Pune. We've got some 2 big acquisitions in Pune, which is going to add about 7,300 crores in Kharadi micro market. We've not been more or less present for a while. In Hoskote in Bangalore, we've added something. And in Warsaw, which is one of the prime micro markets of western suburbs, we were never in that micro market. I'm glad to share that we acquired this project again last quarter. And the more exciting part is going to get launched within this quarter. So yeah, very robust BD funnel, but also fantastic pipeline available because of the previous acquisitions as well.
You're sounding very optimistic about the future. We appreciate you joining in, Mr. Pandey, and giving us all of those details. We look forward to chatting up with you and getting a pulse of how the real estate market is progressing. For the time being, we'll slip into a short break. On the other side, we'll be joined by the management of Federal Bank. Stay with us.
Welcome back. Federal Bank is the next company that, as promised, we are going to be speaking with. So they reported a weak quarter with stress visible in asset quality. Credit costs are higher. We'll be speaking with Mr. Venkateshwaran, Executive Director and Chief Financial Officer at Federal Bank. Sir, good morning. Great to have you with us here. Appreciate your time. Prashant this side. So let's just start with asset quality first, sir. So gross slippages have risen to about 1.1%. Net slippage at about 0.84%. Both are higher. So if you look at Q1 of 25, these numbers were 0.8 and 0.4. So 0.8 has become 1.1 and net slippage has gone up from 0.4 to about 0.85 odd % or so. Could you just detail this out for us? I believe this is stress in the agri MFI segment.
Yeah, good morning, Prashant. Thank you for having me. Yeah, just before I get to answer your question, I would like to highlight the fact that this has been a very strong operational performance Q1. And typically Q1 is soft for banks, and even our own performance year on year, it's a very strong, operationally strong performance. QOQ, our operating profit went up by 6%. And all the metrics, whether it's the NIM, fee income, other income, has been very strong. To your question on the slippage, yeah, the large part of this has contributed by the MFI agri slippage, which caused this increase in credit cost and the increase in slippages. If you look at rest of the book, the asset quality is stable. There is no, cause for concern, even on a seasonality basis, Q1 over Q1. We don't see much stress. For CV, we are seeing a little bit, which is not something which worries us much. But the MFI agri is something which has caused this credit cost.
What is the size of the agri MFI book, sir?
It's about
which part?
It's about 4,000 crore, Prashant. So as a percentage of the book, it's very small.
Okay. And why did this go up? I mean, any specific reason, any particular geography?
Well, see, we do operate in about 20 states. It's diversified, but a couple of geographies where there was, especially in South, where some states had some government intervention, and that did cause this blip. Having said that, I do want to highlight that we have seen the slippages coming down over the last 2 months. From May is when it has peaked. So the slippage numbers for MFI agri in June, July, both have shown a downward trend, which gives us belief and confidence that the worst is behind us on this.
And gross and net slippage number, if you can give us, where overall, where will it stand for the full year? I mean, in terms of at least a guidance, yes.
Yeah, guidance in terms of credit cost, Prashant, we had earlier guided. I'm still sticking to around the same 55 bips level as credit cost for the full year. And we should be below 1% annualized slippage.
Okay, below 1% annualized slippage. For the full year, sir, you're at 0.6% now, right?
It's 0.8, right? 1.11 is the annualized slippage. Against that, I'm saying it will come below 1.
Come below 1. Okay, so annualized gross slippage will come below 1. Got that point. Let's talk margins as well, because I mean, that's a factor playing out across the whole sector. There is some pressure on NIMs. For you, I think net interest margins are just about 2.94%.
Yeah.
Now, what's the prognosis? And we have the policy this week itself. Who knows if we get another rate cut or not?
Yeah.
But how much more pressure before it gets better when the CRR cushion kicks in the second half of the year?
See, if you look at our NIM trajectory in Q1, in fact, our NIM drop has probably been the lowest amongst banks, taking into account the fact that our repo gets repriced at T+1. So a large part of the impact of the repo is already reflected in this NIMs. Having said that, we still have the June rate cut full quarter impact, which will come. 2/3 of it will come in Q2. And we do expect the NIMs to probably go down by another 5 to 10 bips, and it will bottom out at those levels. So around 285, around those levels could be the bottom for us, assuming no further rate cut. And from there, we believe H2, we will start seeing the NIMs coming back. And the second part of that is it's not just the asset side story. What I want to highlight is the fact that we have the best CASA ratio year on year and CASA movement amongst all the private sector banks. And we had 108 bips increase in CASA, and the CASA ratio has also improved sequentially Q4 over Q1. So the liability side benefit is also beginning to kick in and getting reflected in the NIMs.
All right, sir. Hi, good morning. Good to see you, Ben. I missed the loan growth number. What kind of a number are you gunning for this year? I recall in the past you were saying that you'll outgrow the industry. So do you hold on to that view? If you could give us a percentage band. And the other part I wanted to focus on is the ROA. has the ROA bottomed out?
Yeah. See, the ROA for the quarter was 1, and we do expect that it will remain around the same levels in H1, and then we will start seeing it pick up in H2. That's the outlook which we have. And our expectation is that we will get to closer to around 1.15 end of the year. On the loan growth, whilst Q1 has been relatively soft at around 9% growth, but again, one has to look at the details. 50%, nearly 50% of the book is mortgage and home loan where we have not grown in Q1. Despite that, there's a 9% growth, which means that the targeted, identified, mid-yielding segment is where we have seen the growth, and that's where we are focusing on. Commercial banking has grown 5.5% quarter on quarter. Right. You've seen growth in CVC. Cards has grown.
No, we have those numbers. Just a quick point. What is your LAP exposure, sir? And small ticket size LAP exposure, say under 3 lakhs?
It's a very small percentage at this stage, Prashant. That is one segment where you'll see a significant step up going forward.
And what's the, Mr. Venkateswaran, to get back to the loan growth, targets for this year? You said that in the first quarter, mortgages and housing actually didn't fire, but you were at 9% growth. Yeah. What's the outlook for the rest of the year, and which segments do you think will drive it? These mid-market segments or the mid-yield segments that you're talking about?
It will largely be driven by the mid-yield segments, which I mentioned. And gold loan, again, the June circular which came, we have seen only 1 month impact of the growth in Q1. You'll see a full benefit of the gold loan growth coming back strongly rest of the year. All the mid-yielding segments, but in corporate also, we will see the mid-corporate growth coming back, and that's the area of focus, and not the top end of corporates. So based on the loan mix change, we do expect the growth to be around 1.2x of nominal GDP. That's the outlook which we have.
Okay. So just to one point, that LAP, low ticket LAP, you're saying there is significant room to expand. It will go up significantly, you're saying?
See, the base is so small, so as a percentage, Prashant, it will look higher. But
okay. No, I'm just, across companies we speak to, that is one feedback is that is where a lot of stress is. People borrowing small, in that segment, right, and then putting it to use wherever, and that is developing as a stress point. So that's why I wanted to check.
Yeah, there is a difference. There is a micro LAP and then the LAP, loan against property retail. There is a set, market where, again, it's all about the credit underwriting. And so we are confident that, there is room for us to grow in that.
Quickly, sir, going by what you're saying, the loan growth should be 12.5% ballpark. Going by nominal GDP should be around ballpark 10%, hopefully. Before we let you go, I think gold loan as a percentage of a mix is around 12-13%, right?
Correct, yeah.
Where do you see that number headed?
We can pencil in upwards of 25% growth on that.
On the gold portfolio.
So ideally, as a percentage of a mix, say in the next 3 years or so, it should contribute a far larger chunk as a percentage of your loan book mix. Ideally, where would you like that number to stabilize at?
Over the 3-year period, see, the book also will grow. So,
yes.
Say around 15% is where we are looking at.
Okay, so 15% of the book should be gold loans over the next 3-year period. And growth for this year, hopefully 12%, if not better. Got that point, sir. Thank you very much for joining in and got to get that perspective. That's Federal Bank saying that these asset quality issues, the credit, the rise in the credit cost, all of that should bottom out basically in the second quarter. Stocks down about 1.5% right now, but the market, by the way, has been really volatile. 100 points up, and then we gave up the 100 points, and now there's a bounce coming in. Really, really choppy morning. Good time to bring in Mitesh. Mitesh, it's been, all over the place. What's the advice? Index trades, stocks, what to do now?
I think, the one index I'm keeping a very close watch upon is the Bank Nifty. Now, 55,600 is an important pivot, and we're just hovering around that. So in case we start breaking below today's low, then I think the Bank Nifty could take a slight dip, and that could in turn pull the Nifty down. And the next support areas come closer to about 54,750, 800. So keep a watch on that. I think if it breaks today's low, people can possibly look at taking some negative positions on the Bank Nifty, which is buying put or doing a put spread or something like that. And that's how I think the index will shape in the next 1-2 days. On the stock side, I have one buy and one sell. On the selling side, I have sell on Crompton with a stop at about 325, 325 half, and look for a target of around 315. And delivery, I think, looks like a good buy. Keep a stop below levels of 442. Look for targets of 470.
And delivery has delivered. Thanks, Mitesh, for that. More later. Hero MotoCorp is what we want to focus on. Stocks up 2.5%. Let's bring in Sud to talk about this one. Sud, take it away.
So amidst broad-based gain in auto stocks, one stock that has been in focus is Hero MotoCorp. It's the top Nifty gainer. It's on the back of strong July sales that company has reported. So unlike other auto companies, one positive factor that has worked for the company is when domestic sales have increased. And apart from three factors, so if you would have heard that all the companies have been talking about the rural economy has been doing better, and Hero MotoCorp being the leader in the entry-level segment, domestic segment continues to do well. Even exports have been doing well, and future outlook with the upcoming festive season, the sentiment will be improving further, and we are expecting that volumes are going to increase. Now talking about July sales, total sales were up 22%, domestic sales have increased 19%, exports were up 64%, and one segment that has led the growth is scooter segment, where we have seen sales growth of 64% versus estimated growth of in the range of 20 to 25%. So two companies that have been the biggest outperformance in the month of July are TVS Motor, and second one is Hero MotoCorp. That's the reason you are seeing a big gain.
All right, so thanks very much for that. So Hero in focus there. We take a break. Manisha on the other side, commodities in focus.
Welcome back. Volatile Monday morning for equities. Let's find out what's the latest in the commodity world. We have Manisha with us. Manisha, what do you have your eye on?
Well, the crude oil prices, because, last week was a better one. The month of July actually saw some gains, but August clearly has not started so well for the crude oil prices. It's a third straight day of decline for crude prices, and we are down by 6% in this year until now. The latest of triggers clearly are coming in from the OPEC Plus meeting that was on the weekend, and OPEC has decided, the 8 members that is, that they will increase production by 547,000 barrels per day in the month of September. Well, let me remind you that this has been going on for the last 6 or 7 months now. OPEC started on a lower note at 138,000 barrels per day for the month of April, but then came May, June and July, and every month we've seen an additional 548,000 barrels per day of an increase. And for the month of August was 548 as well. What we are looking at September, and markets were imagining or thinking that there could be a pause, but clearly not. So we are looking at really strong supplies continuing from OPEC there. Why it also does make sense is because, remember, the US has been pressuring India to curb Russian oil imports. US also has been pushing Russia to ensure to go to a ceasefire, and that deadline is 8th of August. If that does not happen, then we are looking at 100% sanctions on secondary oil buyers when it comes through from Russia. And that really is a concern. If Russia does go out of market, there's not enough spare capacity that OPEC has to fulfill that. So that concerns really has led to OPEC increasing production at this point in time. Also, when you look at the numbers, Russia in the first half of this year has been a top oil supplier to India, while India, of course, seems to be increasing its imports from US as well. And that percentage also has gone higher from 5 to 8%. But the first half still shows that 35% of overall oil supplies that India got were still from Russia. So this maths or calculation on how things will move going forward, whether India starts to import more from US or the OPEC share increases, are some of the factors that the street will watch out for. In focus in the meanwhile is the US President's decision on Russia that comes in on Friday. The US also has introduced, remember, most extensive and stringent of sanctions on Iran in the last 7 years. Some Indian companies have been impacted with that as well. So this continues to be quite edgy as in place. US tariffs also between 14, 15 to 40%. That start by the end of this week as well. So looking at all of that and impact therein, there is some profit taking that we've seen the crude oil prices start this week with.
Right, Manisha, thanks very much for that. That's oil in focus. On the other side, it's our special segment. It's the economy. Lata in conversation with CNBC-TV18's Citizens Monetary Policy Committee to discuss what they expect from the RBI day after tomorrow. Stay tuned.
থাকতে পারে।
The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC-TV18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chenoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to. And hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though where the US puts on a tariff wall, it's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers. But the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think, Lata, just to take it a little bit forward with the Sajid's argument, yes, the growth has been weak, and continuing the same vein what Sajid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number. But that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth actually, and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum, if you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better, possibly in the first quarter, maybe a little more in the next 3 months. But the second half is actually going to be diametrically divergent. So in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half would be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth, given the way things have been unfolding.
Okay. So even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Lata, I think the balance of risk, both to growth and inflation projections of the RBI are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the kind of summer decline in inflation has been much more than what was anticipated before. And the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9-12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad-based across cereals, as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, we'll probably reach somewhere around 4.5 inflation for the Jan-March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan-March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
Well, this is the thing. The point that Sajid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
The first question that you have to vote on, what will the MPC do to the repo rate on August 6th? Can I start with Samiran?
We are expecting a 25 basis point repo rate cut in the August meeting.
Okay, cut. Soumya?
We are expecting a 25 basis point cut.
Oh, that's 2 cuts. Sonal?
We think the MPC will hold rates this time, but a dovish hold.
Okay. Hold or a pause. Sajid, pause or cut?
It will be a pause.
Okay. Dr. Sen, your team is divided 2-2. Which way do you tilt?
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying. Finally, if you include an action on August 6th, how many rate cuts do you see in 2025? Samiran?
Only 25 basis point.
Okay. 1 cut only, that which you're expecting on August 6th. Soumya?
We are also looking at 1 more cut, 25 only.
Sonal?
50 basis point more.
Okay. Again, there is a dissent here. Sajid?
I would say either 0 or 25 basis points.
No, I'll have to go with 25. No, I can't take either or. I'll take 25. Dr. Sen?
On this, again, I will go with Sonal.
Okay.
delay and when you do it, have a 50 basis points cut.
Hero MotoCorp is the top Nifty gainer after moving almost 3%. A strong set of sales in July led by the scooter segment does well for the company. The management also expects volumes to rise in the upcoming festive season.
Delivery surges following a strong set of numbers. The stock is up close to 4% as the net profit surges by 70%, while the margins also expand. The management also expects double-digit growth going forward.
MCX rises, reports strong sequential growth while EBITDA margins too hit a multi-quarter high. The stock up 5.5%. The board also has approved a stock split in the 1:5 ratio.
ABB India corrects as margins contract and order inflow comes in under pressure in the first quarter. Tata Power also slips following first quarter numbers.
UPL rallies post their numbers on Friday and declining there because brokerages are positive. HSBC and Kotak both issue notes on the stock.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see to the top of the screen, well, most of the indices are trading in the green. It's been a volatile morning, flickering between the green as well as red terrain. There are a couple of parameters that are in the oversold zone. So that's why there is hope that there could be some kind of a bounce, though the structure is looking a little bit weakish till we get past the 24,850 mark and then all eyes on the 20 DMA. Hey, Mangalam. Hi,
Nigel. We take that point entirely. There is volatility. We are close to, oversold zones, but we have a bunch of triggers to watch out for as well. The RBI monetary policy meeting underway this week. The outcome is something that we'll watch on the 6th. Meanwhile, just keep an eye out on a couple of stocks from the broader market. Godrej Consumer reports its numbers in the next fortnight or so. The stock is lower right now at the low point of trade. ABB India, Vamakshi told us that the margins were amiss and the conference call is currently underway. That stock has moved to the low point of trade, so keep an eye out on that one. And PNB Housing Finance, it was the stock of the day on the downside on Friday, entered F&O ban on day one of the series as well, and now currently selling off a little further, down 4% at this morning. What we'll do is, in a market like this, get you some ideas for profit. Our colleagues from Money Control Pro join in. Today we have Neha Dave. Neha.
Today's stock idea is 361 Wealth and Asset Management, the largest non-bank wealth manager, which is one of the key beneficiaries of the structural growth in the wealth management industry. No wonder the company reported its highest ever quarterly profit in Q1 FY26 on the back of robust growth in assets. AUM growth was driven by strong inflows and mark-to-market gains supported by a rebound in equity markets. The strong inflows during the quarter was also due to additions of distribution asset of B&K Securities that was acquired last year. This could more than offset the outflows from the wealth management segment resulting from the team attrition. While the company's total asset under management, distribution and advisory stood at over rupees 6,60,000 crore as of June end, management's focus has been on growing assets that earn recurring revenue. Recurring revenue constituted around 77% of the total revenue in Q1 FY26, which is very positive as it reduces earnings volatility. In terms of valuation, the stock is currently trading at around 31 times earnings estimated for FY27. Valuation looks rich when compared to return on equity of around 20%. However, it is important to note that the return ratio is currently compressed mainly due to recent equity dilutions and inorganic growth strategies pursued by the company. Outcome from such strategies are rarely linear. The recent acquisitions, especially the collaboration with UBS, have the potential to significantly alter the growth trajectory of the company, with the results becoming evident over the next few years. Long-term investors should accumulate the stock.
Okay, all right. Thanks a lot for that, Neha. For the time being, we slip into a short break. On the other side, we go full throttle on managements. We have the management of RK Forgings who will be joining in. Stay tuned.
Welcome back. You're watching us here on Chartbusters. Let's get chatting with the management's post their numbers. And today, the first one on our radar is Ramkrishna Forgings. Remember, the company reported a muted set of first quarter numbers. The management has given a healthy outlook for the second half of this year, and which is what explains the stock's outperformance versus its numbers. Naresh Jalan, who's the managing director of the company, now joins in to discuss their first quarter numbers. Thanks a lot, Mr. Jalan. Understandably, it was a weak performance given the global uncertainty that we are seeing. But you remain confident of this 15 to 20% volume growth for this year. If you could give me two numbers, going forward, what proportion of your revenues comes in from exports, and split this 15 to 20% volume growth in both domestic and exports business. And the second number is the capacity utilization that slipped to sub 70% in the first quarter. Where do you see that number headed by the end of this year?
Good morning. I think our past export performance was close to 60% domestic and 40% exports, and which premix right now has changed to 66% domestic and 34% exports. And that's the reason, because mainly due to North America slowdown and consumption in North America being on the lower side. But going forward in the second half of the year, I think most of the new order wins which we have had in Europe are going to play out for us, which makes us very confident that our export premix in the second half of the year is going to go back to 40% plus, and we will be able to clock the revenue growth as per guidance.
All right. And volume growth, sir, will be around that 15-20%? That's doable?
Yes,
with margins? Yeah.
With the increased capacity, which has been augmented over last 1 year, and which most of our capacity is going to get completed in terms of our expansion by this September end. So I think we are looking at almost 15 to 20% volume growth in the second half of the year.
And margins will improve substantially from these levels, because first quarter has been weak, but you were guiding for 21-22%. So by which quarter does it hit those levels?
I think on a standalone basis, RKFL margins are going to, by fourth quarter or first quarter of next year, going back to the old margins of 20-21%. And with the new capacity of castings being augmented, castings will always remain a lower margin business. So we are looking at 16-17% margin from the casting business. So overall, on a console basis, we are looking at almost 19 to 20% margin going into first quarter of FY27.
All right. So 19% by the first quarter of FY27. If you could give us the split in terms of the growth that you anticipate in your export and domestic business this year. First quarter exports fell by 19%. The overall year, you expect on a consolidated basis to grow between 15 to 20%. If you could split that up between export and domestic, and in export, if you could split that further up into US and Europe, because your Europe contribution has been increasing over the years. Where does that stand at, and what pace is that likely to grow at?
So I think to answer your last question first, I think our Europe exports are going to double down going into second half of the year and into next year. So most of the growth in exports are going to come from Europe. And from North America, non-auto segment is going to grow for us vis-a-vis the auto segment. So both these taken together, I think our export volume should by the year end grow around 10% year on year. And we are pretty confident to maintain this growth into next financial year also.
Okay, exports grow 10%. Overall, you expect to grow 15 to 20%, which implies that a lot of the heavy lifting will have to be done by the domestic business as well. In US and Europe, what is the revenue split right now? And what is it likely to be going forward, since Europe is doubling and US is still under pressure?
So in the current quarter, the volume is close to around 70-30. 70% has come from Europe and 30% from North America. And going forward, I think with non-auto segment from US, North America market going to do well in the next half of this financial year. I think the premix is going to be growth-wise, the new volume which is coming in, 60% is going to come from Europe and 40% is going to come from North America.
Okay, all right. What about the railway business, sir? You have some orders in hand and you are guiding for better times ahead. So on an annual basis, what kind of revenue potential do you see from the railways business? And say in the next 3 years, where do you see this business scaling up to?
That is the main reason why we are looking at domestic doing extremely well for us. I think exports railway business is going to compensate the major growth part which is going to come in RKFL for next 3 years. I think with the new approvals which we have received for manufacturing the complete assembled undercarriage, which is going to start production from the second half of this financial year. This is going to double our business from railways for the passenger segment. And I think this is the path wherein we are going to continuously grow, and that's a heavy lifting going to come in the domestic industry. Railway, we are extremely confident that this financial year we are going to double our revenue from exports with the previous year. And this growth is going to continue with the kind of healthy order book which we have had from railways right now, which is going to continue for next 2 years' time.
Give us a number, sir, absolute number.
We are looking at almost by end of FY28 to do close to around 750 crore to 800 crores revenue from Indian Railways.
750 to 800 crore from Indian Railways by FY28. Just two numbers before we let you go, sir. The first one, I remember AICL, you were targeting 500 crore revenue in FY26. Are you on track for that? And could you give us an FY28 number for that? And the second part, you were expecting autos to be 70% and non-autos to be 30% of your sales by FY26 as well. Are you on track for that number? And do you have an updated guidance for that for the next 2 years?
So in terms of our auto and non-auto, we are on track. And I think we should be doing by FY26 end almost 70-30 in terms of auto and non-auto. And this premix should further improve going into next financial year or probably by FY28. And in terms of ACIL, ACIL is now already a merged entity in RKFL. We have already, last year itself, we have merged this on RKFL. And we have started getting almost 15 crore rupees revenue from ACIL in terms of their own contribution to the balance sheet. I think it's because of being company coming from NCLT, and it has taken more efforts. I think going forward in next 2 years, we should look at a very healthy revenue and margins from ACIL.
So 500 crore happens when? Annually?
So annually, I think it will take another 2 years before we see that kind of revenue from ACIL.
All right, take that point. Thank you so much, sir, for joining in and giving us a detailed outlook on the prognosis of your business for the next couple of years. Slight delay in ACL, slight sluggishness in North America, but you are more than making up for it by growth coming in your railways business and growth coming in from Europe. Non-autos would be 30% of your overall business by the end of this year, as guided earlier. Thank you so much for joining in. Wish you good luck for the remainder of this year. With that, we'll slip into a short break. And as we do that, here's some good news for all your viewers. India's business news leader, now just a click away. Introducing CNBC-TV18's all-new app, which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the app from the Apple Store or the Google Play Store. Just scan that code, which is up for you on the screen.
Welcome back. You're tuned into Chartbusters. You're on CNBC-TV18. Well, Skipper's the next stock on our radar. Reported a strong showing in the first quarter, registered record quarterly EBITDA, while order book as well was at record highs. We have Sharan Bansal, Director of Skipper, who joins us on the show. Hi, Sharan. Good to see you win. Well, good set of numbers. It seems the street liked it, and it appears you'll have an industry tailwind as well. And, the numbers seem to be picking up from here on. But for the first quarter, the growth that you've delivered is close to around 15% approximately. For the year, you were guiding for a 25% growth. Do you think you have enough in store to achieve the 25% and make up in the coming quarters?
Hi, Nigel. Yes, absolutely. We are fairly confident that 25% growth is very much doable in this financial year as well. We have grown very significantly. We've had more than 100% growth in the last 2 years, starting from a 2,000 crore top line in just 2 years ago in FY23 to ending with a 4,600 crore top line in FY25. Even from this elevated base, we are fairly confident of delivering another 25% growth. And that's going to come about on the back of our capacity expansion, which we commissioned recently. That got commissioned in Q1 of this year. So we did not get the full benefit of the new capacity in Q1, but from Q2 and 3, we expect to get the full benefit. So looking at the order book, which is 8,000 crores plus now, 25% seems definitely on the cards.
All right, 25% seems on the cards on account of the orders that you already have and the increase in capacity. But there are a couple of, headwinds as well. One of them is the shortage of manpower. The second is that you have increased your exposure to the US, where uncertainty around tariffs are underway as well. So in light of all of this, what does the order pipeline look like? We've looked at around 30,000 crore worth bidding pipeline that you've spoken about. Given the historic 20-25% sort of run rate, do you think that an additional 7,500 to 8,000 crore of order wins can be possible this year?
Okay. In terms of manpower, yes, you're absolutely right. That remains the biggest challenge in terms of ramping up execution. We are taking a number of steps in terms of recruitment, upskilling and training of manpower. And hopefully that's something which we will be able to deal with in line with the enhanced execution. The US currently makes up just about 1% of our order book. So it's not really significant for us as of now. And the situation on the tariffs is a very, very fast evolving and a dynamic situation. This is really something which we will have to wait and watch to see which direction it goes. However, we have enough opportunities in a number of global markets. Middle East is something which is very significant for us. Recently, in this quarter, we secured a very significant engineering order. It's not a supply order, it's a pure engineering order for Middle East's largest utility. So that is quite significant for us as well. And, we have sufficient amount of opportunities in other markets like LATAM and Australia as we speak. So the pipeline, of course, like you mentioned, is healthy at 30,000 crores. And even if I consider a conservative 25% hit rate that we have been delivering over the last several years, our order intake guidance of about 6,500 to 7,000 crores this year should be very much possible.
Okay, got it. And exports as a percentage of mix, where does it stabilize at?
Exports as a percentage of our order book as of now is just about 10% overall. In terms of our execution this year, we expect this to be somewhere around 15%. We have been taking in export orders roughly to the tune of about $100 million every year. Roughly 700 to 800 crores is what our export order intake and execution has been. This year, looking at our enhanced capacity coming online, where we will be able to take on more short-term export orders as well, and looking at our increased penetration into a lot of key markets like the Middle East, which I mentioned earlier, we believe that we can easily aspire to double our annual export order inflow from $100 million to about $200 million annually. So this is what our target will be to intake in this year.
Wow. So you are looking to double your export execution. Could you give us a sense on what does that do to your margins overall? Because there are two drivers as we see it. One is increased exports coming in. What's the delta between domestic and export margins? And secondly, some of these high-value T&D contracts with increasing complexities that you are delivering, what do they account for in your overall sales mix right now and your order book? Where do they go from here on?
Okay, so I just want to correct that in terms of export execution, it will be in line with, as I mentioned earlier, about 15% this year, because on the back of our order book that was there last year, our guidance for higher exports will be the order inflow for this year,
Got it.
which will result into execution of next year, perhaps. In terms of margins, definitely exports have a better effect on margins, and they come with about almost 1.5 to 2% better margins. Company has been consistently improving on margins also. If you look at Q1, we've delivered about 10.1% EBITDA compared to 9.6% overall last year. So we believe that overall 50 basis point EBITDA for the full year is very much possible for us as well. And in terms of the high value T&D margin projects, yes, we are executing a number of them. Most of our projects are in the highest voltage category, which is 400 and 765 kV and 800 kV HVDC. So yes, certainly as those executions come in to play, we can expect better and better margins ultimately to get to the long-term aspiration margin of 12% in the company in the medium term.
Okay, all right. What about working capital days? They had improved last year on a steady state. Where does it stabilize at?
Yes, you're right. We were able to improve working capital to just about 90 days last year. We believe that certain more optimization is possible. So we should be able to bring it by reduce it to another maybe 10 days or so in this year. We are at the best working capital days in the industry as of now. And in terms of what we are more happy about is the finance charges. We have been able to deliver a significant, improvement in finance charges as a percentage of revenue, which was about 4.6, 4.7% of revenue last year. This year, if you look at Q1, we've already delivered about 4.2. And I think for the full year, we should be closer to 4% as a percentage of revenue.
Finance cost as a percentage of sales from 4.5, it's come down to 4.2. You lend at around 4%. And the working capital days, sorry, I missed the number.
We're from 90 to about 80 days we should be able to achieve.
And very quickly, the polymer part of the business, that's a smaller vertical that's growing quite fast. Any signs of slowdown for the year on an annual number? What can you tell us? What will you achieve?
Polymer, we are very happy that we have delivered a good set of numbers despite not much business coming in from Jal Jeevan Mission projects. Those are pretty much non-existent right now. But despite that, the increase in plumbing sector business has led to this increase of volumes and execution in this vertical. And we are confident that overall in the year, 30 to 40% growth in this vertical should be possible.
All right, 30 to 40% growth. And just a one-word answer on infra. It fell 39% this quarter. What's the outlook for this year?
Infra is just a function of, the project execution. So again, overall for the year, we are pretty confident that we should be able to get 20-25% growth in this vertical as well. Again, quarterly execution may vary from certain quarters depending on the contract.
Take that point, reasonable there. Thank you so much for joining in, Sharan, and giving us an outlook for this year. Wish you good luck for the execution part and order inflow part for the entire year as well, with 50 basis points margin expansion. With that, we're out of time on this edition of Chartbusters. Thank you so much for watching. Stay tuned to CNBC-TV18 as Trading Hour comes up next.
Good morning. It's time for Trading Hour. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormuz Patakia. With me today is Vinny Motiwala. Vinny, good morning. It's a steady start to the week. After 5 weeks of losses, we've finally seen some rebound from lower levels, and the bulls would be hoping and praying that this continues. Sustains, of course, yes. And of course, they can't deny the fact that there are earnings reactions aplenty that are still coming in. No major Nifty results today, but of course, there are a lot of broader market names to track.
Absolutely, a lot of broader market names to track that we'll be keeping an eye on. And like you can see on the flashes at the bottom of your screens also, we have con call highlights that come in as well. ABB numbers were not that exciting, and we've seen the stock see a fall coming in. So that is something that we'll be keeping an eye on. But talking about the index itself, look at the Nifty. As of now, it's managing to hold on to gains of 0.3%. It's up 81 points. We've seen a bit of a flip-flop. It fell down, then recovered, and right now it's managed to hold on to that recovery. So that's something that we'll be keeping an eye out on. Now, Bank Nifty, that's not doing well today. Bank Nifty is underperforming, down almost 0.2% trade. 55,500 levels is what the Bank Nifty is at. IT also seeing a bit of an underperformance, so keep an eye on that. And other than that, Nifty Energy, that is also something that is under pressure. The broader end of the market, mid and small cap, that's performing in tandem with the benchmark indices, so not a worry coming in on that front. Nifty midcap holding on to gains of 0.2%, small cap also 0.2% of gain, but a lot of stocks that are buzzing on the back of earnings and other news flows as well. Which are these stocks? Hormaz, put the spotlight on these top movers and shakers then.
Earnings reactions, of course, you can see some con call flashes from ABB at the bottom of your screen. That stock has taken a bit of a knock. But before we get to ABB, take a look at Utkarsh Small Finance Bank, and that has seen a major knock today, 8% lower on the stock. The quarter has seen a very sharp deterioration in asset quality. Provisions have also gone up. And with this fall, the stock has now slipped below its IPO price of 25 rupees. And not only that, from its 52-week high, which is close to over 50 rupees, the stock is down over 60%. We've already had 55 lakh shares traded already in the first couple of hours of the trading session compared to a 20-day average of just 7 lakh. The other major mover today on the downside is PSP Projects, and that saw a block deal taking place earlier in the day. It's the top loser on the BSE small cap index. Nearly 2% equity changed hands on the index. Details here are not available as of now, and that block deal has resulted in almost 22 lakh shares already having changed hands today at this time compared to its 20-day average of just 35,000 shares. Now, Sarda Energy on the positive side is a big mover today, 17% higher on that stock. At one point was up 20%. It acquired a company from the insolvency process last year, and that has boosted its numbers, and it's the energy business contributing to almost 2/3 of its EBITDA. The top gainer on the Nifty 500 today, and on very, very strong volumes as well. 80 lakh shares of the company have already changed hands compared to a 20-day average of just 1.5 lakh. And lastly, Delivery, one of the many new age companies that were moving, but one of the few that still remain below its IPO price, 6% higher after its results. It's now closing in on that level of 487. It has not managed to cross that yet. And 19 analysts have a buy recommendation on the stock compared to the 24 that track it. But only 8 of them out of these 19 have a target which is in excess of its IPO price of 487. The stock has also seen very strong volumes today. Over 1 crore shares have already changed hands within the first couple of hours of the trading session, and its 20-day average is just 10 lakhs, so almost 10 times its 20-day average. A strong mover on the upside is Delivery, closing in on its IPO price.
Okay, that's interesting. Thank you so much for that list over there, Hormaz. An important one to keep an eye out on in trade through the session today. But Medplus Health, that's the one that we'll be keeping an eye out on as well. They reported their Q1 numbers. The revenue of the company grew mildly. Its margins and EBITDA expanded during Q1 FY26. We have Gangadi Madhukar Reddy, who's the MD and CEO at Medplus Health, joining in with us to talk to us about their numbers. Good morning, sir. Thank you so much for giving us your time this morning. Let's start by talking about the revenue. I'm seeing revenue growth coming in at around 3.6% year-on-year basis. First, if you could start by just giving us a breakup in terms of the volumes as well as the pricing growth that we've seen during this quarter.
I would say, given that we have actually introduced a private label product last year around the same time, and private label actually sells at a price which is almost 50% of what the brand sells. So every time we substitute a brand for a private label, we end up actually losing some top line. And that's one of the reasons why you're seeing that the year-on-year growth is actually much less than what it should be. I would say that the volume growth is probably closer to 6 or 7% out there for us. In the normal this thing, you would actually say that the inflation has actually eaten into some of your thing and volume would be lesser. But in our case, given that the price of the private label is way less, and that is actually a significant number amount of private label we sell, I would say that the volume is actually much higher than what the numbers actually show.
Mr. Reddy, good morning. Thank you for joining in. You mentioned you launched a new private label product this time around, but how much of that private label products are now part of your business? The entire business grew around 6% this time around. So what are you expecting the full year growth to be? And if this business is around 19 to 20% of your overall business, how much of a percentage increase do you see over the next couple of years, say?
So while I must tell you that the private label substitution definitely reduces the top line, it is actually more profitable for us. So even if there is a slight degrowth, I don't think we should really worry too much, because in real terms, the amount of money we make on our own label is double of what we make when we sell the brand. Hence, you're seeing that over the period of last 1 year, we have been consistently increasing our gross margin. Now, coming to what will be the outlook for our private label growth, we actually grew pretty significantly in Q4. Q1, we took a slight step back, as I had actually mentioned in the last call. So going forward, it'll probably be around the same or grow at around 1% every quarter in volumes. That is on the private label pharmacy side. So today, I think around 25% of all the medicines we sell come from the Medplus brand. And this within just a year of us actually launching. So we are obviously very happy with the way it is growing, but we know that this is largely because, the early adopters have moved in and bought the product. Now it is for the rest of the guys who are just sitting on the sidelines to actually convert. Probably be a little slower than the early adoption, I would say. So we'll probably grow at around 1% every quarter, maybe starting next quarter. So the 25% volume which we have of the medicines will probably go to 26, 27, and 28 as we go forward.
And how much is this private label business overall of your business, Mr. Reddy?
As I said, in value terms, if you look at it, in medicines, it's roughly around 14%. So 14% of our 6,000 crores would basically be this. So around 840 crores. This is on the pharma side. On the non-pharma side, it is 50% of all our non-pharma sales. So that roughly is around 500 crores. So you combine the both things, maybe it's around 12 to 1,300 crores overall.
Okay. Mr. Reddy, what about your branded side of the business as well? I want to understand the branded generic side. What is the growth there? What are you seeing in terms of the outlook over there? As well as in terms of store opening plans, you all have a strong store opening plan and aggressive plan, especially for FY26. So, both these factors, what are we watching out for?
Sure. So our store opening plan, we had actually mentioned that we do around 600. We have actually grown by 100 net this quarter. Typically, our Q1 is slightly slower, but by the end of the year, we should easily catch up and basically make our 600 stores. So that will happen for sure. On the branded side, while we are the best priced guys out there in the market, we continue to actually have the highest discount in both online and offline channels combined. I see us growing at the rate of the market, but a little bit of cannibalization is going to happen for sure. Some of the guys who come into our stores who buy regular brands and all may get tempted by the lower prices which we have on our private label. Our private label sells at something like 50 to 60% lower than the branded products. So some of them will switch. So for us, the overall growth is going to continue, but I'm not 100% sure of how much conversion will actually happen and so how much the actually branded products will sell.
Okay. And sir, given this store rollout plan that you'll have as well during FY26, what does it do to your margins, right? Currently, margins, I believe, are at somewhere at 8.5%. So for the year, will this 8.5% be something that we will sustain or, any impact on that is what we're watching out for?
I don't see, given that the 600 stores are on a pretty large base of around 4,800 stores, I really don't expect that this to drag it down significantly. it may remain where it is because we continue to increase the gross margin overall. So I'm not too concerned about that, I would say. Probably remain the same or slightly go up.
Probably remain the same. Mr. Reddy, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Medplus Health Services expecting margins to remain at similar levels or slightly lower. They're 1.5% down on the stock. Just pull up Premier Explosives though. That stock has exploded after this 190 crore order win from an international entity. The stock is up 9% as we speak. So a significant reaction coming in on Premier Explosives on the back of this order win. There you can see the spike there, 9% higher now on that stock. 462 is Premier Explosives. The markets too are picking up a bit of pace here, 100 points higher on the Nifty, nearing levels of 24,670 as we go into this short break. Put the spotlight on the commodities market with Manisha Gupta on the other side. Welcome back. All things commodities now. Manisha is here with us and she's here to talk about copper prices, which took a big knock last week, Manisha.
Oh, yes, and it doesn't seem to be stopping even now after that 24% of a decline in the previous week and coming off sharply from those all-time highs that the COMEX copper did make. We've seen further decline coming into the prices even now. So when you look at the COMEX copper, it is down 1.5% at this point in time. Some support on LME copper prices seems to be supporting the Indian markets right now, but it continues to be quite choppy. Well, remember, we did see a surprise tariff exemption to the refined copper imports into US, which are going to be attracting 50% tariffs, is what has led to this balancing coming in for the international markets. They're The concern now is that US could be looking at a glut right now because a lot of copper was brought in ahead of these tariffs, and now there's not so much of demand, and the storage cost or the warehousing cost is quite on the higher side. So you could be looking at a re-export of this copper coming back from US into London and other European markets. So there's going to be an increase in supplies many of these markets. Is what seems to be weighing onto the space as well. The other thing which seems to be weighing onto the markets is the Chinese refined copper production numbers. Now, for the year 2024, we saw a record number of 13.64 million tons. For 2025, the expectation is that you could be looking at nearly 5 to 7% of an increase, even 12% for that matter, on the numbers that we saw last year. In the first half of 2025 itself, the Chinese refined copper production has gained up by 9.5%, keeping the prices in check there. Especially the Chinese prices have been trading quite flat into the markets there. And the other supportive factor, though, is the demand expectations for China itself. Now, BMI and Macquarie say that between 3.8 to 4.2% of a demand growth is what we could see in this year in sense of copper. So slightly contradicting fundamentals. But if the Chinese demand does come back, because China is a 50% producer and consumer of copper as well, you could be looking at some support returning here.
Okay, Manisha, thank you so much for that, keeping an eye out on copper. But back to earnings, right? Symphony, that's the next company that reports their numbers. Q1 numbers, a weak set of numbers coming in from the company. We're seeing that the revenue has seen a fall of 36%. Obviously, do not forget we had those unseasonal rains that came in. The rains came in sooner than expected. So it does impact the company's overall, sales that come in there. But what is the outlook of the company going forward? What are we watching out for in terms of channel inventory? We have Rupesh Shah, who's the Managing Director and Corporate Affairs at Symphony, joining in with us to talk to us about that. Mr. Shah, good morning. Thank you for giving us your time. Let's start by talking about the Q1 numbers that came in terms of revenue. 36% fall this time. Now, obviously, this is something that would happen to anyone in the air conditioning, air cooling space, given that the rains came in sooner than expected. But channel inventory is also higher. So two parts. One, revenue overall, what is the outlook? Could this whole year be at similar levels? Do you expect a recovery? And channel inventory, those high levels, when do you expect that to normalize?
Thank you. You are absolutely right. All summer-related industry products have suffered, and that too, there was a very high base in June 25 because June 25 was exceptionally good summer. By the way, our June 25 quarter sales is second highest June quarter sales, surpassing earlier best of the best season sales. So, YOY, of course, there is a decline, but at the same time, that is what the traction and overall performance. And again, in March 25 quarter, there was huge pre-season sale, and hence March 25 had recorded all-time highest ever top line as well as profitability. Having said that, it is on account of launch of new models, including Air Force range, and also some of the non-household air cooler products, which in trailing 12 months have contributed more than 20%. They are non-seasonal, and to an extent, they have been savior in this quarter, and they consist of kitchen fan, tabletop, large space ventilated cooling, etc. Second part related to the inventory. Certainly inventory at this point of time in the trade is higher than what it is supposed to be. So there may be a spillover effect of that inventory in subsequent quarter, including current quarter as well as next quarter.
Okay, so you're expecting that to go into Q2 and Q3 as well, right? The inventory issues, by Q3 you're expecting it to normalize.
No, inventory gets normalized normally by February, March, when really consumer sales really peak, and consumer buying happens only from February, March. But in expectation of the season, in March quarter and early December, there is a normal trade sales also.
Okay, and for the full year, Mr. Shah, would you be able to do the double-digit growth? Last time you managed to see a 15% growth. Is that possible this time? Or because of all this, maybe we'll see high single-digit growth? What is it that we're keeping an eye out on?
Again, as per our IR policy, we don't give any forward-looking statement, including percentage of the growth. However, obviously, we have our own business plan as well as standby business plan to maintain the decent top line as well as profitability through various strategies.
Mr. Shah, well, you may not want to give us numbers, sir, but you could give us a yes or no answer. With a 36% drop in the first quarter, do you believe that the rest of the 3 quarters would have enough momentum that you would at least end the year with positive revenue growth?
There are various strategies in place. Let numbers come out and we will see what happens.
I was going through your investor presentation, Mr. Shah, and you mentioned in that your focus is on acceleration of your portfolio resilience and counter-seasonal product-led growth, where you have highlighted towers and kitchen cooling fans, large space venting cooling, and water heaters. Now, is this a conscious decision that you all have taken, considering how the first quarter panned out and how the subsequent quarters are looking like for your core business? And if not, how much of the acceleration would lead to these products being part of your overall top line, say, by the end of the year?
As far as these products are concerned, we have ventured into these products almost for last 2 years. And now we have really scaled them up. We have expanded the range, we have expanded the distribution network, and there is a huge potential to expand further. So even in June quarter, as far as this category was concerned, they have registered quite decent growth with a decent profitability. And as far as water heater is concerned, just last year, we had a test marketing in selected cities and towns. And now we will have all India launch. Rather, we have already launched as through e-commerce as well as large format stores. So, and third segment, which is exports from India, which is again nothing to do with India's summer season. So essentially, these 3 are the verticals where we focus to de-risk as well as optimize the performance.
Mr. Shah, just a last word in terms of, your Mexico as well as Australia subsidiaries. You're looking to monetize that and you're looking to divest over there. So anything on that front, if you could give us, are there any talks going on? Are there any potential, divestment buyers that are there? What is happening here?
Yeah, so it is at initial stage. There have been a decent interest by some very reputed major corporate, and some NDAs have been signed. But as you know, signing of NDA post that a lot of work has to be done. So I would put it, despite good interest and signing of some NDAs, it is at initial stage. Will take some time to take it forward and conclude them.
Very, very quickly, a 2-part question, Mr. Shah. By when do you expect this to be completed? If you could give us a timeline here, since you mentioned it's in the initial stage. And part 2, since you mentioned exports, is US a part of this export market as well? And do you see any potential impact because of this tariff-related uncertainties on the exports to the US?
Okay. Second part of the question first. So as long as our tariff is lower than China's tariff, which even currently is the case, we are really safe. In fact, in summer of 25, there was decent inquiry and reasonable decent sales to US. Many large format stores of USA are actively in discussion with us, and some of them are in advanced stage of finalizing the order. And we need to really worry about the tariff only as and when the goods are ready to dispatch, which is obviously now meant for summer of 26. And that has to happen few months or few quarters down the line. So we are not unnecessarily worried. And as I say, as long as China's tariff is higher than us, we are really well placed. And first part of the question about the time frame, we don't really have a time frame in mind, but it seems that maybe by H1 of 26, we should see some decent development in respect of IB transaction.
Very quickly, how much is US as part of your overall top line, Mr. Shah?
As of now, it is not material, but the kind of the inquiries and the kind of the orders and the discussions which is happening, that is quite interesting and exciting.
Okay, Mr. Shah, thank you for giving us your time this morning and giving us insights in terms of what we should be expecting from the company in FY26. That was the management of Symphony talking to us about the outlook of the company, channel inventory, that will stabilize by the end of this year, next summer, when the tertiary sales actually start picking up. As of now, Symphony is seeing a decline of almost 3.5%. But on that note, we're going to slip into a very short break. When we return, we'll discuss market technicals with Ankit Shetty from HDFC Securities and also discuss stop trading bets. Welcome back to Trading Hour on CNBC-TV18. As of now, markets are managing to hold on to that gain. Nifty 24,670 levels, inching towards 24,700. So keeping an eye out on that. But what's happening in the world of F&O? What are we watching out for there? What are the cues there? We have Mangalam joining in with us for that. Good morning, Mangalam.
Good morning. So, if you look at the way the markets have been progressing all through today's trading session, after a big cut that we saw on Friday, the Nifty ended below the 24,600 mark. There is a bit of a bounce back, an attempt at a bounce back and consolidation taking place from lower levels and from oversold levels as well. So both the Nifty as well as the Sensex are doing well. The broader markets tell you that the advance decline ratio has, more in the favor of advances than declines. Portfolios are feeling slightly better. And this despite the underperformance coming in from the Nifty bank. So if you look at the sectoral indices, the indices that are contributing to the way up, we have, the Nifty Auto as well as the Metals Index, which is doing well. The Nifty Bank is a slight underperformer, though it's moving off the lows and mildly into the green as we speak as well. But importantly, remember, metals and autos are fairly volatile sectors. And with that outperforming in today's trading session, the up move is also coupled with the India VIX rising. Remember, the India VIX, when the market was rising earlier, fell all the way up to 10, and thereafter we saw a sharp spike above 12. And now between the last two trading sessions, the India VIX has moved back to levels above 12, 12.26 to be very precise. So that's something we'll have to watch out for as we move ahead. With the volatility index rising and the market trying to stabilize in this range, what are the option writers playing for? 24,600 put writers. They're fairly active. Early days in the August series, FIs are 91% net short. So 24,600 put writers, fairly active in today's trading session, premium of almost 100 rupees. On the way up, 24,650 call and the 24,700 call writers, both of them fairly active as well. Premium for both of them between 130 to 150 rupees. You add that to the current spot price on the Nifty, you get a range, a beautiful range that the option writers are looking at. They are expecting support for the frontline index around that 24,500 mark, 24,500 to 24,550. But at the same time, on the way up, around 24,800 to 24,850 could be a bit of resistance, and that's what the street is playing for as a range from an option standpoint. If you want to broaden that out, then maybe look at the technical range. 24,388 with 100-day moving averages on the Nifty, and on the way up 25,075 with the 20-day moving averages. In fact, between 25,050 and 25,075 is both the 20 as well as the 50-day moving average on the Nifty. So keep an eye out on that one. Watching out for a couple of stocks. UPL, remember the stock was lower after results on Friday. A lot of shorts entered the system, but now the stock is seeing those shorts unwinding their positions, and that stock has moved higher as well. And finally, we have Delivery. Good numbers coming in. The street was surprised positively, and longs are adding on to that as the stock moves to the high point of trade in early trade today.
Delivery, indeed. Fresh long position seen there. Manglam, thank you for that. And since Manglam brought up UPL, UPL has recovered everything that it lost on Friday. It was down 6.5% on Friday. It's up 6.5% today. So it's back to square one after its results. So good going for UPL. Analysts continue to remain bullish on the stock's prospects going forward. Let's also get in Nagraj Shetty from HDFC Securities for a quick chart check here. Nagraj, do you use this bounce that you have seen from the sell-off on Friday to trim down your positions or as a sell-on rallies market? Or do you expect some further move towards the 25,000 mark and then you take a call after that? And of course, your stock recommendations for the morning.
Hi, good morning, Thomas. Market has been in a downtrend, no doubt. We have seen lower tops and bottoms on the charts over the period of time. Recently, we have seen market bounces and selling encountered at the high levels. And I'm not expecting this as a bigger reversal at this point of time. Though Nifty placed near the support of around 24,500 levels, this bounce could be an opportunity to sell on rise. At the higher level, 24,800 to 24,900 is going to be a strong resistance. I'm expecting Nifty to consolidate from the higher levels, could come down, and even could reach down to the 24,500, 400 levels in the near term. On the stock specific, I have a mixed strategy. One is from long and one is from short. Hero MotoCorp is from long. What we can observe on the chart is this stock has been in a continuous range bound action. Recently, it had made an attempt of upside breakout of the range. Currently placed again at the levels of around 4460, 4455 levels. One may look to buy at this point of time. The upside target will be around 4650, and one can place a stop loss at 4350 levels. And second one is on a short side. Granules India has been in a sharp downward correction. We have seen sharp low tops and bottoms on the charts, recently placed at the lower levels, currently trading around 449 levels. One can look to short at this point of time. The downside target would be around 430. One can place a stop loss at 460.
Okay, Nagraj, thank you for speaking with us this morning, keeping an eye out on those stocks over there as well. But on that note, we're going to slip into a very short break, and a reminder for our viewers, unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. Shifting focus to stocks that are on the move other than the ones that we spoke about. Two-wheeler names are the outperformers in today's session, led predominantly by Hero MotoCorp on the back of good auto sales. Sudarshan is here with an explainer on what is causing this up move in these two-wheeler names. Sudarshan.
So all the two-wheeler stocks are higher after reporting the sales for the month of July, and most of the companies have reported sales that were largely in line or slightly better than estimates, and two of the major outperformers are TVS Motor and Hero MotoCorp. So in today's trading session, one stock that is the higher and its top Nifty gainer is Hero MotoCorp, currently up more than 3%, and the reason is now company has reported sales higher than estimates, with both domestic and export segments reporting healthy growth. Total sales have seen an increase of 22%. Domestic sales were higher as well. It was up 19%. Exports, like all the other OEMs, have seen a growth of more than 60%. Good part for Hero MotoCorp is that it was led by scooter segment that saw a growth of 64% versus an estimate of growth in the range of 20 to 25%. Domestic segment has seen a growth, but sales were slightly below estimate, especially bike segment, where the growth was 18%, which was slightly below estimate. Now, again, festive season is coming, and Hero Moto being the market leader in the entry-level segment, and all the commentary you would have heard that rural segment is doing much better than urban segment. And one of the biggest beneficiaries would be Hero MotoCorp, considering the market leader in entry-level segment. Even company is saying that retail activity has remained stable, and with upcoming festive season, volumes are expected to rise. So that's the reason you are seeing an increase in the stock price of Hero MotoCorp.
Okay, keeping an eye out on Hero Moto, managing to hold on to around 3% of gains. But Delivery, that's the next one that's in focus. That's also buzzing in trade, and this is coming after its numbers. Mangalam is here to give us more details on this front. Mangalam?
Well, it's been a strong operational performance for Delivery this time around. Remember, the first quarter is seasonally weak for a company like Delivery, or for a business like Delivery. 5.5% revenue growth, no great shakes out there. But look at the EBITDA, it's a near 50% growth out there, 53.4% to be precise. Margins improving by 200 basis points, and as a result of that, the net profit increasing by about 67% as well. It's been driven by a couple of factors. One, on the express parcel business, the volumes have grown by 14%, revenues grown by 10%. Margins, while they've compressed a little bit to 16.3%, the management is confident that in e-commerce, the industry can continue to grow at 15%, with them holding on, if not growing their market share, especially after the e-com express consolidation. And they believe margins can be between 17 to 18% by the end of this year. So there is improvement which is likely, and the second half is typically stronger for this vertical. Part truckload, which is where a lot of the operational efficiencies are coming in, 3% margins have turned into 10% as the spot-on integration has taken place, and the revenues have grown by 17% with a 15% volume growth. Here too, the company believes that over 20% growth is fairly sustainable, with 20% ROCE along with improvement in margins all the way between 16 to 18% over the next couple of years. So those two factors doing extremely well for Delivery. Going forward, they believe that capex as a proportion of sales will come down as well, and they do believe that their assets will be better utilized, net working capital days will improve as well. So on all parameters, we will see an improvement, which is why after seeing a rally already in the stock, it continues to do well. Just two things I'll keep an eye out on Delivery. One is the fact that as we move higher on the stock, there are a bunch of institutional investors which at every level may at some point exit or look to exit. So that may cause some of the liquidity challenges for Delivery. And the second thing that we'll be looking at is how the company copes with one of its largest clients, Meesho, coming out and looking to drive in-house logistics.
Indeed, Mangalam, thank you for that update there. 453 on Delivery, closing in on its IPO price of 487. Take a short break, but just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is CNBC-TV18's all-new app, which gets you breaking news, in-depth articles, and financial world updates at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. We take a short break. We'll be back on the other side.
Thanks for staying tuned to Trading Hour on CNBC-TV18. Now, the global tech firm Cognizant recently reported for numbers for their June quarter. Posting strong numbers, CNBC-TV18's Reema Tendulkar actually spoke with Ravi Kumar, who's the as well as Jatin Dalal, the management of the company, and began by asking on the macro environment and AI. Listen in.
The macro has not changed as much. It's been similar to what it was before. And I've always spoken about two swim lanes, a slow market and a fast market. In a slow market, we see more productivity-led opportunities with AI. AI is a double-engine transformation. So you can actually power it with productivity. And what I mean by productivity is doing more for less, using AI and making your software development cycles more productive. So using that pivot, we have been able to win a lot of large deals. This quarter, we won 6 of them. Last year, we won 29 of them. The year before, we did 17. So that template is working well. Some clients use the savings to underwrite that money for innovation. Now, what's also happened this quarter, specifically this quarter, is customers have started to create more downstream opportunities on the innovation side of AI. I call it Vector 2 and Vector 3 in my framework. Vector 1 being productivity, Vector 2 and Vector 3 being innovation-led, where customers use AI for building new products, new services, for improving experience, and for generating growth opportunities for the enterprise. So last quarter, we said 1,400 projects of AI are there. This quarter, there are 2,500 of them. So they have started to trigger off. I mean, there is a good flow of agentic work in the Vector 2 and Vector 3, as I call it. So I would say some sectors have started to open up, like financial services. Financial services is not under the burden of the macro in a way. So it's kind of unlocking a little bit of that. So overall, the macro has not changed, but we are executing well. We've had good traction on productivity-led AI deals. Now we are starting to see initial set of innovation-led deals, which I think is new spend cycles and new labor pools which we can attach ourselves to. Now, coming to your second question on AI, when we gave this metric of how much code is written by machines, 2 quarters ago we said 20%, and progressively, in fact, I spoke to you then. Progressively, it has gone to 30%. This is a hockey stick. It will continue to improve, continue to grow. What we have to do is we have to figure out a way to get our developer community, get our software development cycles, embrace it much more and more. As you embrace it more technology will be consumed. And that is the the elasticity of technology. In fact, in the world of agentic, where you're going to have digital labor around you, there's a multiplier to the human labor. You're actually going to see more software consumption. So that's the premise on which I believe that as more code is written by machines, it's going to serve us better. I'm optimistic that we're going to have more total addressable spend because of the unlock of new labor pools, unlock of new spend pools. But we need diversity of talent to capture those opportunities, and I'm optimistic that the total addressable spend and the opportunity we have to service our clients is going to be much more.
Jatin, Ravi spoke about digital labor. With now 30% of code being written by machines, and that number is only going up like a hockey stick. Would we require fewer people? We already had TCS laying off 12,000. NASSCOM is talking about the IT industry being at a turning point and the possibility of more layoffs in the industry. What is your own view? Will we need fewer engineers even as the top line continues to grow? And do you think this year Cognizant will be in a position to give wage hikes because you've already deferred it?
Let me start by saying that we have added 7,500 engineers this quarter on a sequential basis. We are at a point where we have been able to modestly increase our revenue guidance for the year. We are in a unique time in the history of industry where we are seeing the industry transforming with a very powerful technology like AI. And what we can do as management is to try and strive and stay ahead of the curve and see what's coming and prepare for it. From our perspective, we continue to hire from the market. We continue to hire from the colleges. We have spoken about 15 to 20,000 recent college graduates. We will bring into Cognizant this year. We are moving as planned as at the end of Q2. Macro is where it was before. It is still uncertain. There are news every day which could sort of change the trajectory of rest of the year. So we have not taken a decision on merit cycles for 2025. We will do it in a course of next few weeks. Our endeavor is to cover a vast majority of our workforce in the second half of this year, and that's our intention.
The management of Cognizant there. Take a short break here on Trading Hour, but just before we do that, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. You can tune in to CNBC TV18 Prime at noon for the Global Reset, 1 p.m. for the Big C, and Global Lens at 8:30 this evening.
Welcome back to Trading Hour on CNBC TV18. As of now, the markets are managing to hold on to those gains. Nifty holding on to 24,650 levels. The only one that's trading in the red is Nifty Bank. That's also flip-flopping between the red and the green. We've seen recovery coming in also for Nifty IT, so we'll watch out for where Nifty Bank as well as IT is headed in the second half of the trading session as well. But with that, we're going to wind down this edition of Trading Hour on CNBC TV18. Thank you so much for tuning in. Up next, your halftime report.
Market moves to trade near day's high. The Sensex and Nifty gain 0.5% each, led by metals and auto stocks. The mid-caps gain in line.
Hero MotoCorp misses expectations on bike sales, but sale of scooters sees an over 60% surge, saving the day. The two-wheeler major sees sales picking up further with the festive season round the bend.
ITC sees strong volume growth in cigarettes and in-line growth in FMCG, even as margins come under pressure. On the bright side, the company is seeing early signs of demand recovery in urban consumption.
Indian energy imports from the US are likely to increase 1.5 times in FY26, sources tell CNBC-TV18. This even as not buying Russian oil can cause prices to spike and can weigh against any big shift. Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Manglam Malu this afternoon. Well, it's turning out to be a day where the markets are definitely in the green at this point in time. We've seen the Bank Nifty recover from the day's low as well. So there's some amount of buying which is taking place at lower levels for the Bank Nifty. Around an hour back, the Bank Nifty was down around 0.3%. The big cues to watch out for would be the RBI policy as well as earnings, which would be in focus. And in terms of stock-specific focus this week, we do have UPL, Hero MotoCorp, Delivery, Narayana, a lot of these stocks which are reacting to their numbers. Separately, a lot of results today as well, Manglam. We have the likes of Aurobindo, Kansai, Nerolac, OneSource, Specialty, to name a few. So there will be a lot of action in the broader markets which will continue.
There will be a lot of action in the broader markets that continues, Ekta. In fact, right now as we speak, we have around 1,500 stocks which are advancing. So the broader market tells you that they're in relatively better health than what, the Nifty Bank would tell you. But as we speak, the day definitely belongs to two sectors. On the one hand, it's autos, Hero MotoCorp you spoke about, but look at Eicher Motors. That's up around 2.5% as well as we speak. The auto index comes up for you. That's actually doing the heavy lifting in today's trading session in absence of the Nifty Bank's performance. So auto index has moved higher. And the other one is the metals pack as well. So Tata Steel up around 2.5%. Hindalco up nearly 2%. We are seeing some traction in JSW Steel as well. So the metals index too has moved higher. So these two sectors doing extremely well. On the way down though, a couple of these capex heavy or capital goods sort of names, specifically the ones which I've been reacting to numbers. ABB India, for instance, the management not particularly happy with the way things may look in the second half of this year. Post its con call, the stock down around 6.5%, and giving it company on the way down, perhaps rubbing off of the weakness that we're seeing in ABB India is Honeywell. That's the one that should come up for you as well. So 4% lower on Honeywell. The one stock that stands down in an otherwise strong market for the consumer names is Godrej Consumer. Hasn't yet reported the date on which the company reports its first quarter numbers, though we have a quarterly update coming in, a fairly strong performance. So after outperformance that we saw all of last week in the FMCG pack and Godrej Consumer as well, post HUL's numbers, that stock is seeing some bit of weakness. But let's talk about ABB. We spoke about that one. It's reported a weak set in the second quarter CY25 numbers. The margins have contracted, order inflow under pressure. Vamakshi joins in with more details. Vamakshi.
Well, not a great set of numbers for ABB India. When you look at the revenue, that saw an uptick of almost 12% on a year-on-year basis. This is more or less in line with what the street was anticipating. However, the operational performance was very weak. The cost of goods sold surged by almost 21%, which is growing at a slightly faster pace as compared to the revenues. This has led to a decline in the gross margins of almost 460 basis points. Apart from that, we saw a rise of almost 25% in the other expenses, which again put pressure on the EBITDA margins. They were down almost 600 basis points, and the net profit saw a decline of almost 21%. So operationally, it was a weak quarter for ABB. Let's look at how each segment performed. The revenue growth was largely driven by the robotics and discrete automation business. That saw an uptick of almost 180% on a year-on-year basis. Other than that, electrification saw good growth of almost 23%. It came in slightly above what the street was expecting, but the motions business was rather flat, and process automation actually dipped by 22%. The ordering activity this time around was weak. Order inflow dipped by almost 12%, lower than what the street was expecting. The order book rose by 6% on a year-on-year basis, standing at 10,064 crores. Now, in addition to this, the company also said that the board has approved appointment of a registered valuer to carry out valuation of the robotics division. They've also given a nod to incorporate a wholly owned subsidiary under which the robotics division will be housed. However, no decision has been taken yet on the divestment of the company to either the parent or any third party. Overall, it's a double whammy for ABB, weak order inflow, weak operational performance.
Okay, all right, Vamakshi. Yes, absolutely. From the con call itself, the company is saying that large orders have been muted and they are hopeful of regaining a trajectory in the second half once the large orders are back on track. But Vamakshi, you're looking at MCX. That stock is doing well on the back of its Q1 numbers. Tell us more.
Well, on a quarter-on-quarter basis, MCX has seen a good improvement. However, this improvement is below what the street was expecting. Keep in mind that the revenue saw an uptick of almost 28% quarter-on-quarter. The EBITDA margins have expanded by almost 1,000 basis points, and this is largely being driven by a fall in in employee expenses, IT expenses, as well as other expenses. Resultantly, the EBITDA for the company has expanded by 51% sequentially. Keep in mind that the EBITDA margin this time around is at a multi-quarter high for MCX, but again, it is much below what the street was anticipating. The net profit, however, came more or less in line with the street's expectations, and that is because there was a 12% sequential jump in the other income. The operational metrics for MCX look quite healthy. The average daily turnover in the F&O segment saw an uptick of almost 25%. The premium turnover was also up quite healthy, up almost 30% quarter-on-quarter. Now, in addition to this, the board has approved stock split in the ratio 1:5, so that is something that we'll be watching out for. But overall, MCX does look good on a quarter-on-quarter basis, but is below what the street was anticipating.
All right, Vamakshi, thanks a lot for that. Let's move on to the two-wheeler space, which is stealing the spotlight. The July auto sales have come in. Hero MotoCorp, TVS and Royal Enfield, all of them saw growth of between 19 to 25% year-on-year. So Darshan joins in to tell us how much of this is on account of a favorable base, how much of this is on account of, business actually growing for them. So Darshan, my consumer companies are saying that rural things are improving, urban likely to improve. Does that tie in with what your auto guys are saying too?
It's same for auto guys as well, because ahead of the festive season, all the players are saying that they are expecting an improvement in the volume. But first, talking about the July auto sales. Now, except Bajaj Auto, all the companies have reported or basically seen a growth in the domestic segment. Bajaj Auto has reported a decline of 13%, but except Bajaj Auto, all the companies have seen a growth in the range of 19 to 25% as far as domestic segment is concerned. But for the export segment, all the players have reported a growth. Remember, for Bajaj and TVS, contribution of domestic and export is almost the same, around 40 to 45%. As far as Royal Enfield is concerned, export segment contributes just 13% to total sales. So even if Eicher is saying that they have reported 95% in growth in export segment, but it's very minimal. It's almost the same for Hero MotoCorp. Now, so two of the major outperformers in July, the month of July, are TVS Motor and Hero MotoCorp. Why? It was an all-round beat by TVS Motor. You talk about domestic, you talk about exports, everywhere they have done very well. Now for Hero, domestic segment has done well. And especially in the domestic segment, one segment that has been doing well is the scooter segment, where it has seen a growth of 64% versus expectation of in the range of 20 to 25%. Motorcycle segment too has seen a growth, but that growth was below estimate. What about the outlook? Now, a festive season is coming. One segment that is expected to do well is the entry-level segment. And two of the biggest players in this segment are TVS Motor and Hero MotoCorp. Even in the commentary also, Hero MotoCorp is saying that retail demand has been stable and expects volumes to rise as the festive season approaches. So that's the reason you are seeing a big move in all these names.
Okay, all right, Sudarshan, thanks very much for that. So yes, it's definitely the two-wheelers which are really riding away in today's trading session. As you can see, Bajaj Auto, TVS Motors, Hero MotoCorp, Eicher Motors, all of these stocks doing well in today's trade. We'll take a short break, but we'll do that and give you a reminder as well for our viewers. Unlock a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interaction with our journalists along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits.
Welcome back. You're watching us here on Halftime Report. Just watch out for a couple of stocks. Aditya Birla Capital, that's the one that's actually surging right now as we speak. It's moved to the high point of trade, gain of almost 5%. JSW Energy as well is moving higher. So broader markets are doing fairly well. And then you have the quick service restaurant space too. Jubilant Foodworks has spiked. It's moved to the high point. Remember, the company has given its first quarter update. It's over 12% same-store sales growth coming in for them this time around. So we'll watch out for that. But meanwhile, we do have another stock on our radar. Ekta joins in for Narayana Health. Ekta, we had the management join us today. What is your takeaway from that? This is the Insight Edge segment.
Yes, absolutely. So Narayana Health, overall it was a good, okay set of numbers. It wasn't something too worrisome in terms of the numbers. So the revenue was up around 15.4% on a year-on-year basis. And it was the highest ever quarterly revenue by the company this quarter. The margins were 23.9%. So that came off on a year-on-year as well as on a Q-on-Q basis. And that was because of the integrated care segment, which I'll come to in just a bit. But the street was anticipating maybe, 24% margins this quarter. So it didn't deviate too much from that. In terms of profit, that too was down around 2.3% year-on-year. Now, the India revenue was up in single digits. It was up around 7.8% year-on-year. Cayman did very well. So they opened a second hospital in Cayman Islands, and that revenue is shot up 48.4% on a year-on-year basis. The integrated health business, which had a cash burn of around 65 crores in the previous quarter, where they are looking at clinics, etc., that generated a revenue of around 14.4 crores this quarter. It was up around 79.4% year-on-year. Now, we did speak to the management. A couple of key insights which they had is that the dilution in margin is due to the investment in the integrated care segment, and they're expecting this integrated care segment to be close to break-even in the next 2 to 3 years. They've set around 450 crores aside for the integrated care business in terms of investments. And separately, they took around a low single-digit price hike in January. In fact, let's listen in to what Sandhya J, the group CFO, had to tell us earlier this morning.
Now, the reason we are seeing this dilution in the margin is because we are investing in our integrated care business. So in all, from an India point of view, we have set aside about 450 crores for the integrated care business, 400 to 450 crores. Now, it will take 2 to 3 years time for it to be in a state where it is coming to break even, not because individual clinics are taking that much time, but because that we will keep expanding also and investing behind this vertical.
All right, another stock, a very interesting move on that is UPL. Remember, post numbers on Friday, the stock saw a sharp fall, it was down almost 6%, and now it's recovered almost all of his losses and actually moved into the green from post numbers on Friday as well. What is causing this whipsaw on that stock over the last 2 trading sessions? Ria joins in to tell us both the bull and the bear case on the stock. Ria.
Well, that's right, Manglam. As you said, on Friday, the stock had ended 6% lower after reporting its Q1 FY26 numbers. Now, remember, the impairment cost had gone up to 192 crores in this quarter versus 87 crores in Q1 of FY25. And this was largely due to one client from Brazil where the company had recorded a non-cash loss of rupees 112 crores. The volume this time around has declined by around 1%, but the prices increased by 1%. And the revenue growth that we've seen in this quarter has been led by a forex gain of 2%. Now, today, the stock has reversed its trajectory completely, going up by around 6%, over 6% in fact. And we also have some brokerage notes coming in. First up, Kotak Institutional Equities remains quite bearish on the stock. They have a sell call with a target price of rupees 520. What they've said is that Q1 surprised positively on the gross margin front amid price increases in a few areas, input cost corrections, as well as increased plant utilizations. But they believe that these benefits may continue for some time ahead, although their long-term sustainability is uncertain due to demand softness and increased competition as well. In fact, they've raised their EBITDA targets for FY26 by around 12%, but for FY27 and 28, they've only increased this by a modest 1 to 4% after these numbers have come in. On the flip side, HSBC on UPL remains quite bullish. They do have a buy call on the stock with a target price of rupees 775. They've said that Q1 FY26 was muted given challenging conditions in some markets. But they believe that with a recovery and deleveraging underway, UPL is likely to enter into a virtuous cycle and create value in the process.
Okay, all right, Ria, thanks very much for that. So that's on UPL. Remember that the stock has also run up very significantly this year. It's up around 40% on a year-to-date basis, and adding a little more weight today, up around 6% currently for UPL. We'll take a short break, but up next, Manish Hathiramani from Deen Dayal Investments will join in with some trading calls. Stay tuned. Welcome back. Well, for the market, stable. In fact, the mid-cap index is picking up now, so up around 0.7% currently for the mid-cap index. And we have the advanced decline ratio, which is holding positively, so around 2,200 stocks advancing to around 1,923 stocks declining on the Bombay Stock Exchange. Some news coming in on your screen with regards to Adani and a Bloomberg report where the Adani Group has said they are not exploring any form of collaboration with BYD for battery manufacturing in India. So just something to keep on your radar. Well, we now have Vivek who joins in to take us through all the stocks that are moving around in trade. Vivek, over to you. It's a busy day when it comes to earnings.
Absolutely right. Thank you so much for that. Like you mentioned, the advanced decline ratio, especially in the last hour, has gone towards the positive territory. Quite a few stocks on the radar, mainly, like you mentioned, on the back of results reactions. First on the list has to be MCX, almost 6% higher. Very strong set of results. Along with that, the management talking about newer segments coming in, like weekly options for some of the new segments. And along with that, the street also is waiting for other updates from management once the call is underway. The other stock on the radar is Tata Energy. Now, this particular stock, the power segment revenue growth very, very strong, almost 19% higher for this particular name. UPL, remember on Friday, the stock saw a very steep knock post the results, but post that the management has clarified that there is no change as far as the guidance is concerned, both for EBITDA as well as top line. Along with that, the management has hinted at value unlocking maybe via demerger, and also remember an IPO from the group may be underway as well. Premier Explosive, one stock from the broader end of the markets. That particular stock recently won an order win. They went ahead and gave that particular news to the exchanges. The stock spiked after that, has cooled off a little bit. And GMDC, as far as this particular name is concerned, results results were declared a few weeks ago, post which no real updates as far as rare earth mining was concerned. But today, some more news flow on that particular development, and along with that, this particular stock seen a very sharp spike, highest volume gainer as far as NSE 500 is concerned. On the other hand, ABB India muted Q1, muted order inflow guidance, stock lower by almost 4%, dragging along with it quite a few of the capital goods names. PSP projects, under pressure for the last couple of trading sessions, a large block deal, that particular stock low by 12% today. Honeywell Automation came out with a set of results and slightly muted show compared to what the street was anticipating, 4% lower there. And Alivis Diagnostics, this particular name, again, amongst the top laggards as far as NSE 500 was concerned today.
All right, Vivek, thanks a lot for that. Alivis Life, yes, while Glenmark Life. Granules India is another stock which is spiking right now as we speak. And look at AB Fashion and Retail. That too has recovered almost 3% from the lows, currently in green territory and at the high point of trade as well. All of this while the Nifty holds on to that 100-point lead that we're seeing in today's trading session so far. Good time to get in Manish Hathiramani of Deen Dayal Investments. Manish, what do you think of the range? The Nifty has been between this 24,550 to 24,850 sort of range, with the street believing that maybe the broader range could be 24,388 and 25,075 thereabouts from a technical standpoint. You've been tracking the Nifty, these ranges and these levels very closely. Where do you see the next move comes from?
Good afternoon, Ekta, Mangalam, and to all our viewers. Thank you so much for having me on the show. Well, Mangalam, when I was on the show the last time, I had discussed that if we break the levels of 25,000 on closing basis, we should hit 24,650. That has happened. However, I would not want to go short immediately. I will be very careful at the current juncture, as I feel 24,500 is a very strong support. If I have to be a little more careful, I would want to pay attention on Friday's low point, which was 24,535 to be precise. A break of that level on a closing basis could lead this index to drop all the way to 24,300 and then 23,900. The upside is currently capped at 25,100.
Okay, what about stocks, Manish? Hi, welcome to the show.
Thank you, Ekta. Keeping this strong support of 24,500 in mind, I'm working with two buy calls. The first one is on Reliance Industries for a target of 1445. Stop loss of 1385. The stock opened with a gap down on 31st, but we failed to break the low, which was a positive sign. The next was crossing of a resistance of 1400, which happened on the same day. Volumes are also encouraging, which should allow the stock to move higher. The second buy call is on Trend, which is for a target of 5530. Stop loss of 5000. This stock was trading sideways between 4950 and 5100. It eventually broke out of this range on Friday. The positive trend is also accompanied with good volumes.
All right. Thank you so much for that. Trend up 4% on Friday, up 2% as well right now. And as we speak, has continued to move higher. We'll watch out for that one. Manish, thank you for your views. Sudarshan joins in. Sudarshan, the FNO setup at midday, what does it look like right now?
So as far as market is concerned, it's been a steady day of trade that Nifty is holding on to levels around 24,700. Even midcap is trading with a healthy gains, and that's the reason market breadth is still in favor of advances. Even there is not much any indication for volatility index up around 1 to 2% and currently above the level of 12. Now, if you look at the options data on the put side, two major active options are 24,600 and 24,500. So it tells you that on the downside, support for Nifty at this point is around 24,500. And as far as call options are concerned, 24,650 and 24,700 call options are very healthy. So option writers working with the levels support of 24,500. Resistance is currently at 24,800. If you talk about the technical levels, 20-day moving average for Nifty is 25,075, so that would act as a resistance, and 100 DMA is 24,400. That would be the support for Nifty. Two stocks that I have taken that will be in focus and that have been in the focus for the last two sessions. First one is TVS Motor. After a strong set of sales for the month of July, stock is seeing fresh longs, and on the short side, fresh shorts are being seen in ABB. Company had reported Q1 earnings, that earnings were weak, and with the commentary that's coming out from the earnings call is looking weak, and that's the reason these two stocks are very active in today's trade.
Okay, all right, Sudarshan. Thanks very much for bringing us that F&O update. Well, for the markets, as Sudarshan mentioned, it's a stable day of trade. In fact, the midcap index seems to be picking up pace as we speak. So at the high point of the day, closing in on a 1% gain. Maybe the small caps should come up for you as well to get a sense in terms of how the small caps and the broader end really of the market is doing, up around 0.76% currently for the small caps as well. We'll take a short break. On the other side, Manisha Gupta will join in. She has with her Chirag Sheth of Metals Focus. Stay tuned for our commodities segment.
Joining us now is Chirag Sheth, he's Principal Consultant, South Asia Metal Focus. Chirag, hi, thank you so much for joining in. First of all, your sense on the gold price is a very smart rebound, 2% up on Friday, and we're looking at more gains continuing in the day today, all thanks to the US jobs data, which has been lowered for the month of July. And May and June also have been revised on the lower side. Do you think with the probability increasing of a rate cut from Fed for the month of September, and that's exactly where the gold seems to be taking cues from, how are you reading it all?
Hi, Manisha. Good afternoon. So essentially, gold was waiting for triggers, given that it had faced a lot of headwinds over the last, month or so. We saw, very good correction in gold prices. And then probably jobs data has provided that, support to gold. I think, probably you are now seeing the first signs of weakness in the U.S. economy purely because of the impact of the tariffs. I think U.S. economy over the last 4 or 5 months have been able to weather the storm because of the spendings on AI and various other things. I think now you are actually seeing a bit of impact on the economy. There is also now fear of inflationary concerns, and I think that provides an impetus to any actually discussion on rate cut, which Fed has avoided, as of now. So I think market is now trying to price in 2 rate cuts, and I think that is something which is providing fillip to gold prices.
Are we finally, Chirag, heading back towards that 3,500 marks? I mean, I know you've been holding on to that 4,000 of a forecast going forward. Is this what gives us enough pressure for the gold prices to gain much beyond?
Yeah, I think probably these are the first signs, hopefully, of continued rally in the coming months. And I think we, as you said, we still believe that probably 3,800 by end of this year or early first quarter, and then 4,000 next year is very much a possibility for gold prices. I think this is probably a trigger that the market was waiting for.
But not the trigger that the Indian consumers perhaps were waiting for, especially as we get into the festival season. How are you looking at the numbers? I was talking to World Gold Council, and they believe instead of a 700 to 800 imports, this year could see 600 to 700 tons of imports. How do you read those numbers?
Look, there is a jewelry show which is going on currently in Mumbai, and I think the mood was pretty much upbeat till yesterday. In fact, you spoke with manufacturers, they would tell you that the retailers have started stocking. Now I think there is a fear of cancellations, because usually what happens is that orders get placed at the IIJS, and then there are finalization of purchases happens in a week or 2 weeks after the IIJS. And now if the gold prices continue to rise, then the retailers will once again start cutting back on inventory buildup. So I think we are now looking at probably that scenario. And I would not be surprised if we would still do probably about 700 tons of import, because our investment demand has been pretty robust. I think jewelry demand is something which is getting impacted currently.
Well, the rupee depreciation also seems to be taking the gold prices in the Indian markets quite on the higher side there. But Chirag, we've seen more hallmark centers being added. This is what the latest BIS report shows us right ahead of the festive season. Still not a very strong number with the kind of district distribution in sense of hallmarking centers that we've seen.
But I think, look, to be very honest, if you look at the hallmarking law, it clearly states that the hallmarking has to happen in the first point of sale. So if you actually look at Indian manufacturing setup, I think there are 11 cities as per Metals Focus where majority of our manufacturing happens. Usually 80 to 85% of manufacturing happens in these cities. So still a large part of jewelry which is manufactured in India is getting hallmarks. Yes, there is still need of hallmarking to go into the tier 3 and the tier 4 towns, but I think we are on the right direction, to be very honest.
Chirag, you talked about investing, and that demand really seems to be picking up. Within this as well, would you say it's more about 24 carat than any other caratages that investors are looking at?
So, usually most of the bars and coins which are sold in India predominantly are 995, 39 bars. There is also a growing interest of 22 carat, bars and coins. But mostly we are an out-and-out 995 and a 39 investment market.
Chirag, coming on to the silver prices also, because after that sharp decline that we saw in the last couple of weeks, after silver hit 39, we seem to be consolidating, even slightly back up again. A lot of questions being asked on whether silver can see further profit taking from here. If yes, what would you see as a range, both sides?
So I think in the near term, silver did get, silver prices did get impact because of 2 reasons. One, we saw a bit of weakness in the base metals prices. So that actually pushed silver, down. But also this whole talk about, the big beautiful bill, which reduces tax ops on green energy, clean energy, EVs. Obviously, that to some extent, because silver is used in photovoltaic, in EV, it did impact that. But we don't see any major impact on the demand supply as of now. And that's why we continue to remain bullish on silver. We've been saying this for many years now, that $42 to $45 is somewhere we see silver going forward. And any opportunity that one should get, one should be invested in silver.
All right. Chirag, we also are hearing about hallmarking coming in for silver and bullion. How far is that in sense of progress or development?
Look, this has been coming, Manisha, for last 4 or 5 years, hasn't it? And I think, look, it's a step in the right direction, given the level of, I would not say undercarriages, but the lack of awareness of purities in silver. You've got silverware, which is 30% pure, 50% pure, 60% pure to 92%. You really don't know. And I think getting hallmarking would provide a lot of clarity to the buyers.
All right, we take that point. Thank you so much, Chirag, for joining in. Manisha, it's poetic that the Nifty has moved to the high point of trade, 24,713, and it's the metals which are doing well right now. The metals index comes up for you, 2.5% higher on that index. And that's led by a sharp spike that we've seen in Tata Steel, which is now up almost 4.5%. And pull up, something like a JSW Steel as well. So it's just been the last 15 minutes or so where all these metal names have moved higher and currently taking the index higher as well. The Nifty at the high point. Take a short break, come back on the other side. We get back with the management of Jupiter Lifeline Hospitals on their first quarter earnings. Stay with us.
Welcome back. Well, for the markets, it's okay at this point in time, actually doing well. So we have the Nifty, which is up around 137 odd points. We have the Sensex, which is zooming ahead with a gain of around 0.5%. And the Bank Nifty, which is moved into the green as well. So up around 50 odd points currently for the Bank Nifty. The midcap index, like we mentioned, is outperforming at this point, 500 points higher currently for the mid-cap index. But let's talk about one specific stock. Jupiter Lifeline is in focus. That hospital company, which has hospitals in Thane, Pune as well as Indore, has reported what was a steady state of Q1 numbers. The hospital is planning to double its bed count to 2,500. And however, separately, the occupancy has dipped a bit on a year-on-year basis. We have with us Dr. Ankit Thakkar, who is the CEO of Jupiter Lifeline Hospitals, joining in now. Ankit, hi, welcome to the show. Well, it's a good growth this quarter, revenue growth of around 20-odd%. But can you break up what led to this 20% growth, considering that your occupancies were a little flattish this time?
Hi, Ekta. So, the occupancies in this quarter on an absolute basis are slightly higher than last year because we added around 100 census beds in the previous financial year. Because of the expanded base, bigger denominator, on an relative terms, the occupancy looks lower. But on an absolute terms, the occupancy this quarter is about 5-odd% higher than what it was for the same period last year. So that has been one contributor for the growth in revenue. The other contributor for the growth in revenue is continual expansion and case mix improvement in our Indore hospital, along with the regular inflation-linked pricing, which also plays some role.
So just wanted to understand that when you talk about this mix, which has improved, can you tell us about the complex cases and the percentage of the mix which now comprises of complex and say less complex cases?
So qualitatively, the share of critical care, both medical and surgical, has gone up. The share of oncology and oncosurgeries have gone up. Hematology has gone up. So qualitatively, we are doing more of tertiary quaternary work in Indore than what we were doing in the previous years.
Right. If you could give us a sense on what was the same store or same hospital growth and the occupancy increase and the improvement that we've seen in your newer hospitals. Going forward, what would that do to your operating leverage from here on? So, maybe a growth target for the same mature hospitals and a further delta coming in from the hospitals that are now ramping up?
Right. So the Thane hospital, which is fully mature, like you said, does not have too much of a occupancy growth potential in its current shape. Pune and Indore both have significant runway for occupancy improvement. Pune is around 60-odd%. It can go 70+. Indore should be around the halfway mark. It has a significant growth opportunity ahead of itself. So qualitatively, both Pune and Indore can contribute significantly in terms of occupancy.
And what does that do to your margins? What can we look at by the end of this year with case mix improving, with occupancies improving, and having some inflation-linked price hikes as well?
Right. So I have said that mature hospitals should deliver somewhere in the zip code of 25% margins, and the growing hospitals will over time catch up to that number. So nothing much changes in our thought process on the margin front.
Okay. All right. You have mentioned that, you've taken on additional debt and hence your finance costs have risen, depreciation because you have your expansion which has come on stream. So what is your profit guidance for the coming quarters and for, say, FY26 as a whole?
So I don't have a number guidance, but qualitatively, as I said, the EBITDA margins hopefully should be preserved over the next 3 quarters as well. However, the gap between EBITDA and PBT is expected to be wider this year because, like you pointed out, the depreciation from all the capex last year is kicking in this year. and some finance-related costs are also higher this year. So while the EBITDA we hope should be preserved, the PBT and PAT should be a little lower.
Okay. So when you say lower, how much of a decline should the street expect in terms of the profit?
In the
Up to
first
5
quarter, we have about 1.5% lower than last year, same period. So I think it should probably track that way.
Okay, all right. So maybe up to, say, a 3 to 4% decline in profit is a reasonable assumption?
I have not done the math, but whatever, however you extrapolate the first quarter into the year.
All right. Just coming to, the fact that you've taken on additional debt, around 350 odd crores. What's the plan in terms of strategically expanding in the western part of the country? Because you have mentioned that you all are looking to do that. Any inorganic plans that we can expect from you?
So the 3 new hospitals have been announced, Dombivli, Pune and Mira. Those 3 we should be able to complete with internal accruals and reserves. This debt is just to kind of build our coffers that in case another opportunity comes up so that we could, also launch a 7th hospital, then we should be ready. We are open to inorganic opportunities if something sensible does present itself. However, there is nothing currently in the works. We are discussing for a few greenfield opportunities as well. The moment I have something to announce, I'll definitely talk about it.
All right. And finally, with all these 3 coming in, assuming that there is no immediate inorganic and announcement that comes by, what is the kind of growth that you anticipate over the next, say, 4 to 5 years with your current capacity and the capabilities that you've announced? Is there any more that you're looking to announce beyond these 3?
Yes, so with these 3, we naturally become a little over 2x in the next 4 to 5 years in terms of capacity, and then obviously that should translate into numbers. But yes, the intent is to also do one more. When, where, how, in what shape, I don't know today. But there is an intent and desire to maybe do one more.
All right, take that point. Thank you so much for joining in and giving us the outlook on your business for this year. Wish you good luck with all the expansions and the mix that you speak about as well. With that, we'll take a short break. But as we do that, remember to stay tuned to the all-new CNBC TV18 Prime, which brings you insights from policymakers, business leaders, economists, shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C, and Global Lens that comes in at 8:30 p.m. on weekdays and weeknights.
Welcome back. Well, for the markets, we have a little bit of gains coming in for the mid-cap index, but just watch out for this particular stock, Alivus Life, which is down around 11%, and that's the erstwhile Glenmark Life. That's basically the API business that Glenmark had and then sold it to Nirma. So that stock is down around 11% reacting to its numbers, not that much in term, or rather 3.5% reacting to its numbers. But nonetheless, that stock should be in focus. But we also have Aurobindo, which is releasing its numbers today. So it'll be interesting to watch what Aurobindo comes out with. That stock should come up for you, just about holding in the green ahead of that. But Marico, the other one that we can watch out for, Manglam, what can we expect?
The stock is at a 52-week high. We have the second quarter update, the first quarter update that has come by as well, and it's strong. So Marico is among the better placed FMCG companies when it comes to growth, at least over the last few quarters. And the stock price reflects that, trading at around 46 times FY27 earnings. Street expects good numbers. The only thing that we'll have to watch out for Marico, most importantly, will be the margins and the commentary on that, because over the last 1 year or so, there's been a very, very sharp increase in their key input, which is copra. So consolidated revenue growth seen in low 20s, underlying volume growth in India has been at a multi-quarter high. Gross margins under incremental pressure, expected to ease in the second half as per the company. And they do expect modest operating growth after very strong growth in their revenue. Value-added hair oil, that has grown in double digits, so that's a positive. And international business also delivered high teens constant currency growth. Put all these things together, that was from the update. The analysts expect a 22% growth in the company's top line. 3270 crores on a consolidated basis is what the street is working with this time. But on a 22% growth in the revenue, the EBITDA grows just 6%, which implies that 664 crores is what the street is working with versus 626 crores. And a margin compression of nearly 300 basis points from 23.5% goes down to 20.3%. And despite a 22% revenue growth, because the EBITDA grows at just 6%, the net profit too grows at 4.5%. Shy of 500 crores is what the street is working with. Volumes growing between 8 to 9%, as the company said. Multi-quarter high would definitely be the highest in the FMCG industry, as we've been seeing with Marico. What to watch out for? One, outlook on commodity inflation, like I said, would be extremely crucial. Margins, and the second part would be the growth businesses. Remember, the company has a lot of digital businesses, food brands, and a lot of the investments that they've made in a couple of these D2C companies. So how that continues to grow is something we'll be watching out for very closely.
Okay, all right, Manglam, thanks very much for that. So that's on Marico, just about holding with a little bit of a positive bias, but at a fresh 52-week high. Just watch out for the broader markets, because that seems to be where the action is this afternoon, up around 1% currently for the mid-cap index. It's a wrap on Halftime Report. Stay tuned. Business Lunch will take all the action forward. Thanks for watching.
The markets are surged to the highest point of the day. The Sensex and the Nifty gain 0.5% each, led by metals and auto stocks. Midcaps gain in line with the benchmarks. Hero MotoCorp misses expectations on bike sales, but the sales of scooters sees a 60% surge overall, saving the day for the two-wheeler company. It also said that sales are picking up further with the festive season around the corner. ITC sees strong volume growth in cigarettes and in-line growth in FMCG, even as margins come under pressure. On the bright side, the company is seeing early signs of a demand recovery in urban consumption. Indian energy imports from the US are likely to increase 1.5 times in FY26, sources have told CNBC-TV18. This even as not buying Russian oil can cause prices to spike and can weigh against any big shift. Good afternoon. You're watching us here on Business Lunch. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. I am Hormas Patakia, and it's some respite that the bulls are seeing on the screen today after the sell-off that we saw across Thursday and Friday. And the index has now crossed the mark of 24,700 at the highest point of the day is where it stands. Remember, the Nifty is coming on the back of 5 straight weeks of losses, and this is the longest losing streak that the index has had on a weekly basis since the last 2 years. And so we're seeing a bit of a rebound from lower levels. We also broke below last week's low on a closing basis on Friday, but we have seen a smart recovery from those levels despite that initial dip in the first 15 to 20 minutes of the trading session. You pull up the contributors and that will give you an idea of what is contributing to this move, because it is not the Nifty Bank that is contributing to it. The Nifty Bank at one point had almost slipped into the red, and there you can see HDFC Bank, ICICI Bank, SBI are on the laggards end. What's contributing is Reliance Industries. What is contributing is Bharti Airtel ahead of its results tomorrow, and Tata Steel after its results is also contributing to the gains along with Mahindra and Mahindra. Some broader market results just came out a few minutes ago. Sumitomo Chemicals is one of those. The revenue growth was strong. There was also margin expansion as well. The broader markets have surged to the highs of the day. We are counting down to a lot of broader market earnings, be it from Marico, DLF, and Sumitomo Chemicals now 2.5% higher after that results announcement. ABB India, though, on the downside, continues to remain at the lows of the day. The top loser on the Nifty 500 index, 6% lower now after that earnings call commentary. And you can also see numbers now from TTK Healthcare on your screens there. Almost a 60% decline in its net profit, and it's showing up on the stock as well. 5% lower, taken a bit of a nosedive now has TTK Healthcare. But the pocket that is doing well though are two-wheeler names, and that is after their auto sales numbers and some earnings as well. Counting down to those earnings, Hero MotoCorp, TVS, Royal Enfield, all of them have seen a 19 to 25% year-on-year growth in their overall sales. Sudarshan is joining in with more on this. Sudarshan.
So it's been a good day of trade, especially for two-wheeler names, and that too Hero MotoCorp, which is amongst top Nifty gainers, currently up more than 3%, say almost 4% in today's trading session. And not only Hero MotoCorp, other names, if you take a look, TVS Motor is up almost 3%, Eicher Motors too up more than 2%, even Bajaj Auto is up almost 2%. And the reason is for the month of July, except Bajaj Auto, all the other names have seen a growth, even in the domestic segment. So Bajaj Auto had seen a decline of 13%, all the other companies have seen a growth in the range of 19 to 25%. And if you take a look at the export segment, here even Bajaj Auto has seen a growth, and the growth for the all the companies has been in the range of 28 to 95%. So for the export segment, it was important for two companies, Bajaj Auto and TVS Motor, because contribution of both domestic and export segment is almost the same for these two companies in the range of 40 to 45%. For Eicher and Hero MotoCorp, the contribution of export segment to total sales is very minimal. Example, for Royal Enfield, export segment contribution is just 13% to its total sales. Now, amongst the major outperformers amongst all these names, TVS Motor and Hero MotoCorp. Why TVS MotoCorp? It's the beat across the segments. You take a look at domestic segment, has seen a very healthy growth. For export segment too, has seen a very healthy growth. Hero MotoCorp domestic segment has seen a growth, and its two segments. Motorcycle segment has seen a growth of almost 19 to 20%, but the growth was below estimates. What has done very positively is the scooter segment. Here the growth has come, and the growth was of 64% versus an expectation of growth in the range of 20 to 25%. And now the outlook, festive season is coming, and one segment that has been doing well, especially in the festive segment, one segment that does well is the entry-level segment. And these two companies, both TVS Motor and Hero MotoCorp, have huge presence in the rural segment, and rural segment continues to do far better than the urban segment.
Continuing to do better than urban, that has been the story of the last few quarters. Sudarshan, thank you for that. And speaking of quarters, it was the earnings season that was supposed to determine which way the markets go. And so far, according to Motilal Oswal, it's been a fairly resilient quarter by their word. Now, according to their report that they put out earlier this morning, X of financials, their coverage universe has seen an 8% earnings growth this time around so far. And X metals and oil and gas, that figure is 7.5% on a year-on-year basis. Now, which are the sectors that have contributed to this growth? BFSI, tech, oil and gas, utilities and cement. Of course, cement has been an outperformer with 47% earnings growth this time around so far. And the utility segment too seeing double-digit growth this time around as well. Of course, we are talking about the Motilal Oswal coverage universe that has reported results so far. Now, which are the sectors that contributed to that growth? Sectors that beat expectations. Metals, expectations were already bad. They've been better than those bad expectations. Auto has beaten expectations. Capital goods has beaten expectations, as has the consumer durable segment. What has not done so has been the auto segment. Of course, we are still counting down to a lot of numbers from Tata Motors, Bajaj Auto and so on and so forth. But so far, the auto sector has failed to meet expectations for the quarter this time around. What has done well, what has not done well has been PSU banks, oil and gas and real estate. So these are the ones that have missed expectations this time around. If we talk about categories, the only segment that has missed expectations is the small cap category, a 9% decline so far this time around during the quarter. The other two, the mid caps and the large caps, have fairly met expectations more or less from what the Motilal Oswal was projecting. Now, out of the 50 Nifty stocks, 38 have already reported results, and those have seen an 7.5% earnings growth overall this time around during the quarter on a year-on-year basis. What have contributed, the stocks that have contributed to this growth? It was Reliance, HDFC Bank, ICICI Bank was the standout, of course, JSW Steel, Bajaj Finance, L&T, and Mahindra and Mahindra. Now, the stocks that have not contributed to this growth and have been laggards include the likes of Coal India, IndusInd Bank, HCL Tech, Kotak Mahindra Bank and Axis Bank, the two major banking misses this time around, and of course Eternal, and those have not managed to contribute to the earnings growth for the Nifty 50 universe this time around. Now, based on all of this, as Motilal Oswal has cut their Nifty 50 EPS growth assumptions by another 1% for the current financial year, and almost 0.8% for the next financial year to 1110 rupees and 1297 rupees respectively. These are the Nifty EPS forecasts, and based on that, they say that their model portfolio tilt continues to remain towards the large cap names, which is 70% tilt still there, but they have increased their exposure to the mid cap names, the weightage of the mid caps in their model portfolio, to 22% from 16% on the back of better earnings performance. So that is how the quarter has been so far. We're counting down to the fag end of the result season. It will be interesting to see whether this resilient quarter continues to remain resilient, as Motilal Oswal has said. But the stock that came out with results on Friday evening was ITC, and there were a lot of moving parts to this, some good, some not so. Mangalam is here to summarize all of that, and of course what brokerages are making of it as well. Mangalam.
Well, ITC reported a mixed set of numbers where the revenues actually beat expectations, but the margins were actually a lot lower than what the street was expecting. So as a result of which, mixed set coming in, and the stock price is reflecting that as well. No great shakes on either side. Mild green is what we're seeing. And the reason for that is because, one, while all the other FMCG stocks have done well, ITC has been a bit of an underperformer there, and valuations support ITC as well, as they always have at 22 times two-year forward earnings. If you look at the overall numbers, revenues closer to that 1,907.50 crores, much above street expectations of 17,650 crores as well. But as you go lower, the EBITDA at 6,261 crores, the street was working with a number upwards of 6,300 crores, and there's been a near 500 basis points disappointment on the margins too. The The net profit has come in at 4,900 crores. The street was working with a number a little over 5,000 crores itself. So what was good? The revenue beat was led by, the cigarette revenue growth and the cigarette volume growth. Cigarette volume growth upwards of 6% is actually the highest that we've seen in the last many quarters, but that has had an impact on their margins as well because leaf tobacco inflation was fairly high, though the company believes that going forward that may see signs of, coming down or receding given the sort of crop prices that we've seen for this season. The FMCG business, there's been a margin decline of almost 180 basis points year on year on that one as well. Notwithstanding, quarter on quarter, there's been a near 60 basis points improvement. The second thing that led the revenue growth, apart from the cigarette business, which is the mainstay of the company, is agriculture. The agri-trading business saw revenue growth of almost 40% versus street expectations of 20 to 25%. This was one led by higher realizations and secondly by favorable policy on the exports as well. So while this has done well in this quarter, going forward, whether this continues to do well or not is something we'll watch out for since the government has gone ahead and imposed restrictions on wheat export once again. All said and done, mixed quarter and mixed performance for the stock right now.
A mixed performance indeed. Mangalam, thank you for that update on ITC. I'll take a short break here, but just before that, some flashes on your screen. The PAN 2.0 project is expected to go live in the next 18 months. The CBDT sources are telling CNBC-TV18 that the IT department has awarded the PAN 2.0 project to LTI Mindtree. Now remember, this was the reason why shares of Protean eGov Technologies had seen a major knock just a few months earlier when they had mentioned that they were out of the reckoning of this PAN 2.0 project that the IT department was set to award. And now sources are telling CNBC-TV18 that this project has been awarded to LTI Mindtree. It's showing up on the stock as well, almost 1% higher now on the stock, nearing the highest point of the day. We'll get Timsy on this in just a bit, but for now, these are what the CBDT sources are telling us. LTI Mindtree is likely to have received the PAN 2.0 project from the Income Tax Department. Take a short break here on Business Lunch. Here's a reminder of what our viewers unlock: a world of exclusivity, expertise and influence. Become a member of CNBC-TV18 Access, which is our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC-TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. Now, US President Donald Trump has been putting pressure on India to stop energy purchases from Russia. The sources are also telling CNBC-TV18 that energy imports from the US are set to sharply increase in the near future. We also understand from sources that crude oil prices could harden if India stops buying Russian oil. Sapna Das is joining in with more details on this. Sapna, tell us what more are your sources telling you with this regard?
Well, it's pretty much clear. The view back here in India is the fact that if we halt our imports from Russia, and which are quite sizable in quantity, this could really harden the international global, or rather international crude oil prices. If you look back in 2022, March 2022, just after Ukraine war had broken out, there was a fear of a lot of the Russian oil going off the market. And at that point in time, also, you had seen crude spiking to around $137. But coming back to the present scenario, in fact, back of the envelope estimates within certain sections of the government indicate that crude could spike to as much as $200 a barrel if if a large chunk of the Russian oil goes off the market, or if India halts those imports from Russia. Also, we need to be mindful of the fact that in all these years, India has actually followed all the possible international protocols in terms of sourcing crude oil from Russia. Now, let's just look at the numbers as to how important we are as a buyer of the Russian crude and what kind of numbers Russia talks about. So basically, 4.5 million barrels per day is the kind of exports that Russia does, out of which almost around 1.8 to 2 million barrels per day is what India buys from them. Also, we need to keep in mind that almost 10% of the global demand, that is around 9.5 million barrels per day, is what Russia produces. It is the second biggest producer in the world. So, to speak about Russian oil going off the market, or India halting its imports from, from that country, would basically really cause a shortage of oil supply in the global markets very clearly. So this is the take here, and I think in the coming days we'll know more, but I think the stance back in India is very clear that the imports are not stopping, and Russia will continue to be an important oil sourcing partner for India.
Indeed, Sapna, thank you for that update there. Now, the Organization of Petroleum Exporting Countries, or OPEC, has also announced that it will be raising crude output in the month of September. Manisha is here to tell us more now. Following previous months of increase, another increase this time around, Manisha.
Well, yes, the crude oil prices have declined for a third straight day, and this is after the OPEC Plus meeting over the weekend, where they are looking to increase production further on in the month of September as well. Remember, with this, OPEC would have brought in much of its output cuts, the 8 members that is, and that seems to be weighing onto the prices, but not so much because that Russia sanction threat is still at large in the global markets there. So when you look at the Indian crude imports overall as a picture, prior to Russia's invasion in Ukraine, the number was quite small. 85% of India's imports at that time were from GSS countries, like the Gulf countries, that is. And when you look at the imports from Russia, they were a minute 0.2 to 0.5% at around $5 billion worth. But post-Russia and Ukraine conflict, and because Russian crude oil was available at a much discounted rate, we did see India and China start to buy a lot of it. So from 0.2 to 0.5%, what we did see in the first half of 2025, those imports surged to a huge 35 to 40% of overall Indian imports as well. That is where they begin. Also, when you look at the Kepler data more closely in sense of numbers, then for the month of June, we saw Russian imports of crude into India at 2.1 million barrels per day. By the time it's July, we've seen a decline to 1.8 million barrels per day. But 35% for the first half still stands in sense of imports from Russia there. Now, the markets are looking at those important deadlines where we have US pressuring India to cut its Russian oil imports. US also is pushing for a peace deal between Russia and Ukraine. There's a deadline by the end of this week. If that does not happen, then there is 100% secondary sanctions that we are looking at for buyers as well, and there could be more action and reaction too. So with this, the markets will focus on Friday. That is when the US president says a deadline there lies in. Now, there are a couple of scenarios to this. If US does go ahead with the restrictions on Russia, The markets tell us, and many of these banks and brokerages also have come out with reports suggesting that this could take the crude oil prices in a 3-digit territory above $100 a barrel, because Russia does produce, it's the second or the third largest producer in the global markets there, and with the kind of production Russia does, OPEC members will not be able to meet that. There's not enough global spare capacity, and you will see that knee-jerk reaction come in for the crude oil prices. A second important thing is that annual bill for Indian markets would also balloon by nearly $9 to $11 billion, because that discounted Russian oil, if that stops to come, and if India has to buy it at the higher prices, then we are looking at that bill also going higher. India, remember, is the world's third largest importer and consumer for crude oil, and that will shift a lot of markets and prices in the international markets. So it's going to be very important this week, by the time this week ends, on what really happens with Russia, Ukraine and US, and whether or not we actually see that ceasefire go through. Unless that happens, we would be looking at very strong numbers coming in.
Manisha, thank you for that, and that is the reason why crude prices continue to remain resilient despite this another increase coming in from OPEC and its allies. Now let us also listen in to what experts have to say about India cutting back or reducing Russian oil imports.
India is hugely dependent on Russian oil. We're a major oil importing country. We don't have a trade surplus overall. We have a current account deficit. And it would be a major blow. There's no question about it. And I don't think the government should agree to this at all. But in any case, no country should be bullied into this to look after their own fundamental economic interests by these kinds of very extreme bullying tactics. Now, if we stop buying Russian oil or reduce it, I think that's extremely unfortunate. We really need to keep our sources of supply as diversified as possible. The push is to make everybody buy very expensive US natural gas, which is not in our economic interest. It's, by the way, not in Europe's interest either, although they've agreed to do it.
Take a short break. On the other side, we get you excerpts from the conversation we had with the management of Tanishq on the outlook ahead and the likely impact of the US tariffs on their business. Stay tuned. Welcome back. Now, Tata-owned jewelry brand Tanishq has rolled out diamond expertise centers designed to give buyers scientific clarity and full confidence while choosing their diamonds. CNBC-TV18's Shivani Bajaj spoke to Ajoy Chawla, the CEO of Tata Jewelry segment, and the company's plans for lab-grown diamonds and the likely impact of the US tariffs on the gems and jewelry sector. Listen in.
About lab-grown, it's a very recent phenomena. There are many players who've jumped in. Prices have been dropping significantly. Hopefully in the future, penetration of diamond-studded jewelry in the country will go up because of that. But right now, it is still less than 2% of the total diamond-studded jewelry market. If I think of it from an all-India perspective and overall perspective. With the prices dropping, this is a challenge for the industry because unit economics have to play out.
There is a lot of talk since for the last 2 days about the US tariffs, and gems and jewelry is one of the baskets that is big, even though you don't. But as an industry leader, what do you think is the impact? How do you see this playing out for India?
Early days. I think we should wait for all the talks to complete. Right now, there's a lot of posturing going on. Maybe this is the truth. Maybe there'll be some other deal. Maybe who knows where it will go. Let it emerge. I think even the government is trying to see where it goes. The government is very, very conscious of the role of gem and jewelry sector in the overall export piece, and US is an important market. I'm sure good sense will prevail and something interesting will come out. Otherwise, the industry will adapt and innovate. I think business and industry has to be agile and has to factor in all uncertainties that happen. So early days, we should wait and see where it goes.
And with that, we take your leave on this edition of Business Lunch. We leave you with the market still 100 points higher on the Nifty, and the broader markets continuing to do well as well. Speaking of the broader markets, Midcap Radar takes the action forward on the other side. From me and the team that put this show together, thank you so much for watching.
Well, good afternoon and welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Vivek Iyer and with me today is Mangalam Malu. Good afternoon, Mangalam. Well, not much to complain about. We started off the day on what was a very muted note, very weak handover, 5 consecutive weeks of declines. But post 11 a.m. especially, we've seen what is essentially a broad-based recovery across the entire market.
That's incredibly, well put, Vivek. We've seen a fair amount of selling. The street was anticipating a big, sell-off post, especially what took place on Wall Street as well. But the GIFT Nifty told you that maybe, we are in oversold zone and a bounce is imminent. A bounce is what happened. Now what we need to see is whether this sustains and builds on to that as well. Have we done ourselves with, the oversold zones and a relief rally that we've seen? Because it's struggling to go past that 24,700 mark. And the biggest reason for that is the Nifty Bank. Nifty Bank is currently underperforming. The Nifty has been taken higher by, you have the metals index as well as the auto pack. And both these indices are fairly volatile. And as a result of which, we have the India VIX. Despite the market being higher by almost 115 points, the India VIX has spiked in today's trading session. What the street would have liked is if the market continued to do well and the India VIX fell further from levels as well. But this is Midcap Radar. No complaints about the midcap end of things. 1,600 stocks advancing for 1,100 stocks which are declining. The midcap index itself up over 500 points. So let's go across to Hormaz, who is joining in with all the midcaps that are moving around in trade today. Hormaz, there are a bunch.
Oh, absolutely. And the mid-cap index, as you mentioned, the market recovery is showing on the broader markets as well. They were the ones that were significantly bleeding during the sell-off last week. And starting off with some of the gainers that are not earnings reactions in today's session. Look at GMDC is up 8%. NetWeb, after its results, is continuing to build on to gains. UPL has recovered what it lost on Friday and a lot more. And Endurance Technologies has surged to the highest point of the day, 8% higher now on that stock as well. You take a look at some of the positive earnings reactions that have come in, some of them today, some of them over the weekend. Look at Sarda Energy now, 18% higher on that stock. Delivery is holding on to gains of 6%. MCX after the results and the stock split as well. And Ramco Industries just came out with results a few minutes earlier, saw a brief spike, but now is coming off those higher levels. And look at the negative earnings reactions on the flip side, and that'll give you an idea of TTK Healthcare. At one point fell 5% after its results. ABB India after its con call is down 6%, and Narayana Health too, another negative earnings reaction today. Stocks that are doing well on the volumes front, and they include the likes of CCL products. Look at Tata Investment, of course, the board came out with results and a stock split here as well. And JSW Energy trading 5% higher on today's session with very strong volumes. And lastly, stocks that are at a 52-week high today, and of course, you would not be difficult to find names here in today's session, especially eClerk Services is up 6%. Star Cement has moved to the highs of the day, and another 52-week high for this stock as well. Back to you guys.
Thank you so much for that, Hormaz. Whole host of stocks, especially the broader end of the markets, moving. Cement pack in focus. We have a large IPO too. And at the back of that, some positive rub-off seen across some names. Shree Cement too will deliver its numbers later today. Well, what's actually seen a bit of a recovery is the entire IT pack. Remember, the entire sector was actually under quite a bit of pressure in the week gone by. But today, what we've seen is a bit of a recovery. Names like TCS, Infosys, Wipro, all three of them near the day's highest point, even as we speak. Well, ABB India reported a weak set of Q2 CY25 numbers. The company's margins contracted, and the order inflow too came under pressure. We have the management with us, and this is something that we look forward to listening to.
So I think base orders definitely grew, right? So I think what was missing in this particular quarter was a large orders, what we had in the last year at the same time. And that's something which did not materialize in this particular quarter. And that's more driven by the fact about how speedy decisions get made up in the market, given the uncertainties of the other topics which are being dealt in the geopolitical level. So that's how we see that the market is behaving at this point of time.
So any particular segments in particular that are being impacted this time around? Is it largely, the impact is coming in on process automation, or, any specific segments that you like to highlight?
So as far as ABB portfolio is concerned, as you know, we are into 4 business areas, robotics, process automation, motion, and electrification. So typically our motion and electrification is a flow business, which essentially captures the mood of the market, how nation is building itself into infrastructure, industrial infrastructure, and the government capex which is formed in different areas. When it comes to robotics, it's pure manufacturing play, whether it's in automotive, electronics manufacturing, and I think that's where we continue to automate the industries. Process automation is the area wherein it goes into relatively in the core sector or heavy industry, which is prone to capex cycles, because sometimes the industrial cycle capex is up and sometimes is down. So we did see that there is a delay of decision making in the process automation area. And also around this year, we had fairly large orders in the traction area from railways and in the metros specifically, so which is not matching in the same quarter. So on a relative basis, you will see there's a decline there. So otherwise, we find that the market at a base level is pretty solid and robust, but at the same time, there's a sluggishness in decision making at this point of time.
Understood. So this sort of cyclical correction that you've alluded to, Sanjeev, I mean, how long do you think it can last from your experience over the last couple of years?
Back of 5 years of robust growth in our orders, revenues, as well as profitability, and I think that has been reflected very well. I think India's GDP has been growing about 6.5%, close to 7%. We have captured about 22% CAGR growth in last 5 years. So given that kind of a scene we always have seen in our existence in the country as well as in the market always takes a breather after certain period of time, and I think that's what the market is doing at this point of time. And also given that lot of uncertainty is there in the market, especially on the trade front. So some of our customers they're taking a cautious approach. And we see that there are projects out there, but then there's a delay in decision making.
Understood. So the pipeline for the base orders as well as the large orders, how does that look like? Do you think that the order inflow trajectory that has slowed down now may pick up probably in the second half of the year? Is that something that you're working with?
They're tracking well. So that means that represents the base strength of the market, because channelization of the products and the solutions and the consumption in tier 1, tier 2, tier 3 markets is happening, and I think that's something which is working well. On the larger side, I believe we will say that we wait for another quarter and see how market grows, because some of the orders which should have been decided in the previous quarter, they have been kind of supposedly moved in the next quarter. We see that how the realization takes place, and then we'll see how the traction starts developing. So we typically take a view very close to when the customer changes their kind of behavior in terms of decision making, and then will we take a move whether the momentum is coming back or it is one-offs.
All right. Shikhar, actually I'd like to ask you about the margins this time around, because I think that was the other casualty, if I can call it that. So I mean, of course, you did allude to some sort of forex losses, and of course there was some one-offs. So what were exactly these one-offs, and adjusted for all of this, what would the margins have looked like?
We did an PBT of 11%, PAT of 11% at this point of time. So, but I think if you adjust for these type of one-offs, which is the forex loss which we had, and you could look at it from the euro and CHF appreciation, which happened in the last one quarter, which has been unprecedented over the several quarters, right, was a thing which we had to deal with in this particular quarter. And as you know, ABB follows a very sort of a conservative accounting standards, and we took all the impact on the P&L. So I think that was 56 crores, and the other one-off which we took on account of an project execution topic which we need to deal with was 39.5 crores. And I think if you adjust to this, we are in that range of 12 to 15%, which we already mentioned. So I think
that is the PAT margin, but what about the EBITDA margin?
EBITDA margin 1.5% to that, and we would be there around 16-17% over there.
And Sanjeev, I have to ask you about the robotics division. I know you have given a lot of clarification out in your presentation as well as the press release, but if you can help me with the timeline for that, because the global parent has said Q2 of 2026 is roughly when this sort of restructuring will take place. So is the timeline similar for the entity in India as well?
We take note of the global kind of flow, wherein start of next year, they wish to have a new co established, and I think given if the board finds everything in order in India, we'll try to follow the same timeline.
All right, and I'd also like to ask you about the other segments, right? I mean, if I look at the business X of robotics, only in Q2, the growth was only 4.5%. Of course, there was a decline in process automation, So what is the outlook on all of the other segments going forward? Do you believe that, X of robotics, what would be the kind of growth? Will we see double-digit growth from all of these businesses as we've seen in the past?
I would say compared to last 5 years, there's a relative sluggishness in more market segment relative to what we were experiencing. But we see this is more to be a temporary phenomena. Whether it lasts for 1 quarter and 4 quarters, we'll have to see how it performs going forward. Yeah.
Well, that was the management of ABB India in conversation with our colleague Vamakshi, talking about how Q1 fared and what is the outlook as far as the rest of FY26 is concerned. But we'll now slip into a short break. The management of Epicral joins us next to discuss the Q1 numbers and more.
years.
Welcome back. Let's talk about Epicral. The company reported a mixed set of earnings with the revenues going below estimates, down 7%. Margins remained healthy. In fact, the upper end of the guided band of 23 to 27%. More importantly, what is the way ahead for the company? We do have Maulik Patel, who is the chairman and managing director, who joins in to discuss more. Maulik, as expected, there was weakness in realizations. What wasn't expected was a decline in volumes as well. Could you give us a sense on what kind of volume growth are you targeting, and at what point do realizations start to turn? Because, prices have fairly seen a big fall. A lot of people do believe that maybe they've bottomed out and from here on we can see an increase. In light of that, what kind of growth or, performance do you expect in the next 3 quarters?
Yeah.
So, a major our revenue at last expansion, what we did in the CPVC as well as in the epichlorohydrin, both molecule are import substitute. And the major consumption happening in the Q3 and Q4, because during the monsoon time, the consumption of the CPVC pipes as well as the epichlorohydrin, which is a major consumption in the epoxy resin, which is in the paint and coating and the construction sectors, is almost down. And this time, the early monsoon has lowered the demand in the Q1 itself. But going forward, we are expecting H2 will be much stronger because both the products are very strong and the major consumption happening in the H2 in the Q3 and Q4 in this financial year. Volume growth, we are expecting close to 10% in this financial year. And going forward also, we are doing a capex. We are expanding capacity in both the molecules, which are import substitute based on the growth we are seeing in India in terms of the construction, coatings, and the windmill sector. We are expecting very high growth in both the molecules, and our expansion is also on stream and going to be on stream by mid of next year.
So what happens to the realizations? Volume growth, we take your point on board. Second half looks very strong. You've expanded capacity, but realizations, they've been coming down structurally. How long before we see a turnaround here?
Yeah, if you can see that realization is also going down as the raw materials prices are also coming down the same time. That's why if you can see our margin has remained intact irrespective of the realization is going down also.
Understood that. Mr. Patel, at the end of Q4, please correct us if you're wrong. We understand that you had given a guidance, especially for volumes, that it will trend in the range of 15 to 20% with EBITDA margins in the range of 25%. So FY26, are you trimming down the volume growth as far as guidance is concerned to 10%? FY27, post capacity on stream, can you quantify the guidance that you expect?
Yeah, that's right. The chlorotoluene and derivatives, what we have expanded and what we have commissioned by end of March. Normally, that kind of products is mainly going into the specialty chemical, which is agrochemicals and the pharmaceutical intermediate, which is taking little more time for approval of the customers, and routine to reach to a initial approval, trial orders, and the commercial quantity will take little more time than what we have thought of. So we are expecting, I think by Q4, we are going to get a volume from the chlorotoluene and derivative business. That's why we have cut down a little bit shorter the volume, but we are expecting the Q3 and Q4. We are very bullish, and we may, the volume may increase in this in the remaining products.
All right. What about your domestic export mix? You've been saying that you are looking at domestic as your key growth driver. You spoke about import substitution projects as well. But around 10 to 20% of your sales, which does come in from exports, facing some uncertainty around Europe too. What's your prognosis of growth for both exports and domestic in this year?
As a Epigrel, as a company, always focus on the domestic growth, and we have always focused on the import substitute molecule. So our export is hardly 10% of the entire company's revenue. So 90% we are domestic focused, but yeah, in the European segment, there is no change in terms of the export, in terms of the quantity. And we are expecting going forward as a chemical sector is going down in Europe in terms of the manufacturing. They are facing a lot of issues after the energy started facing issue from the Ukraine and Russia war. We are expecting the volume may increase in the European segment, and that's what we see in the going forward.
Mr. Patel, so FY26 capex guidance was 450 crore, which is something that they've alluded to, saying that there will be a few capacities that will come on stream. Going forward, will you go slow on capex given the fact that demand outlook is slightly subdued compared to what you had envisaged earlier?
No, we are going to continuously expand our business in terms of the chlorine derivatives. So we have a land availability in the existing complex, as well as we have purchased a land 2-3 years ago for the future capex. So next 5 to 7 years, we are continuously focusing on the import substitute molecule. We are continuously going to do our capex where the India requires, and the import substitute we can able to do it. So that strategy we are continue. Capex also going to be continue. And yeah, so that is we are not going to stop or any full stop in terms of the capex of any, and in the future in terms of the volume expansion.
And what about chlor-alkali and specialty? Where do they stand in terms of overall contribution? Where do you expect this to go going forward? Since you have some capex coming in other parts of your business, what happens to this mix?
So this mix as a long term, we have we are going to end up with 70 and 30%. 30% revenue will come from the chloroalkali, and the derivative segments, it is going to come on the 70%. So as of now, we have reached to 50%, slightly lower than the last quarter because of the the price mix, the revenue mix has changed a little bit in terms of the pricing in the chloroalkali and the derivative segments. But going forward, we are expecting 70% revenue will come from only from the derivatives and the specialty chemical. And our capex is also going in that direction only.
Understood that, Mr. Patel. Thank you so much for joining us, speaking to us about how Q1 fared and the plans as far as the rest of FY26 is concerned. Well, as you can see on the bottom of your screen, some time ago, you did see the results of Shree Cement. Appears to be a slight miss to what the CNBC poll was indicated, but more on that later. We'll now slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back. Let's look at Marico. The company has reported its numbers. Right now, the street was working with a revenue of 3270 crores. The company has gone ahead and reported the numbers of 3259 crores. So largely in line with expectations. Even on the bottom line, it is fairly in line with street expectations. Remember, for Marico, the important part to look at will be what the volume that the company will report this time around. Typically comes about 5 to 7 minutes after the company reports their numbers. So the poll was 495 crores on the bottom line. The net profit 513 crores, largely in line. and we do have, the revenues coming in line as well. We're looking at volume growth at 8 to 9%. Let's see how the company reports. And more importantly, the commentary around margins will be extremely crucial to track. Marico, going into numbers, was at a 52-week high. Post these numbers, which are largely in line, stays around that 52-week high as well. With that, we wrap up on this edition of Midcap Radar. Your stocks when we return. Important show to watch because markets move to the high point of trade.
Hello, good afternoon. You've tuned into Your Stocks, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. Markets as of now have gone about at 24,700 levels. Nifty at 24,720 around that mark. Day's highest point is what is coming in for the Nifty 50. Let's look at the broader end of the market as well, because the advanced decline ratio has actually moved on towards more in favor of advances versus decline as well. So interesting to watch out for, given that the broader end of the market is also performing well and outperforming the benchmark indices. But let's move on and talk about JSW Cement's 3,600 crore rupees IPO, which will be opening up for subscription on 7th of August and will close on 11th of August. The IPO comprises of a fresh issue of shares worth around 1,600 crore rupees and an offer for sale of up to rupees 2,000 crore rupees from the existing shareholders. Now, my colleague Reema Tendulkar actually caught up with Parth Jindal, Managing Director of the company, to talk about the same. Listen into that conversation.
Over the years, JSW Cement has been growing steadily. In 2016, when I took over the business, we were a 6 million ton company. And over the last 9 years, we've tripled our capacity from 6 million to now over 20 million tons. At that time, we were primarily only in the south. Now we've entered the markets of the west and the east. And I think now that the company has grown to this size and scale, we are truly poised for our next phase of growth, which is to enter the markets of the north as well as the central parts of India. And the IPO and the proceeds of the IPO that we're getting is going to allow us to expand into the north and over time expand into the central part of India as well. So, you know, I truly believe that in order to be relevant in the Indian cement industry, you need to be present across the country, because you never know which region is doing well, which region is doing badly. So in order to truly make a, you know, well-diversified and stable business model, being in different regions and all the regions of India is very important, and that's the ambition of the company.
So talking about your expansion plans, Parth, you're looking to increase your total grinding capacity to 42 million tons per annum and even double the clinker capacity. When do these capacities come on stream?
So at the moment, we are in phase 1 of our expansion, which is we are adding a grinding unit in Odisha, in Sambalpur, and we're adding our integrated unit in North India, in Rajasthan, in Nagaur. These two plants, although we have guided that they'll be ready at different times, I'm very confident that within this financial year, both of these plants will be up and running, which will take our capacity from 20.6 million tons to about 26 million tons. We have also started the groundwork for the other expansions that we have in place, which is some of them are brownfield in our existing locations. So Vijayanagar in Karnataka, we want to add 4 million tons of grinding there. Dolvi in Maharashtra, where we again, JSW Steel has a large complex, we want to add 4 million tons there. And then our complex in central India, which is the mines we acquired from India Cement about 3 years ago in Hatta in Madhya Pradesh. So all these projects are primed and we can actually begin work very, very quickly. It's our endeavor, it's my endeavor, my aim to get to 41 million tons within 3 to 4 years. The sooner the better, but obviously the performance and the leverage needs to be in check, and we would modulate our growth based on our leverage.
Got that. And 60 million tons per annum, you've got that ambition too?
Yes, so within the existing locations, within the existing mining deposits that we have enough limestone and enough land, as well as enough fly ash as well as slag, which tied up to take our capacity to 60 million tons.
Okay.
So the way to think about us is today we're 20.6 million across 7 locations. These 7 locations themselves can go from 20.6 to 30 million tons. And then the balance 30 million tons would be coming from 3 different sites. Rajasthan and Nagaur, along with its split grinding units, would be 15 million tons. Central India, which is Madhya Pradesh and Uttar Pradesh, should be 10 million tons. And then Gulbarga cluster in Karnataka and a grinding unit in southern part of Maharashtra would be another 5 million tons. So this entire strategy is in place to 60 million tons, which we hope that once we get to 41, we will embark upon the journey from 41 to 60, which again should take another 3 to 4 years. So if all goes well, we could get to 60 million tons, sometime in the early part of next decade. And if it goes a little bit worse, then it'll be in the middle part of next decade.
Well hedged, Parth. So today I think you're the 9th largest player by capacity.
That's right.
Can you get into the top 3, top 5, challenge the Shree Cements, Dalmia Cements of the world?
I think first of all, I think all the companies that are there in the cement industry have been around for a very, very long period of time. And they've all built fantastic businesses, whether it's Bangarji or whether it's Puneet Bhaiya, they've all built phenomenal businesses, and they all have their own growth plans. So I think the top 4 players of the country are well out of reach at the moment, and obviously they also are expanding.
Sure.
I think the 5th spot is up for grabs, and that's the aim, is to try and see how quickly we can get there. Having said that, inorganic opportunities in the cement industry, as we've seen over the years, have come, and there's been a lot of consolidation. And one of the disadvantages of being in the cement industry is that the competitors that we deal with on a daily basis are all sitting on very strong balance sheets. So for them to acquire inorganically is far easier than for us at this stage to acquire. But obviously with the IPO coming in, with liquidity coming in, with currency being available, tomorrow if a very exciting opportunity comes in a market that is attractive, we could do a QIP, we could do a follow-on, we could do so many things which the group has done in the past, which will allow us to compete. But all said and done, my fundamental belief is that you need to be at least a 10% market share player across the country to be relevant. And I believe that, last year the Indian cement industry consumed 435 million tons of cement. I believe over the next 5 to 6 years, this number will grow at a CAGR of about 6 to 7% in lockstep with GDP and get to about 750 million by 2030, 2031. So in order for us to have 10%, we would need to be selling 75 million, which is higher than our current plan, but still getting to about 55, 60 million tons of sales, 7 to 8% market share would be the first step, and then to get to that 10%. So I do think the cement industry, the consolidation wave will continue, and it will become an industry which is dominated by, call it 6 to 7 players.
Yes. Got that. Just a quick word on your balance sheet. Your debt today is 4,200 crore. 520 crore of the IPO proceeds go in reducing your debt. What would the post-listing debt look like and leverage ratios? You've got so much capex coming on stream. So how would the leverage ratios move?
No, I think if you look at our debt profile, last year due to the difficulties that the industry faced, our net debt to EBITDA almost touched 5 times, which is way above healthy level or a comfortable level for the company. It is my intention that over time to bring the debt as close to 2 times as possible, and not exceed 2.5 times. So this is not something that this may change from time to time given the dynamics, but in general being below 2.5 times net debt to EBITDA is the aim of the management.
Okay, got that. But now, considering your ambitious expansion plans, what is the total estimated capex outlay for you?
Yeah, so I'm not allowed to actually give the forward guidance in terms of capex, but what I can say is that building organically for JSW is significantly cheaper than building for any of our large competitors or in any of the acquisitions that are happening. So on average, the acquisitions have been happening at about $120, $130 per ton. Some of them even as high as $150 per ton. Our capex intensity for this phase of expansion is less than half of that.
Okay. So you're going to be building incremental capacity at 60, 70?
That's it. So close to that.
Close to that. Okay. What about the operating, the EBITDA, right, per ton? In FY25, it was depressed. I think it was sub 700. What is the number looking like in Q1?
Again, our Q1 results will be announced soon after the IPO. But I think the industry has seen a sharp increase in EBITDA per ton. I think the pricing power has come back into the industry, and all our competitors have announced their results at nearly 30 to 40% EBITDA improvements, both overall as well as on a per ton basis. So we would be in that ballpark for sure, and we would announce our results imminently after the IPO.
Okay, an interesting chat there. Surely we'll be waiting out for the IPO opening up 7th of August. So keep an eye out on that one. But on that note, we're going to actually sip into a very short break. And here's a reminder for our viewers. Unlock the world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access at that's our premium members only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back to your stocks on CNBC-TV18. We have the numbers of Escort Kubota that is flashing at the bottom of your screens for you all as well. Profits 1,397 crores versus 302 crores. There's an exceptional gain that has come in as well, which was of 76 crores versus nil last year. We're seeing the stock has seen a sharp spike up that's coming in as well. Revenues are a bit muted, down 3% in trade. Let's keep an eye out on Escorts Kubota. But let's get started with all your stock-related queries then for today. And we have our experts joining in with us, Ashish Kayal, who's a chartered market technician, author at Wave Strategy Advisors, as well as Gaurang Shah of Geojit Financial Services to answer all those queries. Ashish as well as Gaurang, good afternoon and thank you so much for joining us on the show as always. Let's start with those queries then. We have the first query that is coming in from Miriyala, who's writing to us from Vijayawada. He's holding 150 shares of Torrent Power. This is at a price of 1,414 rupees, and 42 shares of Hindustan Aeronautics, and this is at a price of 4,589 rupees. So they're making a loss on Hindustan Aeronautics as well right now. He wants to know, can he hold both these stocks for one more year, or should he just sell both of them? Gaurang, good afternoon. Torrent Power as well as HAL. What's your view coming in now? Torrent Power, we have the numbers also coming up tomorrow. Both these companies have not yet reported their Q1 numbers. So it will be interesting to see this.
Thank you so much, Vinny, for having me on the show. Good afternoon to all of you, all the viewers of CNBC-TV18 and my good friend Ashish Kayal as well. A small disclosure. Recommendations that I'm going to give this afternoon on the show are a part of our research team recommendations. Our company, Geojit, or I, do not have any personal investments in the recommendations given across, nor any financial interest, nor conflict of interest. But we give similar recommendations to our clients. They might have their investment interest in the stocks that are recommended. So coming first on Torrent Power, we've been maintaining a positive stance on Torrent Power for a pretty long period of time. This is one of the stocks that has been under recommendation from our research team in the power generation universe. Cash-rich balance sheet, power supply to not only the state of Gujarat, but also to the neighboring states like Rajasthan, MP and Maharashtra as well. Good capacity and the business strategy is very strong. Have an accumulative stance on Torrent Power from a long-term point of view. I think this will also be one of the companies which will benefit from the government's push in terms of adding almost about 300 to 500 gigawatts in the next couple of years. So hold on to it. On Hindustan Aeronautics Limited, we don't have a direct coverage. Of course, we covered the stock during the IPO, which is pretty long period of time. But one of the strongest players in the defense universe, that is Hindustan Aeronautics Limited. HAL, likely possibility that Tejas Mark 1 is going to be introduced in the Indian Air Force fleet very soon. They are working on Tejas Mark 2 as well, which is a long gestation period. And along with that, they have supplied a light combat helicopter called Prachand to the Air Force and to the armed forces. So the company's order book is very, very strong. Can't give specific on HAL because we don't have coverage.
Okay, that's a word coming in there for Torrent Power as well as HAL on the fundamentals. Ashish, good afternoon. And on the technicals, both these stocks, what's your view coming for Torrent as well as HAL?
Good afternoon, Vinny, to Gaurangji and to every viewer as well. As far as Torrent Power is concerned, we can clearly see the stock has come to the prior support level. The prior price action support level was around 1270. Stock made a low today near around that level and showing some kind of a positive attempt. So my recommendation would be to hold on to the stock here. Maintain a stop loss of around 1270 on the downside for near term. From a medium to long term perspective, hold on to the stock here. We can expect it to again move back towards the upper end of the swing, which is near 1400, 1420 levels. So hold is the recommendation on Torrent Power. And on the HAL, we can clearly see that HAL showed a very, very smart move from March 2025 from 3000 levels to 5000. And it's correcting a portion of that move, which is a very healthy sign. And it has a prior support, which is around 4350. So there is a possibility we can again start seeing an upward journey in HAL also. Stock can move towards the level of around 4940 on the upside. And one can maintain a stop loss of around 4350 levels.
Okay, keep an eye out on those levels over there for HAL as well as Torrent Power. We have the Marico volume that has come in 9% versus expectation of 8 to 9%. So that's almost in line with what we were expecting at CNBC TV18. Just a word on that front. So keep an eye out on Marico, which reported its Q1 numbers just a short while ago. Let's move on to the next query for today. We have Ravi, who's writing to us from Hyderabad. He's holding 30 shares of KPIT Tech, and this is at a price of 687 rupees per share. Now he wants to know if he should continue to hold the stock or exit at the current levels. Gaurang, KPIT Tech, they reported their numbers, muted Q1. Commentary also doesn't seem to be that exciting for the next couple of quarters. What should the viewer do now? Should they continue to hold this for the long term, or maybe there'll be some better levels to enter at?
So, Vinny, allow me 30 seconds, if you will. Not only KPIT Tech, but the entire IT universe, IT sector is likely to show some kind of slowdown. We've already seen in the numbers for the Q1 for IT industry. And our view is that maybe there might be a stretched out period of underperformance. Second, third quarter could be painful in terms of earnings. That is primarily because of the headwinds that the IT sector is facing. The reliance on US related orders coming in, which contributes largely to the top line and bottom line, is a little bit sticky right now. We don't know whether US will go into a slowdown, a recession, interest rate cuts, etc., etc. Along with that, US companies spending on the IT platforms as far as services and product is concerned, which they outsource from the Indian counterparts, Indian IT companies. But from a long-term point of view, Vinny, we remain positive. On KPIT Tech, we have a coverage on the positive side. We have a buy coverage on KPIT Tech. I think if one decides to invest in IT universe, the time frame has to a little bit longish. You can't do with 6 months, 1 year kind of time frame. But 1.5, 2 year plus, I think turnaround is visible, anticipating that whatever happens in US will not be a huge negative on the Indian IT sector.
Okay, that's a word there on KPIT and IT sector as well. But, Ashish, on the technicals, KPIT Tech, what should the viewer do now?
If you look at KPIT Tech, or if you rather look at any other stock for that matter, TCS or Wipro or any other stocks, they have been performing very much in similar lines, because we saw some kind of a positive traction from April to until June onwards. And since then, we have again started seeing kind of a downtick in these kind of stocks. So my suggestion as of now would be to continue to hold. The entire IT cycle can possibly start turning back on the upside. When that happens, the IT space will outperform. So KPIT Tech, maintain a stop loss of around 1170 on the downside. We can possibly start seeing it touching and crossing the levels of 1300 and moving towards 1400 levels on the upside.
Okay, keeping an eye on that. The next query for today coming from Ram Kumar, who's writing to us from New Delhi. 35 shares of Pidilite is what he's holding, while price is 1,760 rupees, making a profit on this one. He wants to know if he should add more stocks, so look to average or add more in his position, or exit the stock. Gaurang, your view?
Not trickling in at the anticipated speed, but I think the entire specialty stroke agrochemical sector is likely to do well. On Pidilite specifically, we have a buy recommendation. So if the investor is inclined towards adding more on Pidilite and having a longish time horizon, I would definitely recommend that.
Okay. And Ashish, a quick word on Pidilite for you?
Yes, continue to hold. The stock is already up by more than 3% in today's session. I think the stop loss can be 2840 for the existing levels. And 3,100 can be the target, which is the previous swing high.
Okay, keeping an eye on those levels over there. But that was the last query for today. So Gaurang as well as Ashish, thank you so much as always for giving us those insights and solving all our viewer related queries on the show. Thanks for that. But with that, we're absolutely out of time on this edition of Your Stocks on CNBC TV18. Thank you so much for tuning in. Remember, you can always email us your queries on the email address that will be flashing for you all on the screens as well. But don't go anywhere. Last lot of traders still left. And for that, you have closing bell up next.
go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Well, it's looking like a mixed screen for now.
We believe that India's energy imports from the US have gone up significantly after Donald Trump won the election.
Nifty broke the low of 24,598 on Friday. The next zone of support for the index stands at 24,300 levels.
We will have this little bit of dilution coming in from the integrated care business until the revenue catches up to the fixed costs that happen with every new business.
E-commerce, they believe that the industry can be reasonably projected to grow upwards of 15%.
Flattish, right? I mean, 24,580 on the Nifty.
We expect that this year the demand of power will be very muted.
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying.
It's a steady start to the week. After 5 weeks of losses, we've finally seen some rebound from lower levels.
Ahead of the festive season, all the players are saying that they are expecting an improvement in the volume.
If we halt our imports from Russia, and which are quite sizable in quantity, this could really harden the international global, or rather international crude oil prices.
Post-11 especially, we've seen what is essentially a broad-based recovery across the entire market.
I think what was missing in this particular quarter was a large orders, what we had in the last year at the same time.
Good afternoon, hello and welcome to Closing Bell, start of a brand new week. And there seems to be some sparks of hope out there, hope in terms of global markets also stabilizing, hopes that that weak data from the US that we had on non-farm payrolls, tariffs, etc., finally maybe it'll get the Fed to move, and hope here that earnings are probably going to be turning a corner very, very soon. We'll talk about that as we go forward. Next 1 hour coming up. It's been a good day. It's actually been a trending up day from the morning lows for the market. So it's actually bulls seeing some green after a long, long time. I'm Surbhi Upadhyay. With me, as always, Reema Tendulkar. Hi, Reema.
Hi, and as we look at the market right now, it's 150 points up on the Nifty. The Nifty is comfortably above 24,700. The Sensex is a gain of about 430 points. And look at the midcap score. The midcap index is up a good 1.25% with a strong advanced decline ratio at 3:2. And talking about numbers, Ather Energy, a more than 70% jump in the company's top line. The loss remains unchanged, so it's still loss-making, but very strong growth seen at the company's top line. We'll talk more and more about the numbers, lots of them, in today's trading session. But let's get on with the show and tell you what we've lined up. Two-wheeler makers surge as TVS, Hero Moto and Royal Enfield all report strong sales in July. ABB India is sharply lower as margins and order inflow concerns weigh on the stock. The company is also seeing sluggishness in some of the business segments. MCX is a big mover today. Earnings have impressed the street. The company has also announced a 1:5 bonus issue. We'll put the spotlight on the other big movers of the day, like transformers and rectifiers. That's got a gain of about 6.5%. UPL is surging 7%. But on the flip side, Narayana Health is under pressure, down nearly 5%. But how should you position yourself in the last hour of trade? We've got Mitesh Thakkar now joining in. Mitesh, this has been a trending up day. Have you been positioned on the long side, and are there any trades for the last hour?
So, one, I think, this is a market which apparently has bounced back from the levels which we're talking about around 24,500, 550 zones. We got a low of 24,535 yesterday. That's held down, but still not a market which is showing signs of a strong uptrend. I think this bounce back could even see the index try and test 24,900, and there's a midpoint pivot at around 24,770. So these are the two levels to watch. I think only about 24,900 would one want to be turning positive on the index. But on stock side, I think a lot of stocks are showing signs of reversal. So Grasim is something which I have a buy with the stop at 27.50 for targets of 28.30. And the other stock which I like is JSW, Jindal Stainless Limited. It's a buy with the stop at about 7.09 for targets of 7.60.
Okay, all right, Mitesh, got it. Thank you very much for that. So we'll keep those trading calls in mind. By the way, before we get on and get to all the stock-specific analysis, two reasons why you're seeing some green on the screen today. One of them is a turnaround in global sentiment. Look at what's happening. Look at the way a lot of Asian markets have closed out today, mostly green, barring some big markets like Japan. Look at what Europe is doing now. European markets are up almost 1%. US futures are up 0.5, 0.6%. So Friday was a day of digesting the disappointment, the tariff disappointment, the fact that non-farm payrolls are so weak. But very quickly from the disappointment, global markets are swinging to optimism, thinking the Fed will finally move. If the US jobs market is weakening as much as the numbers seem to be indicating, then will the Fed cut quickly? And we've seen that, right? If you look at the CME Fed Watch tool, the probability of a rate cut has jumped to about 85, 86%. So that's one global tailwind that we are getting. And on the local side, I just want to put up two graphics. I mean, earnings. The local optimism is that it seems like the first quarter earnings season, of course, we know it's been very, very muted and somber, but maybe not as bad. And is a turnaround coming. So you'll, by the way, hear out that conversation with Sunil Kaul of Goldman Sachs in more detail. But the headline that I picked up from their note is a very interesting one on earnings, at least. If you look at the MSCI India index, then 72% of the companies have reported, 39% companies have beaten estimates, 44 have missed estimates, but the guys who are missing estimates are not missing estimates by a huge mile. The miss is only 1-2%, so it's not that bad. Look at what Motilal Oswal is saying. Motilal Oswal is saying that for the Nifty, out of the companies that have reported, 38 companies out of the 50 that have reported, the earnings are up 7.5% versus estimates of 5.7%, so it's not too bad. And they've trimmed their FY26 Nifty EPS estimates, but by just about 1% right now. So again, short point. Yes, the first quarter season has been subdued and somber, but maybe it's not that bad. And the market's looking ahead, looking to the future, is a turnaround in earnings ahead. And that seems to be the sentiment. We were anyway at the lower end of the trading range, and it's helped the bulls come back on the street. Now, speaking of earning sentiment, turnaround, recovery, all of that seems to be playing out on two-wheeler stocks. And that's one of the first elements that we'll focus on today. Let's bring in Sudarshan, because in the morning he was flagging off how Hero's numbers, at least the monthly sales numbers, are looking good. But it seems it's not just Hero Moto. A couple of other two-wheeler folks have been doing well. We just saw Ather's numbers. At least optically, they look good. So two-wheelers all revved up, Sudarshan?
We are starting festive season this year very early in the month of August only, and the last monthly sales that these companies have reported for July. So sales for most companies were largely in line or slightly better than its estimate, especially for two-wheeler names. They have outperformed by wide margin if you talk about the two-wheelers versus passenger vehicle sales. And amongst major outperforms, two names in the two-wheeler space were TVS Motor and Hero MotoCorp. But overall, if you talk about both domestic segment, if you exclude Bajaj Auto, all the companies have seen a healthy growth, and that growth was in the range of 19 to 25%. Export for all the companies have seen a big growth, and that growth range was 28 to 95%. Two companies, TVS Motor and Bajaj Auto, for them contribution of export and domestic is almost in the similar line. As far as Eicher Motors and Hero Moto is concerned, the contribution of export to total sales is very minimal. So for Royal Enfield, export growth was 95%, but contribution to total sales is just 13%. So that impact is not that much. Now, what about the outlook? Festive season is approaching, and one segment that is expected to do well is the entry-level segment. And two of the major players in this segment are Hero MotoCorp and TVS Motor. So when in the commentary, Hero MotoCorp is saying that retail demand has been stable, and now with festive season approaching, they are expecting volumes to improve. So that's the reason you are seeing a big move in all the names. Hero Moto is up more than 3%. It's almost the same for TVS. Bajaj Auto is up almost 2%, and even Eicher Motors is up more than 2%.
Thank you very much for that. Let's just get in a quick word from Gurmeet on the numbers. Gurmeet Chadha is also joining in.
Yeah, hi, Rima. As I said, and I agree, I think rural surprisingly is doing better. And this is not just for Q1. We saw that even in Q4. Even if you see the TVS numbers which came, they were pretty good, pretty solid. TVS is more of a bit of a turnaround story also in terms of capital allocation, margins, the iQube story on the EV side and presence in different terrains. I think even if you see the M&M numbers, that pointed to a broader recovery in farm equipment and tractors. And today we saw Escort, Abota also, showing some margin increase. So I think, and this is the data we've been discussing, that whenever monsoons are 5% above normal, the agriculture GVA tends to be around close to 5%, which has been around anemic 2-3% now for almost 2-3 years. So August good news as well. I think the only thing which is now concerning the market is more urban consumption. So rural is actually making a bit of a comeback. Early signs, but pretty positive.
Okay, so we need good news, and maybe some is coming in, like Gurmeet is saying, on the rural side at least. Some of these two-wheeler guys have been reporting pretty decent numbers. Speaking of consumption, is there further light at the end of the tunnel? Well, we've just heard from Marico a while back as we were coming in for closing bell. We got Mangalam joining in. Mangalam, what, 9% volume growth? Doesn't look bad, right?
9% is the highest that we've seen among the large companies that have reported when it comes to Marico's volumes. But importantly, remember, the street was prepared for that, and which is why the stock is holding on, and it was at close to 52-week high before numbers. The street had already sussed out these numbers from the first quarter update that the company has given. So largely in line. If you look at it, the revenue is 3259 crores. The street was working with a number of 3270 crores. Volume growth at 9%. The street was working with a range of 8 to 9%. EBITDA at 655 crores. The poll was closer to 665 crores. No problems out there as well. And net profit around 500 crores as well. Largely in line. The only thing we need to watch out for going forward are the margins. Why do I say that? Because gross margins declined by 530 basis points. There's been a sharp inflation in their key copra prices, 18% quarter on quarter, over 100% year on year, and that will remain the key monitorable going ahead. Parachute rigids declined volumes by about 1%, and this after a 31% revenue growth, telling you how raw material prices have had an impact on their main business. Value-added hair oils grew well. That was a positive. Saffola also saw a mid-single-digit growth. So what is it that led the volume growth this time around? It was foods and their new businesses. The company has been diversifying in the past itself. What they've said is that the impact of unprecedented margin headwinds will peak out in the first half, and the second half we will see margin improvement. They will sustain positive volume and revenue growth momentum through the year. So demand from a top-line standpoint, no problems. Margins remain the key monitorable.
Interesting. Foods business for Marico. Mangalam, before we let you go quickly, since we're on the subject of FMCG, and I remember you said green for ITC in the morning, despite that huge margin decline, right? Stock's actually showing a shade of green right now. Again, the read-through in terms of just overall growth and pickup, is it positive from ITC as well?
It is a positive from the ITC management as well. They've said that urban consumption has seen signs of recovery. In fact, across the board, right from HUL to ITC to Marico to Dabur as well, said that there has been a pickup in urban recovery, even as rural remains resilient. The more important part is the next couple of months look a lot better from a demand standpoint, largely because one, monsoons have been good, so rural, there's little to worry about. And the steps that the government has taken with regards to spurring consumption have also, some fruition to bear over the next couple of quarters. The only monitorable from here on would be how the raw material prices pan out, but that sort of volatility and margin compression may perhaps be in the price given the underperformance that we've seen from the FMCG stocks. So which is why top-line growth is something that the street is factoring in, and that's what has caused the FMCG index to actually rally about 12% from lows as well. For ITC in particular, the margin miss came in on account of high inflation in leaf tobacco prices, which the company believes that this season has a lot lower prices, so they've exhausted their high-cost inventory. Going from here on, margins are likely to improve in the tobacco business, so that's a positive, and that's what the street has taken forward as well. Cigarette volume growth of upwards of 6% is at a multi-quarter high. So the top line, more important than the bottom line.
Absolutely, take that point. Thanks very much for that, Mangalam. Very quickly, Gurmeet. So like you said, there are signs of rural recovery picking up. The question is, which stock will you play through? Some of these FMCG names, two-wheelers, something else. What are you buying?
So, if you see in FMCG, for example, Emami and Marico reported good numbers. Tata Consumer was, I think, slightly above average. Even in Marico, if you see now, the food business crossed 900 crores last year with like a 30% plus growth. This year also they are talking of 25% growth, and largely led by Saffola, Saffola oats, soya chunks, etc. So there's a bit of a difference happening. Companies in BPC, more in skincare, they are facing a lot of competition from a lot of startups and local players. And companies which have a better food business and more rural reach tend to do better. So got to differentiate there. So we are looking at Tata Consumer and Marico in terms of FMCG names. We have added some fertilizer stocks, some crop protection names like Coromandel. Fantastic set of numbers. Continues to do well, industry leading margins. We have M&M in the portfolio. We are also looking at in terms of some two-wheeler ancillaries, both two-wheeler and four-wheeler ancillaries in the portfolio. So this is where we are paying the rural recovery. But in general, if that market recovers, it has a broad-based cascading effect overall, because urban consumption, in my view, can be fixed earlier. Rural is more difficult to fix.
Okay, let's now talk about ABB. That's been the sore point today. It slipped in trade after reporting a weak set of numbers. Margin contracts, order inflows, all have come under pressure in the first quarter. Vamakshi joins in with the details.
Well, Rima, a weak set coming in from ABB this time around. Keep in mind that the revenue saw an uptick of almost 12% on year-on-year basis. This is more or less in line with what the street was anticipating. But operationally, it has been a very, very weak quarter for the company. Keep in mind that the cost of goods sold were up almost 21%, outpacing the growth in the revenue, which is why the gross margins came under pressure, down almost somewhere around 462 basis points. Apart from that, the EBITDA margin too saw a sharper fall of almost 600 basis points. Keep in mind that this time around there were some forex losses as well as some one-time expenses given a project execution topic, and therefore the margins came under pressure. But the management said that if we keep this aside, the margins could have adjusted for these one-off could have been at around 16 to 17%, which is still low as compared to the 18 to 19% that they've reported in the past. The net profit this time around declined by almost 21%. Let's look at how the different segments performed as well. The robotics and discrete automation segment saw the highest growth so far, 180%. This has outpaced what the street was expecting as well. On the other hand, electrification did decently well, slightly above estimates, but motion and process automation have come in lower than what the street was anticipating. The ordering activity too was quite weak. The order inflows have declined by 12% on a year-on-year basis. This is only the second instance that we've seen in the last 10 quarters where the order inflows have actually declined for ABB India, so that's important. And the order backlog, on the other hand, saw an uptick of only 6%. The order book now stands at 10,064 crores. Now, what they've also said is that the board has approved appointment of a registered valuer to carry out valuation of the robotics business. They have given a nod to incorporate a wholly owned subsidiary which will house the robotics business, and no decision has been taken on the divestment of the robotics business to the parent company or any third party. Overall, a weak set of numbers, commentary coming in from the management also slightly tepid, and resultantly the stock is out in trade today.
That there is a delay of decision making in the process automation area, and also around this year we had fairly large orders in the traction area from railways and in the metros specifically, so which is not matching in the same quarter. So on a relative basis you will see there's a decline there. So otherwise we find that the market at a base level is pretty solid and robust, but at the same time there's a sluggishness in decision making at this point of time.
ABB follows a very sort of a conservative accounting standards, and we took all the impact on the P&L. So I think that was 56 crores, and the other one-off which we took on account of an project execution topic which we need to deal with was 39.5 crores. And I think if you adjust to this, we are in that range of 12 to 15%, which we already mentioned. EBITDA margin, you could add another 4.5% to that, and we would be there under 16-17% over there.
That's the word coming in on ABB. Gurmeet, is ABB, I think the company also spoke a little bit about robotics and how they're incorporating that. But Gurmeet, any thoughts on ABB? Is that a part of your portfolio? Are you looking at it?
Not currently, but as I said, any miss, because the stock is very richly valued, almost 50 times EV by EBITDA, almost 55 times on trailing basis. Any miss, there will be some reaction from the market. I still think 5% is not much, but in case there is more correction, happy to look at it. I think as your colleague pointed out, the big trigger could be some unlocking on the robotics business side, and that part of the business also seems to be doing well as far as the quarterly breakup is concerned. Right now we are more positioned in L&T. We have some power equipment names like in Rectifier, and we are tracking a few more names, in power equipment space. That's the space we are anchored to as far as capital goods is concerned.
Okay. All right, Gurmeet, shorter conversation today. So many earnings to go over, right? So quick one today, but thank you so much for joining us this afternoon. Well, with that, let's move on. By the way, I think Shree Cement numbers also flash. We'll get them back on the screen from first glance. It seemed like the volume number was a little lower than Nigel's estimates. We'll get back to it in just a minute. But we do have Nimesh now joining in. He's been taking a look at the latest view coming in from Morgan Stanley. Rhythm Desai says he's still very bullish on the market. Nimesh, thanks for joining in. So Rhythm, I think, is this day and age's biggest bull on India, right? What's he saying now?
Well, absolutely, and again, in this current environment of such a big doom and doom, with so much of uncertainty with regards to US tariffs and everything, to come out and say that expect re-rating of Indian equities, which is on the anvil. That's the headline from Rhythm's note, and he says that get ready for new highs in months ahead. So that's a real bold call coming in from Rhythm Desai, and he's been bullish, as you rightly pointed out. Now the rationales. Now the key rationale is he believes that the immediate prospects depends on the confidence of growth cycle, and there Morgan Stanley is little ahead of everybody else and ahead of the consensus as well, and they seem to be quite confident that this is going to come. In fact, even on the earnings part, while we've seen a soft patch in terms of earnings starting from second quarter of FY25, that he believes is coming to an end very soon, and market is not yet pricing in. So the big thesis of being bullish is that he expects big earnings upside from coming quarters. So that's a key call from Rhythm Desai. Now in terms of sectors where he's bullish on, his biggest bet is on domestic cyclicals compared to defensives and external facing sectors. In terms of sectors where he's overweight on financials, consumer discretionary and industrials. He's otherwise he's underweight on energy, materials, utilities, as well as healthcare. And he believes that from here on it's going to be more of a stock pickers market. So bet on stock specifics, but to say that re-rating is on the anvil and expect new highs for the Indian markets in the months ahead, that's really a bold call coming in from Rhythm Desai.
Absolutely, and I mean he remains steadfast. I think his confidence is unwavering and remains very, very optimistic on the prospects of Indian equities. Thanks for bringing that up back on the table, Nimesh. We'll come back to you in just a bit for the street chatter. We do have to take a very quick break, but as we do that, here's a reminder to all our viewers. You can unlock a world of exclusivity, expertise and influence. Become a member of CNBC TV18 Access, our premium members-only experience on CNBC-TV18.com. The membership includes access to CNBC TV18's flagship events, interaction with our journalists, along with curated studio tours, e-learning sessions and masterclasses, and curated lifestyle benefits. Welcome back. So the market's been holding on 157, 158 points up on the Nifty right now. As always, it's been a very, very busy day, of course, for earnings as well. But as always, Hormaz is here with the buzzers, earnings and beyond. Let's take a look at what he has on his board today. Hormaz, over to you.
Well, some interesting names coming up. Firstly, from the IPO space, we have JSW Cement's issue opening later this week. And in light of that, Shiva Cement saw a very sharp spike just a few minutes earlier. The stock was up almost 9% and has now cooled off from those levels. But the volumes have seen a bit of a spike as well. Almost 7.5 lakh shares have already been traded on the stock compared to its 20-day average of just over 2 lakh shares. So that's a volume mover and a sudden one at that. Endurance Tech is the other one on the auto ancillary space. That has snapped a 2-day losing streak today, 7% higher on the stock, and volumes 7 times of its 20-day average at 3.5 lakh shares compared to just 50,000. And this is the third straight year when the stock is delivering positive returns, at least as of now. On the downside though, Advanced Enzymes has snapped a 5-day gaining streak, was up every single day last week, seeing some profit booking today. It's the biggest single day fall, this 8.5% one is since November of last year, and we have already had 15 lakh shares traded in over the compared to a 20-day average of just 4 lakh shares, and in 4 out of the last 5 years the stock has delivered negative returns. Now, Neogen Chemicals was an earnings reaction as well. Last week came out with numbers, is down almost 6.5%, and 6 out of the last 7 sessions the stock has been lower. And not a very highly traded stock. It's 60,000 shares traded so far compared to a 20-day average of 15,000, and it's already down 35% on a year-to-date basis, which is the worst calendar year return since it listed almost a decade ago. And there seems to be no respite for Dream Folks, and it's down for the 6th straight session today. Now, almost 1.5 lakh shares traded compared to a 20-day average of 6.3 lakhs. So this fall is coming on lower volumes in today's session, and from its 52-week high of almost well over 520 rupees, the stock has corrected well over 75% from those levels. So no respite for Dream Folks, but there are some earnings reactions on the positive side as well.
Okay, absolutely. Dream folks, dream not so great, at least for the time being. Thank you for that. Always an interesting list to look at, Hormaz. Well, let's welcome in our next guest on the show. Sunil Kaul, Global Emerging Market Equity Strategist at Goldman Sachs, is joining in. And like I was just telling you from Sunil's latest note, some of the headlines on earnings, they perhaps look not that negative. Sunil, great to have you on. Thank you for joining in. As we started the show, I was just giving viewers some of the highlights. I mean, out of the 90 MSCI India companies that have reported, you point out in that note that 39 companies have beaten estimates, 44 have missed estimates, and the misses are not like by a huge margin. They're like 1-2% misses. So that gives a sense that, yes, this has been a subdued first quarter, but not a washout one. You tell us, what's your summary of the earnings, the management commentary, the read-through so far?
No, I mean, you're right, Surabhi. I think the numbers are holding up much better. I mean, to be fair, I think they're in line with what we and the consensus were expecting. I think we sort of came into the year thinking that earnings growth will be 10-11%. And so far, I think that's what it is tracking, around 10% year-on-year profits up for MSCI India as a whole. I mean, there have been sort of some, as you said, at the margin, a little bit more misses than beats, but on average, this is like 1-2% misses. So we would say it's largely in line so far, but it's kind of in line with expectations. And that's something we are seeing broader across the region, which is like consensus expectations have been sort of generally low, and the numbers are coming in sort of in line and meeting those expectations. So India, I think in that sense, has been kind of in line. The other bit, which is more important, you mentioned in terms of management commentaries, I think there is generally sort of more confidence we are getting listening to the commentaries that people are feeling more confident about the consumption recovery. I mean, I think there are at least 3 or 4 large FMCG companies that have reported that they are seeing slightly better mass urban consumption picking up, and I think that's an encouraging sign. It's not sort of broad-based, to be honest, at this point. I mean, in terms of the consumption categories, we're not seeing it as much in autos or durables or paints. But staples, for sure, I think so far it's been encouraging, especially the mass, urban, low-ticket item is clearly kind of seeing improvement, which has been our expectation. And it's good to see that coming through in the earnings season so far.
Okay, so that's great news. I mean, it's great news. It's a great silver lining to an otherwise very cloudy market sky, Sunil, because the market has been testing investors' patience, right? And there's very little good news. There's tariffs on one hand. We'll talk about that in a second. But what you're saying in terms of some, shades of recovery, mass consumption, etc., what does that? I mean, where does that leave us? So, is this an earnings pivot? So, should one be prepared for a much stronger second half and therefore maybe a market rally resuming? Or does this just mean that at least we have a bottom in place? So maybe a couple more months of time consolidation.
I think clearly the latter. I mean, it has been our expectation, Surabhi, as you know, I think last time as well, is that we are calling for an earnings cycle to bottom out a couple of months back, and we did expect the second half of the fiscal to be stronger. And I think, as I said, it's encouraging to see that view is starting to pan out. I mean, to be fair, multiples are expensive. It has been for a while, but it's very little. But I mean, in terms of our return expectations, we don't think the market can have further multiple expansion from current levels. And in that standpoint, earnings becomes the critical fuel for the market if it has to make more gains over the course of the next 12 months. And in that sense, the earnings cycle being bottoming out firmly and possibly seeing recovery in the second half would be a good sign.
But that means, again, since you said it doesn't necessarily mean multiple expansion, what does that mean for overall, market price action? 5% flat, or just, go back to old highs? That's the best case scenario for this calendar year?
Look, I mean, in terms of our expectations, we are baking in 27,000 on Nifty on a 12-month basis. So that will take market to new highs. But that's from current levels, only 9% upside. And our earnings growth numbers are roughly around 11-12%. So we are baking in a bit of multiple compression in our numbers. But if you are right that the earnings do grow low double digit, that should take market higher over the course of the 12 months. And so we do think market goes back to highs. But I think the near term, we'll probably come to tariffs in a bit. But near term, it's going to be a little bit sort of challenging given sort of the news flow around tariff. Given not that great seasonality, not specifically for India, but for broader markets. And that probably means for the next few months, the market kind of range bounds in here. But as we get into festive season, we get sort of more clearer signs that things are kind of picking up. You could see a rally into the year and further gains there.
Sunil, now on the global piece as well, and I'm curious to know what you've been hearing from a lot of the conversations that you have, international clients as well. Because first it was the US market was, doing so well that you didn't want to go anywhere else. And then again, it was the US continued to do so well despite all the tariff headlines. And now the US is not doing well because of, let's say, the job report on Friday. But again, the futures are up because now you'll hope that the Fed will start cutting. So again, you go back and buy US assets. So this whole US exceptionalism, so far it's not ended. We've paid the price in terms of, lackluster FPI flows. What do you see ahead next couple of months?
Look, I mean, I would sort of push back on that a little bit in the sense that, yes, the US market has had a few sort of exceptionalism early in the year. People thought it's dead, and now sort of markets have gone back to all-time highs. But I think if you look at emerging market as a whole, we have had a pretty strong run despite kind of US equities going back to highs. I mean, emerging markets have rallied sort of 15% in the first 7 months of the year. That's the strongest it has done in terms of January to July performance in the last 7-8 years. FII flows, to your point, I think from the April lows, we have seen close to 40 billion come into the broader emerging markets. And obviously, India has been a bit laggard, partly to do with the fact that sort of growth was kind of still slowing and earnings were still in the down cycle, partly because of elevated valuations. But to say that because US has gone back highs, the entire exceptionalism story is kind of come back in terms of your assessment, I think that's not entirely true. I think from our client conversations, we continue to see a lot of interest from clients trying to diversify away from US and trying to build up broader emerging market exposure, which is why if you sort of look at the flow data broadly, it's been 10 weeks in a row where emerging market funds are actually seeing inflows. And so I think we continue to see, therefore, momentum of people diversifying. India, unfortunately, hasn't been a large sort of gain from that trend. But we still believe that overall money will continue to come into the emerging market as a whole, and some of that will also trickle down into India. I think as the fundamentals improve, that should get us further inflows.
Yeah, that was the second part of my conversation, that even when people have diversified away from the US, they've been going to South Korea, and there's always the China question because valuations are so great there. But now with the kind of earnings that we just discussed, I mean, in the first part of our conversation, if we don't have more earnings disappointments, then do you expect FPI flows to pick up?
Yeah, we would certainly think so. I mean, I think for India, it is a growth story. I think given where multiples are, we do need, and that has been our view all along, we do need sort of earnings growth to come through. And I think now we're feeling a little bit more confident that that is coming through in terms of consumption recovery, and that should be the fuel for FPI flows to come in, market to do much better in the second half of the fiscal as well.
Okay, so let's come to the portfolio call as well, Sunil. And I mean, you put out that stock-specific sensitivity analysis as well, because we have this tariff situation to deal with. And let's start with pharma, because on your list, obviously, there are a couple of pharma companies that are most vulnerable if we get further news. So from that respect, have you made any significant changes to the portfolio construct because of this whole tariff situation?
I mean, we have not made any major changes to the portfolio or the sector allocations. I mean, we have made some changes to our sort of headline numbers, both in terms of growth and policy. I mean, just to sort of make sure we're on the same page, Surabhi. So after the tariff announcements, we did shave India's GDP growth numbers a tad, sort of 20 basis points for this year, 10 basis points for next year calendar. So we're now looking for India growth a little weaker in terms of 6.5%. But at 6.5%, it's still going to be far greater than many other sort of economies around the world. And a large part of that is not because we think, I mean, these high tariffs will remain. We do think that there is a scope that they will be negotiated lower, as is the case with many other large trading partners US has had. But it's more the impact of uncertainty over the next few months till we get through that, which is we are baking in our numbers. We have also penciled in one further rate cut in our numbers in Q4. We don't think the RBI cuts in the August policy, but we do think that in Q4 there is a chance for RBI to cut once more. So that also would be helpful for equity markets. And then I think from the earnings standpoint, we already had baked in some impact of around 15% reciprocal tariffs, 25% on pharma. So that was already in our numbers, which is 11-12% earnings growth I mentioned. So we haven't made any incremental changes. But I would say, depending on where the final numbers land, every 5 percentage point higher sort of tariffs on India does put roughly sort of 1 to 2 percentage point incremental drag on EPS. And obviously, the sectors that are most impacted are the export sensitive sectors like autos and pharma and sort of industrials and chemicals as well. The way we sort of look at it is not the direct first order impact, because if you sort of looked at goods exporters, only 4% of the exposure is to the US and demand. Only 2% of the MSCI India sales actually comes in from the goods exporting sector. So the direct hit is actually not that huge.
Correct.
It's the second order impact from growth slowdown, which will impact some of the sectors, which is what we are kind of baking in. So the sensitivities I just mentioned is kind of combining the first order as well as the second order.
Got it. So Sunil, finally putting it all together, all things equal, tariffs, expectation of RBI cuts, etc. Right now, which are the top overweights and where should the money go? Is it financials? So you mentioned consumers and the pickup in commentary on the consumer side as well. So just tell us top overweights.
Yeah, I mean, the reason we didn't make any changes in our allocations is because we have been overweight consumption pockets, sort of staples, bits of discretionary, autos and financials, and we have been underweight export sensitive sectors like pharma, as well as industrials, for example. And I think that trend will continue. I think the market has started to price that already in the last sort of month or so, wherein we think both sort of consumer sensitive sectors plus financials do much better than sort of exporters and the industrials, which also get impacted because of some export exposure, but also the ongoing uncertainties. And I think that sort of divergence within the market will continue in the near term.
Okay, all right, Sunil, great conversation as always. Thank you so much for joining in and giving us a complete perspective on all the moving parts, including tariffs, the impending RBI policy, and of course, how earnings season has played up. And not too bad if you go by how Goldman Sachs is reading the numbers and the trends. Thanks very much for joining in. Well, with that, let's shift the focus back to the market, which is actually having a great start to the week. I mean, it's bulls in control after a long time. We've got Mangalam back, and he is looking at the F&O Qs of the afternoon. Mangalam, what are you picking up?
Bulls in control. The market's at the high point of today's trading session so far. The important part, however, is that, it's done that in absence of the Nifty bank. So if you look at the key indices, you have the Nifty, which has moved higher, 24,700 plus. You have the midcap index, which is up 1.5%, making your portfolios feel a lot better. But we have the Nifty bank, which is marginally in the red. So what is it that is taking the index higher? We have the metals pack and the auto pack, which have been doing well for the first half of trade. And thereafter is the IT pack, which actually, suddenly woke up from its slumber in the second half so far and has currently surged higher, 1.5% higher on that index. And that has taken the Nifty upwards of that 24,700 mark itself. India VIX, in the morning we were talking about how it spiked to around 12.26. Now it's cooled off. So that is a better sign for the bulls because you don't want the Nifty moving higher with the VIX moving higher. The Nifty's moved higher and the VIX has actually cooled off from the highs. So that's a positive. VIX cooling off from the highs tells you that there is put writing which is taking place. What does that imply? Support is moving higher. This morning, the 24,600 put was fairly well bid. Now, we have the 24,700 put, which is higher or which is seeing a fair amount of writing in terms of open interest. So a premium of 100 rupees on the 24,700 put tells you the support for the Nifty has moved higher from 24,500 to around 24,600. Though on the way up, 24,750 call writers, for them to feel jittery, the market has to sustain at these levels, and that could lead to a further short covering pop. Though the important part for the bulls to track from here on would be the range between 24,850 and 25,000. That's where, there have been congestions in the past, and there is the technical, 20 and 50-day moving average up at those levels too. The put-call ratio has moved from extremely oversold levels of close to 0.7, 0.75 to 0.95. That is good news for the bulls, and a lot of stocks are moving around as well. Post numbers, AB Capital saw a lot of long positions being added, so that's one stock I'm keeping an eye out on. The other one is Manappuram Finance, which too is up 7% in this market at a time when financials are not doing well, with a lot of long positions being added on Manappuram Finance. So looking very good from a bull standpoint, more so in the second half of trade so far than what it was in the first half.
Thank you very much for that. Slip into a break on that note. We'll come back and get you a check on what dealing rooms are saying in our segment D Street Chatter. We'll also get you a few BTST calls from our technical experts.
investing.
Welcome back. Still holding on to that 24,700 mark, 150 points higher. But let's get a sense on what's happening in the dealing rooms and what the chatter is. Nimesh is now joining in, as always. Nimesh.
Hi, Rimana. A decent pullback, and I guess it's largely from an extremely oversold levels. The PCR at close to 0.7, 0.75, the long-short ratio at almost 90% on the short side. It normally indicates a bit of a pullback, and that's what is played out in today's market. So large part of the rally seems to be more of a short covering rally, especially in the F&O names, and we can see the big moves in those stocks today. From a flow perspective, again, a mixed day with a negative bias. So my sense is there's going to be a small MOC sell basket at a leading FID. So last 30 minutes, you can see some reactions in some individual names today. In terms of sector which are helping to pull back, IT, financials, and metals are the sectors where you're seeing a pullback, and that's helping the Nifty to hold on to the current levels. From a technical point of view, I guess 24,350 is a level to watch on the downside. If that gets taken out, you could see further selling pressure in days to come. But on the upside, 24,950, 25,000 is a big resistance as well. So we've been in this range for a while now, and looks like that's going to be the trend. It has to break on either side for a decisive move. But for today, the sense is the pullback seems to be largely from extremely oversold and thanks to short covering in many of the F&O names.
What about stocks?
So the first stock on my list is PSP Projects. That stock is down 13% last I checked and on very large volumes. I guess the numbers were weak, but again, there is an anticipation of a large block coming in PSP Projects very soon. So that's the first stock. The second couple of PSU names where there is delivery-based selling, SBI and GAIL, both stands out in terms of very aggressive selling from larger FIs in today's market. Surprisingly for SBI, while there is selling, there was an upgrade as well from HSBC over the weekend. And the last is Indian Hotels. Small buying has emerged after the recent correction in Indian Hotels. So expect high delivery volumes, and I understand some domestic mutual funds have started accumulating Indian Hotels at current levels.
Thank you very much for that. TBO Tech seems to be slipping post the numbers. The company's delivered a revenue growth of 14.5%, but margins have come under pressure. Margins are down to 14-15% compared to about 18.5% in the prior quarter. So the stock is under a bit of a pressure. And even the revenue growth of about 22.5% is less than the kind of revenue growth that it had last year, which was nearly about 25%. But Q1 was a tough quarter, with the India-Pakistan, and generally there was so much upheaval with Turkey. And maybe as a travel platform, TBO Tech also got impacted. But margins, 14.5% versus 18.8%. Mitesh is now with us with a few, BTST calls. Mitesh?
Yeah. I think Grasim and Pidilite are the stocks which are on radar. Pidilite, I would recommend taking a BTST with a stop just below 29.35 for targets of 29.80-85 for tomorrow. And the other one is Grasim, as I said, take a BTST here with a stop below 2775 for targets of 28.15-20.
Thank you very much for that. Let's get to Ather Energy. Very strong top-line growth reported, more than 70%. The stock today is at about 386. The issue price was 321, so comfortably above that. But for a fine print on the numbers, Sudarshan now joins in.
It's a steady set of numbers from Ather Energy for Q1 of FY26. If you talk about the bottom line, losses have narrowed not only sequentially but also year-on-year. Loss in Q1 FY26 has come in at rupees 178 crore versus loss of 183 crore in the same quarter last year and versus rupees 234 crore in the last quarter. So sequentially as well as year-on-year, losses have narrowed. Second parameter is revenue. It was led by healthy volumes that company has seen. Sequentially, volumes have increased by 1 to 2%. But if you take a look at YOY, volumes have increased by more than 2.5 times. That has helped basically big surge in the revenue, where revenue has grown by almost 80% year on year. Now, coming to EBITDA loss also, this quarter, it has come at rupees 134 crore versus 127 crore in the same quarter last year. But on a sequential basis, even EBITDA losses have narrowed. Now, recently, even two brokerages had come out with a note. Nomura and HSBC, both brokerages had initiated coverage on the stock. And even from current levels of around rupees 380 to 385, they are expecting an uptick of almost 20%. But as far as earnings are concerned, very steady set of earnings from Ather Energy.
Thank you very much for that. Anand Tandon is now joining us on the show. Anand, broadly, How has Q1 shaped versus your own expectations? Because we were just looking at the Motilal Oswal estimate. They're saying out of the Nifty earnings so far, the actual growth has been 7.5% versus their own estimate of, I think, 5.7%. So not bad all in all, Q1. For you, which were the standout performers, and have you been making any investments based on the earnings performance and the expected trend?
Well, I think what has happened is that this year the earnings expectation were a little more muted, even though if you look at the expectations in January versus now, the consensus earnings for Nifty were supposed to be growing at 50%, and now they are in mid-single digits. So there has been a sharp deceleration in the expectations. The challenge I see is that while most people are saying that the next quarter or the second half will be better, we are also looking at a situation where most of the fast-moving economic indicators are showing a slowdown, given what we are seeing in the macroeconomics and the global markets. And more importantly, if you assume that the inflation trajectory remains low, you will also see a slowdown in the nominal GDP, which will automatically mean that if you've got, let's say, a single-digit nominal GDP growth, it is very difficult for corporates which are growing, let's say, at 10% to actually show very high profit growth. So net-net, I would imagine that, depends on where you started from. You would expect to see only a single-digit earnings growth on the Sensex companies even in this current year, which means that, with the kind of valuation that we are at, we are still somewhat stretched. Now, if you look at where the numbers are, clearly, for example, two-wheelers have done better. And while one is attributing it to rural recovery and so on, it does look like it is a higher priced items which have done reasonably well. And of course, in the case of Hero, also been helped by a sharp increase in EV sales, etc. So there are pockets which have done reasonably. But overall, I don't see a major difference between what was expected, at least for the first quarter. And I think the street is still ahead of expectations in terms of factoring in the kind of slowdown that we are seeing in the economy for the full year.
Okay, all right, got that point. Stay on with us, Anand. We'll have more questions in just a second. Let's look at more stocks that are catching the eye this afternoon, and AB Capital is definitely one of them. It's up almost 9-10% after the first quarter numbers came out. Let's take a look at the fine print. Gaurav is here with the details. Gaurav, what's the buzz? Big performance from AB Capital, the stock that is at least.
Well, yes, when we look at AB Capital, we saw strong performance, and this was across the business segments. So first, let's look at the consolidated numbers. Net interest income there increased almost by 14%. We saw operating profit increasing just by 10%. But on the other hand, when we look at profit, that increased almost by 13% on a year-on-year basis. And this was because of the strong asset quality that the company showed. When it comes to AUM, there also we saw a very big positive surprise because it grew almost by 22% on a year-on-year basis. And this was specifically led by business loans, which grew almost by 25%. Even in this business loan segment, the secured segment is something which drove the growth. And at the same time, when we look at disbursements, there also we saw 18% of a growth on a year-on-year basis, which was not anticipated by the market. Specifically from the segment-wise, when we look at the NBFC segment, now net interest margins, they have declined almost by 10 basis points. We saw a little bit of uptick in credit cost, but even after that, we saw ROA is actually improving, and this was because of the cost efficiencies that the business shown. For housing finance also, the ROA is increased almost by 15 basis points on a sequential basis, and specifically from the AMC business, they delivered profit growth of around 17% on a year-on-year basis. So definitely a strong set of number across the business segments, and as a result, we saw the stock performance also, it hit its upper circuit, and even after that, we saw the stock was soaring up in trade today.
Okay, all right, Gaurav, thanks very much for that. We'll, of course, keep that on the radar. AB Capital definitely doing very well in today's trading action. Take a quick break. We'll come back with more in just a bit. And a reminder here, do remember to tune in to the all-new CNBC-TV18 Prime lineup, bringing you insights from policymakers, business leaders, and economists shaping both the world's and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC-TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and at 8:30 p.m. we bring you the Global Lens.
Welcome back. In conversation with Anand Tandon, and we've got about 5 minutes to go before we wrap out on what's been a good trading session for our markets. We've rebounded from last week's levels, 160 points up on the Nifty right now. Anand, ABB is the big miss of the day. We've seen the shares decline. In fact, they've plunged close to about 6%. Net profits are under pressure. The street is going to watch out if that monetization comes through. But ABB, what is your view?
Well, all that entire sector has a good order book and so on. So there is nothing particular that you can argue other than the fact that all of them are extremely expensive. So if there is any kind of miss, you should expect to see volatile reactions. I think the more interesting set of results were from the logistics space. I mean, if you look at the ports as well as some of the logistic companies, they have done, perhaps better. Now, the only question is whether it's sustainable or whether it is a reaction to a possibility of some kind of trade impact, and therefore people having accelerated movements. But if it is something that sustains for a long time, that could be something that could be interesting.
So which ones? In the ports, is it Adani ports or is there any other play that you would look at?
Well, there aren't that many private ports that one can look at. Clearly, Adani is by far the biggest, so that would be something that would be worth looking at.
In the past, you've looked at the textile space very closely. Now, the tariff situation has questioned India's competitiveness versus some of its neighboring peers. What is the call now on Indian textile makers?
I don't think it's substantially any worse. I mean, at the end of the day, Bangladesh, for example, always had a better positioning vis-a-vis India. And now that has come back to the same kind of levels. The only challenge now is that Bangladesh itself is going through political turmoil, so that may be a much less attractive place for people to be buying stuff because there will be likely disruptions in the supply chain anyway. So from that point of view, I would argue that there is still an incremental benefit to India, given the more stable outlook that you have from the market here. However, the tariff advantage that one was looking to get perhaps may not play that important a part.
So is textile a part of your portfolio?
Well, I mean, it's something that is not something that makes a huge amount of money. So it's not necessarily that I would be buying any of those stocks. But as a sector, from an allocation perspective, maybe you could look at that as a potential investment opportunity.
Anand, the IPO market is also fairly active. The Knowledge Realty Trust, so a REIT is opening tomorrow. It's sponsored by Blackstone. So that issue opens tomorrow. So today we had the JSW Cement holding their press conference. The valuation is approximately 20,000 crore. Have you been participating or would you advise participating in any of these IPOs?
In general, I think IPOs are always overpriced. So one should be really careful about which ones one wants to be participating in. But then rather than looking at just IPOs, there are any number of companies which are already listed in each of those spaces. So it is perhaps as good as if you really like the space, you might as well buy something that is existing. There is hardly any valuation gap that exists nowadays from the IPO to the secondary market. Why take the risk on something new?
So tell us some stocks that you like now.
Well, that's a difficult question for the simple reason there isn't anything in the market that looks undiscovered or cheap. By and large, the market is more than fully priced. So it's now a question of whether or not you are willing to look at a 2-3 year time frame and therefore are really betting on something which the market is not willing to price in today. Even if you were to take that view, I would imagine that many of the stocks that would be looking at, for example, you look at the Swiggies and Zomatos of the world, for example, which are local favorites. The chances are that you may find that the growth there may actually even off and perhaps slow down. So some of the valuations may be a bit more challenging. At this stage, I think the best way to play the market is just ride the momentum and be invested in a broad set of sectors.
Okay, all right. Well, we'll take that advice on board. Thank you very much for that, Anand. Good conversation as always. Thanks for taking us through today's action and a lot of the interesting stocks. It's been an interesting day. It's been a good day, actually, for the bulls. You'd have to say after a very, very long time, they've managed to see green and they've managed to hold on to green. And look at the screen right now. It's a trending up day. I mean, not too much, but 160 points, ending pretty much at the highs. And the mid-cap screen is looking even better. Look at the mid-cap index. It's up about 1.5%. And the advance decline ratio finally in favor of the advances today. So let's recap what's been a very solid session, particularly for the broader markets. On the Nifty, actually, if you look at the gainers, Hero Moto charging away with those solid numbers, monthly sales numbers coming in, looking very, very good. 5% up on that stock. Some of the global-facing metal names like Tata Steel and Hindalco, they did well today. Tata Steel was up 4%, Hindalco up 2.5%. Then you had names like BEL, which had takers. Actually, on the metal side, I didn't mention JSW Steel. Should take that in as well. Very strong day for metals today. 3% up on JSW Steel as well. Then there was some buying in tech names. HCL Tech, Wipro, TCS, Tech Mahindra, coming back from beaten down levels. Many of these names. And today was not a great day for banks. It was a better day for NBFCs and non-banks. For instance, Shriram Finance, SBI Life, Geo Financial. So the non-banks had green. The banks were actually the only disappointment today. HDFC Bank almost 1% lower. ICICI Bank 0.5% lower. Maybe some nervousness ahead of the monetary policy announcement that comes in on Wednesday. Well has gone, but not a bad day, and even better, Rima, when you talk about the broader market.
Indeed, so many big movers and so many volume-led action seen today. So just to quickly recap some of the closing levels, Sarda Energy 20% up, Peninsula Land 13%, Aditya Birla Capital, very solid set of numbers. Stock is up nearly about 11%. Delivery, again, reacting to numbers, good volume, 7.25% up. UPL, sales, so just adding to that metals tally are some of the non-large cap metal names also. On the way down, you had cuts coming through in a name like PNB Housing. Well, the bell is gone, and we're wrapping up a good start to the trading week with the Nifty at 24,726. Don't go anywhere. On the other side of the short break is Markets Forward.
Looks fresh.
No Monday blues on the Dalal Street. The Sensex and Nifty gain over 0.5%, led higher by metals, autos, financials. Keep the gains in check. The Nifty Bank underperforms. Midcaps see broad-based gains.
Two-wheelers steal the spotlight in July, except for Bajaj Auto, Hero MotoCorp, TVS and Royal Enfield see domestic growth of 19 to 25% on a yearly basis. Exports remain healthy for all.
ABB India tanks after reports weak numbers. The firm's order inflow was under pressure. A strong Q1 sees delivery hit fresh 52-week highs. MCX hits upper circuit. AB Capital also gains after it delivers in the first quarter.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear you up for the next trading day. I'm Ekta Batra and with me is my colleague Reema Tendulkar. Well, it turned out to be a good steady day in terms of the gains, and not to mention that we started the week on a positive note. So we had the Nifty, which was up around 157 odd points. What stood out was the entire metals as well as the auto pack, which really led from the front. The broader markets did see some amount of a catch-up as well. So the midcap index ended with a gain of around 1.4%. The advanced decline ratio also in steady state at around 2,500 stocks advancing to around 1,951 stocks declining on the Bombay Stock Exchange. As you can see, there was a crisscross and a widening which took place, giving you an indication of the breadth of the market. So overall, great day, great start to the week.
Indeed, and it also helped that the global markets were also fairly upbeat. So Asia closed with strength, gains between about 0.5 to 1%. And plus, some of the earnings that came through today were on the positive side. And we had fallen so much over the last 5 weeks in a row till last week. Markets were cracking. So in that sense, it was also a rebound from oversold levels. So good day, all in all, broad-based gains. Let's tell you what we've lined up for you on our show today. We start with the top movers and shakers. Hormuz joins in. The stocks which are on our radar today are Delivery, AB Capital, UPL and more. So stay tuned. We'll tell you why these stocks were buzzing. And last and not the least, we'll delve into the key market events to watch for tomorrow's trading session. But on to our first segment of the day, Hormuz joins in. He's at the big wall with the top movers and shakers. Hormuz.
Well, after 5 weeks of intense selling pressure, some respite on the screen, at least for the benchmark indices, and it was the index heavyweights that led the charge today, particularly Reliance Industries and the IT names that were on course for contributing to gains on the Nifty today, be it Bharti Airtel, TCS, Infosys, Reliance Industries, all of them contributing to the gains in today's trading session. Well, there were positive earnings reactions as well that came in from stocks like Ather Energy. That stock was up 16% after its results. There were also positive earnings reactions from stocks like MCX. There were also positive reactions from a lot of other names that reported results. Aditya Birla Capital is a case in point as well. On the flip side, though, there were negative earnings reactions that came in from a lot of these names, be it Narayana Health, be it the likes of a lot of these other names, be it PSP Projects after a block deal. That stock was also down 10% in today's trading session. Well, on the flip side, though, a lot of sectoral movers, the metal stocks were higher in today's session, be it the likes of SAIL, be it the likes of JSPL, Tata Steel, all of them contributing to the gains today. And almost every stock on the Nifty Metal Index ended in the green in today's trading session. And a lot of other rate sensitives as well, barring IT, be it the auto names, be it the real estate names, all of them did well. And lastly, among names that ended at a 52-week high, there were a lot of these smaller names, be it the likes of eClerx and a lot of other stocks that ended at a 52-week high in today's trading session. So all in all, a positive trading session nonetheless, be it for the benchmarks and for the broader markets alike.
Okay, all right, Hormuz, thanks very much for that. So there's a lot of stocks in focus in today's trading session, and definitely a lot of the metal stocks as well as a lot of the stocks were at fresh 52-week highs today. But now let's in fact go across to our guests. We have Anand Tandon, the market expert on the fundamentals, and Jay Thakkar from ICICI Securities joining in to discuss what they made of today's trading session. Anand as well as Jay, welcome to the show. Well, Anand, let's start with you. You know, we ended very strongly, or relatively strongly, you would have to say, for the broader markets. What's your take?
Well, the market is still reasonably robust, given the fact that, the context in which we are investing today is a context where you have a very vocal US president who's completely who loves to make announcements without without any precedent, and therefore it's a very volatile environment that you are in, because many of the announcements have a direct economic impact. So you can't really factor that in, and despite that, the market have done reasonably well, given the fact that you're again looking at an earnings which will be, not more than single-digit kind of growth in the current 1 year. that, along with the fact that the interest rates are reasonably low and therefore are pushing assets into the equity markets, implies that the valuations are a little higher than they should be. And I would imagine that unless something changes dramatically to rattle the market, we will likely remain kind of range-bound situation for the next at least a couple of quarters.
Okay, let's talk about the two-wheelers that stole the spotlight. In the month of July, we've seen some strong sales numbers come through. Hero MotoCorp, TVS, Royal Enfield have all seen a domestic growth of about 19 to 25%. Sudarshan is here with the numbers.
So all the incumbent players, I'll say, so basically there were two news. One, on the basis of July auto sales, all these incumbent players were sharply higher, and Ather Energy reported Q1 earnings, and after the stock has surged more than 10%. So first, talking about all these players which have reported sales for the month of July, and except Bajaj Auto, all the companies have reported a growth even in the domestic segment, while Bajaj Auto had seen a decline of 13%. In the export segment, all the players have seen a growth, and in the export segment, growth was healthy and was in the range of 28 to 95%. So for two players, Bajaj Auto and TVS Motor, contribution of exports is somewhere in the range of 40 to 45%, while for Hero Moto and Royal Enfield, the contribution of exports to total sales is very minimum. For example, for Royal Enfield, contribution of exports to total sales is just 13%, whereas company has reported growth of 95%, so it's not that much. Now talking about the major outperformers in July. So two companies were the biggest outperformers, and those are TVS and Hero MotoCorp. Why TVS? So TVS reported an all-round beat, both in domestic and export segment. Now for Hero Moto, domestic motorcycle segment too has seen a growth, but here growth was below estimates. For scooter segment, growth came in at 64%, much higher than the estimates of 20 to 25%. Now, what about the outlook? So, festive season is approaching, and Hero Moto in its commentary said retail demand has remained stable, and now with festive season, they are expecting volumes to improve further. Now, coming to Ather Energy, it has reported a Q1 earnings, and earnings by the first look very steady. Losses have narrowed both on a sequential basis as well as year-on-year, and the revenue was led by healthy volume growth. That company has reported volume growth of more than 100% if you take a look at YOY. Now talking about the first bottom line, loss was at rupees 178 crore versus 183 crore in the same quarter last year, and versus rupees 234 crore in the last quarter. Revenue is up 80% year-on-year, and even EBITDA loss has narrowed. It has come at 134 crore versus 172 crore that company has reported last quarter. Now, recently, even two brokerages had initiated coverage on the stock. Even from current levels, these two brokerages, Nomura as well as HSBC, see upside of almost 20% from current levels, and that was the reason we saw a big move in Ather Energy in the last hour of the trade after Q1 earnings.
Anand, which one would be your preferred pick in the two-wheeler pack? And is Ola versus Ather, would you have a preference, or would you, it's both, either or, neither?
I mean, it's not as if the two-wheeler market is cheap, but the most consistent performer for quite some time now has been the TVS Group. And while that is also reflected in the price, the numbers continue to develop positively. So if you have to make, imagine that's probably one of the better options. Ather versus Ola, I think Ola is still struggling in terms of being able to stabilize their service levels and their, their quality and delivery and all of that. So in that context, they will continue to lose market share till they get that right. And I don't see the management yet working hard enough to be able to correct that. So, by default, therefore, you're looking at the other if you're looking at the choice between the two.
Okay, well, you mentioned delivery, the word, but we have delivery, which soared over 6% on the back of what was a strong set of first quarter numbers. The firm's revenue rose 5.5% on a yearly basis. Mangalam is here with more details. Mangalam, take us through the key highlights this time.
Well, it's been a strong operational performance for Delivery this time around. Remember, the first quarter is seasonally weak for a company like Delivery or for a business like Delivery. 5.5% revenue growth, no great shakes out there. But look at the EBITDA. It's a near 50% growth out there, 53.4% to be precise. Margins improving by 200 basis points. And as a result of that, the net profit increasing by about 67% as well. It's been driven by a couple of factors. One, on the express parcel business, the volumes have grown by 14%, revenues grown by 10%. Margins, while they've compressed a little bit to 16.3%. The management is confident that in e-commerce, the industry can continue to grow at 15% with them holding on, if not growing their market share, especially after the e-com express consolidation. And they believe margins can be between 17 to 18% by the end of this year. So there is improvement which is likely, and the second half is typically stronger for this vertical. Part truckload, which is where a lot of the operational efficiencies are coming in, 3% margins have turned into 10% as the spot-on integration has taken place, and the revenues have grown by 17% with a 15% volume growth. Here too, the company believes that over 20% growth is fairly sustainable with 20% ROCE, along with improvement in margins all the way between 16 to 18% over the next couple of years. So those two factors doing extremely well for delivery. Going forward, they believe that capex as a proportion of sales will come down as well, and they do believe that their assets will be better utilized, net working capital days will improve as well. So on all parameters, we will see an improvement, which is why after seeing a rally already in the stock, it continues to do well. Just two things I'll keep an eye out on delivery. One is the fact that, as we move higher on the stock, there are a bunch of institutional investors which at every level may at some point exit or look to exit. So that may cause some of the liquidity challenges for delivery. And the second thing that we'll be looking at is how the company copes with one of its largest clients, Meesho, coming out and looking to drive in-house logistics.
Thank you very much for that strong performance. But Meesho as a client for delivery will be watched, especially since they've gone in-house, as he pointed out. But let's talk about Marico. Came out with the Q1 numbers, largely in line with estimates. Remember, in the case of Marico, the company had already guided. They had a pre-quarter release, and they'd given us pretty much most of the numbers. So the key monitorable going ahead will be the gross margins. Revenues for the company came in at 3,259 crore, beating estimates. Volume growth was a strong 9%, highest amongst the peers, but in line with estimates. Profits after tax was marginally higher versus what the street was anticipating. The management said the impact of the unprecedented margin headwinds would peak out in H1. They also expect to sustain positive volume and revenue growth momentum through the year. The stock was up nearly about 2%.
Okay, all right. Well, on to the other stocks in news then. ABB India did see strong profit booking after it reported weak margins and a weak order inflow in Q2 CY25, while MCX and UPL hit upper circuit after better than expected numbers in the first quarter. Ria's here with more details on three of these stocks.
Well, yes, UPL today closed 7% higher, completely reversing its trajectory after it closed about 6% lower on Friday after reporting its Q1 FY26 earnings. Today, we have two brokerages coming out with notes on the stock. First up, Kotak Institutional Equities has a sell rating on the stock with a target price of Rs 520. They've said that Q1 has surprised positively on the gross margin front amid price increases in a few areas, input cost corrections, as well as increased plant utilization. They do say that these benefits may continue for some more time, although their long-term sustainability is uncertain due to demand softness and increased competition. On the flip side, HSBC on UPL has a buy call with a target price of Rs 775. They've said that the muted performance in Q1 FY21 was given the challenging conditions in some markets, and they do say that with a recovery and deleveraging underway, UPL is likely to enter into a virtuous cycle going ahead. Moving on to ABB India, this one was down around 5.5% today after reporting its Q1 numbers. This time around, the margins were weak as well as a weak order inflow as well. Revenue was in line with estimates. EBITDA margins came in at around 13% versus 19% compared on a year-on-year basis. Gross margins also saw a contraction of around 462 basis points, coming in at 38.2% in this quarter. The order inflow declined around 12% on a year-on-year basis, coming in at Rs 3,036 crores. Moving on to MCX, this one was up over 5% today after reporting its Q1 numbers. The numbers were good on a sequential basis but lower than the estimates that we were working with. EBITDA margins are at a multi-quarter high for this one, and EBITDA has improved due to lower employee expenses, and although revenue, EBITDA and EBITDA margins have missed estimates this time around, the net profit has been in line with estimates due to a 12% sequential rise in other income. And lastly, the board has also approved a share split in the ratio of 1:5 for MCX. The last one that was in focus today was AB Capital, up over 11% today after a very strong set of numbers in Q1 of FY26. They've seen strong growth across their business segments. They've reported a strong AUM growth of 22% on a year-on-year basis, led largely by business loans, which went up by around 25%. They also delivered a net profit growth of around 12% on a year-on-year basis, with ROAs improving in housing finance and cost efficiencies in the NBFC segment as well.
Thank you very much for that. Jay, before we get to some of the other stocks, first on two-wheelers, which is the strongest looking chart to your mind?
Well, I would say, Rima, as far as two-wheeler names are concerned, definitely the strongest has been the TVS Motors. I mean, the kind of upward trend is what we have witnessed out there. Also, recently we have seen some short build-up out there on TVS Motors, and we have seen this rally coming on account of short covering, I'm sure, on all of these auto names. But then the stock is trading around its lifetime highs, has been consolidating in a very narrow band, is not correcting much. So this is one stock which I think is a clear winner as far as two-wheeler names are concerned, followed by Hero MotoCorp for the short term, because that was too consolidating in a very narrow band. You can say that 4,400 to 4,000 levels, and that has broken out on the upside. So you can one can superimpose the target of 10% on the upside, which comes to 4,800. So it would be TVS Motors followed by Hero MotoCorp.
Okay, all right. Well, thanks, Jay, for that. Well, let's now go across to JSW Cement, the IPO, which will open for subscription on the 7th of August. The IPO comprises of a fresh issue of shares worth around 1,600 crores and an offer of sale of up to 2,000 crores by existing shareholders and promoters. While speaking to CNBC-TV18 earlier today, Parjindal, MD of JSW Cement, said it's poised for the next phase of growth and aims to quickly become the 5th largest player by capacity. Listen in.
Over the years, JSW Cement has been growing steadily. In 2016, when I took over the business, we were a 6 million ton company. And over the last 9 years, we've tripled our capacity from 6 million to now over 20 million tons. At that time, we were primarily only in the south. Now we've entered the markets of the west and the east. And I think now that the company has grown to this size and scale, we are truly poised for our next phase of growth, which is to enter the markets of the north as well as the central parts of India.
So today, I think you're the 9th largest player by capacity.
Yes, sir.
Can you get into the top 3, top 5, challenge the Shree Cements, Dalmia Cements of the world?
The top 4 players of the country are well out of reach at the moment. And obviously, they also are expanding.
Sure.
I think the 5th spot is up for grabs. And that's the aim, is to try and see how quickly we can get there.
Okay, well, Anand, would you be a subscriber to the IPO?
Like I said, there are other stocks which are already listed. I don't particularly fancy getting into IPOs.
All right, okay. Anand as well as Jay, thank you very much for joining in and taking us through all of your views on the markets. With that, it's time for a short break. We'll get you all of the top corporate voices along with key market events to watch out for on the other side. Stay tuned.
Welcome back. Let's now go across the key corporate voices. So first up is Federal Bank. The management believes the worst is behind them. They added that agriculture and the MFI segment stress peaked in May and that June and July has seen better collections in this segment. They also expect limited impact from the 50 basis points June rate cut. The bank expects NIMs to decline by 10 basis points in Q2, and they expect the CASA ratio to improve further. The stock, remember, was in focus on the back of the Q1 numbers.
That's not all. We had the management of Narayana Health on the channel post Q1 numbers. The private hospital reasons dilution in margins is due to investment in its integrated care business. Adds its integrated care business will break even in the next 2 to 3 years. It highlights multiple cost pressures were faced in the hospital operations and overall across companies, and adds to partly offsetting these pressures. It took a low single-digit price hike earlier in January.
Okay, and before we wrap, let's get you the key market events to watch out for tomorrow. Ria standing by.
Well, yes, let's take a look at the key events to watch out for tomorrow. First up, keep your eye out on the PMI data coming out of India, Europe, the UK and the US as well. In the US, we also have the trade balance data coming out. And in Japan, watch out for the June monetary policy meeting minutes to be released tomorrow. Back home in India, a lot of earnings to watch out for. We have Adani Ports, Berger Paints, Bharti Airtel, Britannia Industries, Exide Industries, Gujarat Gas, Lupin, as well as Prestige Estates reporting their numbers tomorrow. In terms of board meetings, we have Power Grid, KPI Green and Max India to hold board meetings to consider fundraising proposals tomorrow. We also have Knowledge Realty Trust's rupees 4,800 crore REIT issue to open on the 5th of August. And lastly, Hyundai Motor India is also going to trade ex-dividend tomorrow.
All right, Ria, thanks very much for that. With that, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side. Thanks for watching.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Positive start to the week for the markets. Metals and autos lead from the front even as Nifty and the Sensex gain over 0.5%. Midcap see broad-based gains. Government sources say India buying Russian oil is critical to maintaining price stability even as it emerges as an irritant in Washington. New Delhi trade talks add that Russian crude oil has not been sanctioned. A senior Trump aide says it's not acceptable for India to continue financing Russia's war in Ukraine by purchasing oil from them. Oil prices slip after OPEC countries and their allies agree to a large production hike in September. The organization cites a healthy economy, low stockpile as key reasons behind the production hike. RBI's three-day monetary policy committee gets underway. The street keeps an eye on whether Trump's India tariffs and a lower inflation forecast would lead to the MPC to cut the benchmark rate. CNBC-TV18 Citizen Monetary Policy Committee votes 3-2 in favor of a pause. Marico Meat Street in the first quarter outperforms its peers. Its 9% volume growth is the highest among FMCG giants who have reported their numbers so far. China's largest electric vehicle maker, BYD, posts its first monthly sales decline of the year as price war intensifies in the sector. Sales drop over 10% compared to June. Rivals Xiaomi and Xpeng see strong sales growth. Chinese regulators recently announced plans to help curb price wars in the EV space. Supreme Court stays defamation proceedings against Congress MP Rahul Gandhi for social media posts on the back of the 2020 Galwan Valley clashes, but criticizes his claim that 2,000 square kilometers of Indian territory were occupied by the Chinese. The apex court observes that a true Indian would not make such a statement in times of conflict. One of India's tallest tribal leaders and a three-time Chief Minister of Jharkhand, Shibu Soren, dies at 81. One of the key forces behind the creation of Jharkhand, Soren had been admitted at a prominent Delhi hospital for over a month. Prime Minister Modi, senior ministers and politicians across the spectrum condoled his death. Policy Bazaar's Yashish Dhaya says he wants to change the health insurance incentive structure with their new platform PB Health. Tells CNBC-TV18 that they are advising customers to move to a narrow network of hospitals to avoid rising higher health insurance premiums and higher incidences of claims rejections. All right, on to the day's market action. Sensex and Nifty started the week on a healthy note, largely led by metals and autos. Financials kept the gains in check while midcaps witnessed broad-based selling gains. Surbhi Upadhyay joins us now with the day's market action. Surbhi.
Well, it was a good day for the bulls after a long time. A trending update, not a very massive gain on the Nifty, but I'll tell you why it was a good day. And there were three reasons why we finally managed to get this pullback and the bulls at least managed to resurface today. Reason number one, the weak jobs report in the US has now led global markets to feel that the Fed will finally move. So far it hasn't, despite all the push and all the overtures coming in from the US president. So that's the first reason. The second reason is that earnings season perhaps is not turning out to be as bad as feared. I mean, look at some brokerage commentary that's coming in. Goldman Sachs is saying that out of all the MSCI India earnings that have come out, 39% are above estimates, 44% are below estimates, but the misses are not much, just 1-2%. So it's not that bad. Ditto by Motilal Oswal. They're also saying that they've cut their FY26 EPS estimates by only 1% so far. So the first quarter is not as bad as feared. And number three, the market simply needed a reason it got that. It bounced from oversold levels. So now let's talk about today's performance. For the Nifty, we've seen gains pretty much across the board, a very green screen. Hero Moto 5% higher. Tata Steel doing very well today, 4% up. Hindalco higher. BEL, Adani Ports, and even some of the tech stocks that have been beaten down, like Tech Mahindra, TCS, they managed to rebound today. The only underwhelming side of the market really was large cap banking. HDFC Bank, ICICI Bank, these stocks had some red on the screen. Midcaps had a very strong day. The midcap index has done much better than Nifty. The gain is almost 1.5% for the midcap index. Let's talk about some big movers here. Trill, Transformers and Rectifiers surging 7% on a very solid set of numbers for the first quarter. Again, delivery, a very positive reaction to the numbers. MCX There were other movers, Dilip Bilkon, which got a major order, Mannapuram, so lots and lots of mid-caps that were buzzing around. There were some losers, of course, the notable ones being ABB, very weak performance in the first quarter. It took down Thermax with it as well. Thermax was down 6% today, and Narayana Health also reacting to numbers and on the downside. Now, of course, the week is a very busy one. Going forward, the market will react to the RBI policy, more earnings that are in focus, and any developments on tariffs, specifically with respect to any possible breakthrough when it comes to India and US and those trade negotiations.
Right, thank you, Surbi, for that. The top story this evening. The Trump administration has ramped up its criticism of India's purchase of Russian oil in what is Washington's strongest criticism so far. The White House's Deputy Chief of Staff, Stephen Miller, accused India of effectively financing Russia's war in Ukraine. The senior Trump aide said that US President felt that New Delhi's actions were unacceptable. However, India's crude oil imports from the US are set to rise by over 150% in FY26. Sources tell CNBC-TV18 that imports in the first quarter of the fiscal already rose by 114%, with share of US crude in India's import basket rising from 3 to 8% in July alone. Furthermore, government sources maintain that India's purchase of Russian oil is critical to maintaining price stability. Sapna Das is here with more on the government stance on the matter. Sapna.
Well, it's pretty much clear. The view back here in India is the fact that if we halt our imports from Russia, and which are quite sizable in quantity, this could really harden the international global, or rather international crude oil prices. If you look back in 2022, March 2022, just after Ukraine war had broken out, there was a fear of a lot of the Russian oil going off the market. And at that point in time, also, you had seen crude spiking to around $137. But coming back to the present scenario, in fact, back of the envelope estimates within certain sections of the government indicate that crude could spike to as much as $200 a barrel if a large chunk of the Russian oil goes off the market, or if India halts those imports from Russia. Also, we need to be mindful of the fact that in all these years, India has actually followed all the possible international protocols in terms of sourcing crude oil from Russia. Now, let's just look at the numbers as to how important we are as a buyer of the Russian crude and what kind of numbers Russia talks about. So basically, 4.5 million barrels per day is the kind of exports that Russia does, out of which almost around 1.8 to 2 million barrels per day is what India buys from them. Also, we need to keep in mind that almost 10% of the global demand, that is around 9.5 million barrels per day, is what Russia produces. It is the second biggest producer in the world. So, to speak about Russian oil going off the market, or India halting its imports from that country, would basically really cause a shortage of oil supply in the global markets very clearly. So this is the take here, and I think in the coming days we'll know more. But I think the stance back in India is very clear that the imports are not stopping, and Russia will continue to be an important oil sourcing partner for India.
Right, thank you, Sapna, for that. Moving on, crude oil prices declined after OPEC Plus agreed to a big production hike in September. This move comes as concerns mount over potential supply disruptions linked to Russia. Now, US President Donald Trump has threatened secondary tariffs of up to 100% on nations buying Russian oil. Remember, India is the world's third largest importer of crude oil. Manisha Gupta joins us now to give us an outlook on crude oil prices and also how US sanctions may impact India. Manisha.
So when you look at the Indian crude imports overall as a picture, prior to Russia's invasion in Ukraine, the number was quite small. 85% of India's imports at that time were from GSS countries, like the Gulf countries, that is. And when you look at the imports from Russia, they were a minute 0.2 to 0.5% at around $5 billion worth. But post-Russia and Ukraine conflict, and because Russian crude oil was available at a much discounted rate, we did see India and China start to buy a lot of it. So from 0.2 to 0.5%, what we did see in the first half of 2025, those imports surged to a huge 35 to 40% of overall Indian imports as well. That is where they begin. Also, when you look at the Kepler data more closely in sense of numbers, then for the month of June, we saw Russian imports of crude into India at 2.1 million barrels per day. By the time it's July, we've seen a decline to 1.8 million barrels per day. But 35% for the first half still stands in sense of imports from Russia there. Now, the markets are looking at those important deadlines where we have US pressuring India to cut its Russian oil imports. US also is pushing for a peace deal between Russia and Ukraine. There's a deadline by the end of this week. If that does not happen, then there is 100% secondary sanctions that we are looking at for buyers as well, and there could be more action and reaction too. So with this, the markets will focus on Friday. That is when the US president says a deadline there lies in. Now, there are a couple of scenarios to this. If US does go ahead with restrictions on Russia, the markets tell us, and many of these banks and brokerages also have come out with reports suggesting that this could take the crude oil prices in a 3-digit territory above $100 a barrel, because Russia does produce, it's the second or the third largest producer in the global markets there, and with the kind of production Russia does, OPEC members will not be able to meet that. There's not enough global spare capacity, and you will see that knee-jerk reaction come in for the crude oil prices.
Right, thank you, Manisha, for that. Shifting tracks now, Prime Minister Narendra Modi has called for citizens to support locally made products. Speaking at a public rally in Varanasi over the weekend, the Prime Minister added that countries globally are focusing on their self-interest as the world economy is facing instability. Now, his remarks came days after US President Donald Trump announced a 25% tariff on India and vowed to impose additional penalty for buying Russian oil.
आज दुनिया की अर्थव्यवस्था कई आशंकाओं से गुजर रही है, अस्थिरता का माहौल है। मेरे देशवासियों, अब हम कुछ भी खरीदें तो एक ही तराजू होना चाहिए। हम उन चीजों को खरीदेंगे जिसे बनाने में किसी न किसी भारतीय का पसीना बहा है।
On to earnings now. Consumer goods brand Marico's first quarter numbers were in line with street expectations. Net profit rose over 8%, while revenue surged more than 23% on an annual basis. Mangalam Malu joins us now with more. Mangalam, take us through the numbers.
9% is the highest that we've seen among the large companies that have reported when it comes to Marico's volumes. But importantly, remember, the street was prepared for that, and which is why, the stock is holding on, and it was at close to 52-week high before numbers. The street had already sussed out these numbers from the first quarter update that the company has given. So largely in line. If you look at it, the revenue is 3259 crores. The street was working with a number of 3270 crores. Volume growth at 9%. The street was working with a range of 8 to 9%. EBITDA at 655 crores. The poll was closer to 665 crores. No problems out there as well. And net profit around 500 crores as well. Largely in line. The only thing we need to watch out for going forward are the margins. Why do I say that? Because gross margins declined by 530 basis points. There's been a sharp inflation in their key copra prices, 18% quarter on quarter, over 100% year on year, and that will remain the key monitorable going ahead. Parachute rigids declined volumes by about 1%, and this after a 31% revenue growth, telling you how raw material prices have had an impact on their main business. Value-added hair oils grew well. That was a positive. Saffola also saw a mid-single-digit growth. So what is it that led the volume growth this time around? It was foods and their new businesses. The company has been diversifying in the past itself. What they've said is that the impact of unprecedented margin headwinds will peak out in the first half, and the second half we will see margin improvement. They will sustain positive volume and revenue growth momentum through the year. So demand from a top-line standpoint, no problems. Margins remain the key monitorable.
Right, thank you, Mangalam. EV two-wheeler maker Ather Energy's first quarter loss contracted 3% compared to last year, aided by a rise in other income. Revenue surged 79% year-on-year as retail volumes rose. Gross margin largely flat, both sequentially and on an annualized basis. The company's share surged 13% to hit a fresh 52-week high after reporting its earnings for the quarter. Now, shares of auto major BYD declined in trade after the company's July sales fell nearly 10% month-on-month. The Chinese EV giant delivered over 3.5 lakh vehicles globally during the month, marking gains of less than 1% on an annual basis. This is the company's first monthly decline in 6 months, causing investors to worry. Adani Group has denied reports suggesting a possible tie-up with Chinese companies BYD and Beijing Wilion New Energy Technology. The company clarified that reports suggesting a partnership with these Chinese companies are inaccurate and misleading. It further said that the company is not exploring any collaboration with BYD for battery manufacturing in India. RBI's Monetary Policy Committee has begun its three-day meet. The street will be watching if Trump's tariffs and a lower inflation forecast would goad the MPC to cut the benchmark rate. 3 of CNBC-TV18's 5-member Citizen Monetary Policy Committee voted in favour of the central bank keeping rates steady. The committee also expects one more rate cut in 2025.
The first question that you have to vote on, what will the MPC do to the repo rate on August 6th? Can I start with Samiran?
We are expecting a 25 basis point repo rate cut in the August meeting.
Okay, cut. Soumya?
We are expecting a 25 basis point cut.
Oh, that's 2 cuts. Sonal?
We think the MPC will hold rates this time, but a dovish hold.
Okay. Hold or a pause. Sajid, pause or cut?
It will be a pause.
Okay. Dr. Sen, your team is divided 2-2. Which way do you tilt?
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying. Finally, if you include an action on August 6th, how many rate cuts do you see in 2025? Samiran?
Only 25 basis point.
Okay. 1 cut only, that which you're expecting on August 6th. Soumya?
We are also looking at one more cut, 25 only.
Sonal?
50 basis point more.
Okay. Again, there is a dissent here. Sajid?
I would say either 0 or 25 basis points.
No, I'll have to go with 25. No, I can't take either or. I'll take 25. Dr. Sen?
On this, again, I will go with Sonal.
Okay.
Delay and when you do it, have a 50 basis points cut.
The government's tax card upgrade project known as PAN 2.0 has been awarded to LTI Mindtree. Sources tell CNBC-TV18 that the project is expected to go live in 18 months. PAN 2.0 will introduce a single unified portal, paperless processing and free ePAN services. Over 3,000 Boeing defense workers went on strike in Missouri and Illinois. The workers are trying to seek a new contract. This move comes after union members at operations rejected the company's latest offer over pay, work schedules and pensions. The union last went on strike nearly 30 years ago, where they stopped working for 99 days. Now, Vietnamese EV maker VinFast has opened its first manufacturing plant in Tamil Nadu. The company's first overseas plant is expected to generate over 3,500 jobs in the next 5 years. It is part of a 16,000 crore rupee investment pact inked between VinFast and the Tamil Nadu government. The plant will initially have a production capacity of 50,000 vehicles per year. The company will focus on making premium electric SUV models at the plant. On to a CNBC-TV18 exclusive. PB Fintech's founder Yashish Dhaya has said that he wants to change the health insurance incentive structure with their new platform, PB Health. Speaking with CNBC-TV18, he said that they are advising customers to move to a narrow network of hospitals to avoid rising higher health insurance premiums and higher incidences of claim rejections.
What we are doing is for our customers, at renewal, when their price goes up and they are suffering on claims, we're advising them to move to narrow networks.
Okay.
Because their price will be controlled, and plus, we will stand guarantee that their claim will be settled. But then they don't have the choice to go to any of the 14,000 hospitals. They have to do exactly what the army structure is. There is a gatekeeper. The gatekeeper will advise you where to go. You don't pick up your face and just go wherever you feel like. That doesn't work. If you want to do that, keep doing that. There is a price that's going up and there is a claims problem as well.
Is this going to be like Policy Bazaar, a profitable venture in the future that you are currently backing and willing to invest in? Or is this a philanthropic venture or philanthropic idea or philanthropic enterprise? I think that's the question that people are confused about.
I'll explain to you.
Yeah.
I'll explain to you and I'll also explain my responses. It is going to make profit. If I was to build a hospital and try and compete with the best hospitals the way they are run today, I don't think I will be able to win. But please understand, I'm not a better seller of insurance than an agent. They are probably much better than my employees at selling insurance. I changed the incentive structure. And I'll explain what I did. I said, let us sell those products which are useful to the consumer.
Yeah.
Let us not push those products only which make us the most money. You have to understand, I changed the incentive. I did not become a better seller. I changed the incentive so that I was no longer in competition. That's what I'm doing here. I'm changing the incentive structure altogether, so nobody is competing with me.
Yeah, so you're not up against the Max and the Fortises of the world.
How will they compete with me when I start reducing the incidence rate? They don't want to do it.
All right, time for a short break. Coming up next, Supreme Court stays defamation proceedings against Congress MP Rahul Gandhi for social media posts on the back of the 2020 Galwan clashes. Details in a bit. Welcome back. In international news, Israeli forces continue to bombard Gaza, killing at least 92 Palestinians, including 56 aid seekers yesterday. Now, officials have said that more than 22,000 humanitarian aid trucks are waiting outside the Gaza Strip, and only 36 trucks entered the enclave on Saturday. Hamas has said that it's open to the International Committee of the Red Cross delivering aid to Israeli captives in Gaza. However, for this to happen, Israel must open humanitarian corridors to deliver aid to all people in Gaza. Ukraine's military has said that it used drones to target several sites inside Russia, including refineries, an airfield and an electronic plant. One of the drone attacks had sparked a major fire at an oil depot in Sochi in southern Russia. Ukraine also said that Russian forces launched 76 drones and 7 missiles across its cities. The Supreme Court has stayed defamation proceedings against Congress MP Rahul Gandhi for social media posts on the back of the 2020 Galwan Valley clashes. However, the top court criticized his claim that 2,000 square kilometers of Indian territory were occupied by the Chinese. Ashmit Kumar joins us now with more. Ashmit, take us through what the apex court said.
Well, the Supreme Court granting the relief to Rahul Gandhi by way of staying the defamation proceedings pending against him in the state of UP, but at the same time asking a question of he's being a true Indian. Now, what's the context of it all? Well, let's remember that as a part of the Bharat Jodo Yatra, at the time Rahul Gandhi had raised questions about clashes between Indian and Chinese forces in Galwan. He raised questions about as much as 2,000 square kilometers being under Chinese control. He talked about 20 Indian casualties. He talked about how the Chinese forces were thrashing Indian forces. And these were the very same questions on the back of which defamation proceedings had been launched today. They were very pointed questions. The Supreme Court granting relief, but coming with the rebuke as well, asking questions as to where Rahul Gandhi is making such comments from, where is he getting his information from, that these comments are irresponsible, that he's taken to social media to make these comments. Instead, he should be raising these points, if at all, in the parliament. At one point also remarking that is it truly Indian to be asking these questions, especially in times of conflict, and then going on to say that he could very well have free speech rights, but as a leader of opposition, he also has a certain degree of responsibility. So sharp questions are being asked by the apex court, but nonetheless, on the back of that, agreeing to grant a stay as far as defamation proceedings is concerned. So a legal remedy, a legal relief coming Rahul Gandhi's way, but not without a fair bit of tongue lashing from the top court. Back to you.
Right, thank you, Ashmit, for that. Now, one of India's tallest tribal leaders and a three-time Chief Minister of Jharkhand, Shibu Soren, has died at the age of 81. He had been under treatment in Delhi for over a month and his condition was critical for the past few days. Prime Minister Narendra Modi, union ministers and politicians across the spectrum paid their tributes. The PM said that Shibu Soren was a grassroots leader who rose through the ranks of public life with unwavering dedication to the people. A leader with over 4 decades of political experience, Soren was elected to the Lok Sabha 8 times. He also served as India's coal minister and was currently serving as a Rajya Sabha MP. Soren was also convicted in the murder case of his former secretary in 2006. He was later acquitted, with the apex court upholding the acquittal in 2018. And with that, it's a wrap on this edition of Business 360. News and updates continue right here on CNBC-TV18.
The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC-TV18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene, literally changing the rules every night over with a tweet. So, at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to. And hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest of the world is going to be beset with more disinflation. Think of a dam where the US puts on a tariff wall. It's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers. But the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think, Lata, just to take it a little bit forward with the Sajid's argument, yes, the growth has been weak, and continuing the same vein what Sajid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number. but that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum, if you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better, possibly in the first quarter, maybe a little more in the next 3 months. But the second half is actually going to be diametrically divergent. So in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half would be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth given the way things have been unfolding.
Okay. So even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Lata, I think the balance of risk, both to growth and inflation projections of the RBI are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the kind of summer decline in inflation has been much more than what was anticipated before. And the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9-12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad-based across cereals, as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, we'll probably reach somewhere around 4.5 inflation for the Jan-March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan-March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
The points that Sajid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
Okay. Well, I'll want more opinions on that. Let me take a quick break. We are back with more questions, also questions on liquidity and where the Reserve Bank should keep the call rate. Back in a jiffy. Welcome back to the deliberations of CNBC-TV18 Citizens Monetary Policy Committee. I have with me Chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakravarti, and Sonal Verma. Gentlemen and Sonal, thank you very much for your time and for your patience. Before going to break, I asked Dr. Sen about the timing. Let me get another opinion on that. Soumya, what's your sense? Would it be better to give it earlier because you will be in time for the festive season? Or would it be better to postpone because there will be more pressure on the governor in October? The Fed may have cut. The July number looks like, it will be 1% or something inflation. There'll be more pressure on him. So is it better to push it to October?
Yeah. Thank you, Lata. I think that's a very interesting point. In fact, our July inflation numbers are also closer to around 1.2 to 1.3%. It could be even lower. And the full year average is now tracking at 100 basis points lower than the RBI projection. Having said that, I think we need to understand that ultimately, given the inflation trajectory and given that the RBI is an inflation targeting central bank, it may have to adjust the rates in a downward direction if the forthcoming inflation numbers are an indication. But the question is that how do you time it, whether it is in August or in October? I think in my sense, a rate cut earlier than what would have happened in October could make some sense because in every way, if you look into the data right now, all data seems to be front-loaded. If you look at the global growth numbers, they are front-loaded in terms of a better number, but they are not going to deteriorate going further. Indian growth numbers will be a story of two halves, good, better now, but it may not be better in the future. Even on the inflation numbers, I think if for the assumptions in the market, the concern in the market is that the inflation numbers over the point of time, maybe over the next year could actually inch up a little bit. But there is also uncertainty over here, and the new base, which will be launched next year, could actually impart a downward bias because if the food weightage comes down and the e-commerce gets included, there is every possibility that it could be a downward adjustment in the revised inflation numbers. And also the fact that on a lighter note, the festival season is also being front-loaded this year. It's in October rather than in November as it happens every year. And as we have seen in the past, in 2017 also when the festive season was earlier, there was a significant bump up in the personal loans. So, and in sense that if you cut right now, there will be a scope for the banks to adjust the rates in the downward direction. And that would actually give ample time for transmission. So from every perspective, if all data seems to be front-loaded, either good or bad, and if the central bank may not take the decision to cut rates now, there is a larger probability of committing a type 2 error, which means that even if inflation continues to undershoot, you are not taking the action because every policy we have seen that the inflation is undershooting this year, beginning from February. So if that continues, I think we may actually make a type 2 error if we are not cutting now, rather than wait for the later to cut when the numbers are out.
Okay, there is another fear which may be prying on the Reserve Bank's mind because it's an institution with a lot of history. They've already given a lot of liquidity and a lot of cuts. So, Dr. Sen, can that worry prey on their head? That if I've given so much and it will work its way over the next year, then at a time when inflation will be at 4.5%, you're going to have all this liquidity act and inflation actually turns out higher. Like you remember in 2010 to 2014, everything worked towards double-digit inflation, probably because you front-loaded too much. What's your sense? Can that be a fear?
There are two things. That can certainly be a fear. The point is, as we talked about, core inflation has been sticky for 2 years or longer, actually. That's not been changing, right? So all the variations that you get are in those components of the CPI, which are inherently transient in nature. Now, the real question is that it's not just what the RBI feels may happen in a forward-looking sense a year from today. It's also important for the RBI to be seen to be doing something when the objective conditions of the world change. Now, my problem is that if we actually front load and then something goes off the cliff later, then we may not have any other arrows in the quiver.
Got it.
Right? The RBI will look toothless.
Okay.
And it's the image of the RBI which the RBI can and will, I think, try to protect.
Fair. Yeah, they should be seen to be doing something
Yes.
if things look very bad in September and they need that ammunition. Samiran, let me come to liquidity, the elephant in the room. Do you expect Reserve Bank to keep call rates at the lower bound? That is, if the rate is 5/4, suppose it's a pause, then will they keep it at 5/4? And if they do cut, will they keep call at 5%?
View, since RBI has now changed the stance from accommodative to neutral, it will be more consistent if in the neutral stance, the sanctity of the monetary policy operating procedure is maintained and the weighted average call rate is kept closer to the repo rate rather than closer to the SDF. Now, one way to get around this is to do the rate cut we have been talking about, that if you do the rate cut, then effectively the weighted average call rate falls down to 5/4 rather than staying at 5/2. So rather than doing this somewhat stealth method of keeping the rate 25 basis point lower than repo through liquidity operations, it's probably at this juncture in a neutral stance, better do an explicit rate cut and keep the overnight rate at 5/4 is what our view will be. Anyway, we'll all be looking forward to that new liquidity management framework suggestions to figure out whether there is any significant change to the current operating procedure that has been suggested.
Okay. Well, actually, on liquidity, some more opinion from you. Sajid, do you think continued higher liquidity will be needed to help credit offtake?
There'll be a temptation for that, Lata, because there's somehow this belief in the market that when you inject a lot of durable liquidity and banks are lending to the RBI, every day, whether it's a VRRR or in the STF, that somehow behaviorally that induces banks to boost credit growth, to lower deposit rates, cut lending rates, and boost credit growth. So
because it's a loss, that's a fair expectation.
Yes.
It's a loss when you put it to Reserve Bank. You might as well give it to an NBFC.
It's a fair expectation. The question is, does it stand the scrutiny of data? And so we looked at this, very exhaustively for the last 10 years. And what we find is that, theoretically, there should be two channels at which liquidity impacts credit growth. One is the interest rate channel. And Shamiran alluded to that when you inject a lot of liquidity, you push the call money rate down to the bottom of the corridor, and that will clearly have some impact on lending rates. And I agree with Shamiran, while that's tempting to say, let me do some stealth easing, in the wake of so much global uncertainty. If your stance is neutral and, there has to be sanctity to that rate, you need to move that rate back to the policy rate. The question, therefore, is, well, what if I add more durable liquidity, keep call rates at the policy rate? Will the injection of more durable liquidity, increase credit growth? And what we find is there is no evidence for that. Okay. It's called the credit transmission channel. We find no evidence that beyond affecting the call rate, higher quantums of durable liquidity either boost deposit growth or boost lending growth. So I think the incremental efficacy of that is extremely limited.
Okay. Well, let's see. Even in the last cycle, the one I remember, 2004, it was only after the rates started rising that credit offtake went through the roof. But situations are very
lending
different.
Rates and credit growth.
Yeah. Sonal, out of time, but very quickly, will the rupee be a worry at all? I mean, we've suddenly seen the impact of the trade issues on the rupee. Will Reserve Bank worry we can't cut too much, rupee under tension?
Should not be, Lata. I think obviously we need to wait for what this Russian penalty is and what that ultimately means. So that's something to monitor going forward. We have sufficient FX reserves to manage volatility. And importantly, inflation is below target. So any sort of imported inflationary pass-through will more than be offset by the disinflation we are seeing on food and core, such that overall inflation will still undershoot not just 4%, but the new projections and potentially actually undershoot 2%. So should not be a constraint in our view.
Oh, okay. Well, thanks a lot for many-sided discussion. Please take up your voting pads. The first question that you have to vote on, what will the MPC do to the repo rate on August 6th? Can I start with Samiran?
We are expecting a 25 basis point repo rate cut in the August meeting.
Okay, cut. Soumya?
We are expecting a 25 basis point cut.
Oh, that's two cuts. Sonal?
We think the MPC will hold rates this time, but a dovish hold.
Okay. Hold or a pause. Sajid, pause or cut?
It will be a pause.
Okay. Dr. Sen, your team is divided 2-2. Which way do you tilt?
Strategically for the RBI, a pause.
Pause. Okay. So no action is what our committee is saying. Finally, if you include an action on August 6th, how many rate cuts do you see in 2025? Samiran?
Only 25 basis point.
Okay. One cut only, that which you're expecting on August 6th. Soumya?
We are also looking at one more cut, 25 only.
Sonal?
50 basis point more.
Okay. Again, there is a dissent here. Sajid?
I would say either 0 or 25 basis points.
No, I'll have to go with 25. No, I can't take either or. I'll take 25. Dr. Sen?
On this, again, I will go with Sonal.
Okay.
Delay and when you do it, have a 50 basis points cut.
Oh, 50. Okay. I think you would want a 50, is it, sir?
Yes.
Okay. So it's actually equally divided, almost 3:2 in favor of a 25 basis cut. I have to wrap up on this edition of the Citizens Monetary Policy Committee deliberations. Thank you very much, members, for your insights.
Hello and welcome to News Center. I'm Parikshit Luthra. The top story this evening. The Trump administration has ramped up its criticism of India's purchase of Russian oil. In what is Washington's strongest criticism so far, the White House's Deputy Chief of Staff, Stephen Miller, accused India of effectively financing Russia's war in Ukraine. The senior Trump aide said that US President felt that New Delhi's actions were unacceptable. In fact, US President Donald Trump has continued to threaten to impose secondary sanctions on buyers of Russian oil. A decision on the matter is expected on Friday. If US does impose sanctions, India's oil import bill could rise by $9 to $11 billion per year. Remember, Russian crude oil accounted for 35% of India's total imports in the first half of 2025. However, India's crude oil imports from US are set to rise by over 150% in FY26. Sources telling us that imports in the first quarter of the fiscal already rose by 114%, with share of US crude in India's import basket rising from 3 to 8% in July alone. Furthermore, government sources maintain that India's purchase of Russian oil is critical to maintaining price stability. Sources added that India followed international protocols while buying from Russia. Brent spiked on fears of Russian oil going off the market in 2022. Sources have said that India's increased oil imports from Russia stabilized prices. All right, let me go across to our guests at this point. We're now joined by Gaurav Moda, partner and head of the energy sector vertical at EY, and Prashant Vishisht, who is Senior Vice President of ICRA. Prashant, what would be your estimate on the spike in India's crude oil bill if we had to increase imports from the United States and reduce our reliance on Russian crude?
Parikshit, if we were to buy market price crude in place of the discounted Russian crude, our estimate is that the import bill would rise by less than 2%, because as it is now, the discounts are quite low, in just about $2.5 to $3 per barrel.
And Gaurav, your own estimate?
Parikshit, I think there are three aspects to take into account here before we come to a number. Aspect one is that India's crude imports are fairly diversified now. We import from South America, the US itself, as well as other geographies all over the world. So that diversified sources helps us balance our averages. Second, most important aspect also is that the crude prices last year were averaging $75 a barrel. They went down to $60. Now they're $65, $66. So it's not like the crude pricing has gone completely out of whack in the market. Third aspect also is that India has been preparing for these kind of situations, not just now, but over the past several years, where we've increased our domestic inventories of crude. All PSUs are doing that. And we have strategic reserves and caverns where we store. So the question is not necessarily how much will be the direct impact on India's buying pricing, but more in terms of how we can stabilize and manage the market.
Right. Now, let me ask you, what would be India's options, Prashant, if we had to stop import of Russian crude oil in case the United States imposes sanctions on Russia and imposes secondary sanctions on countries like India and China if they were to purchase Russian oil?
Right. So, see, the first thing that we need to remember is that prior to 2022, our imports the Russian crude were in any case quite low, at less than 2%. We are also quite close to the Middle East or Gulf region, which is one of the biggest exporters of crude. So we are well served by that, by the crude that we can source from the Middle East. Besides that, there are several other options, US being one. Then there are a host of African countries, Algeria, Nigeria, and so on. So our crude basket has been fairly diversified, and we can obviously go back to some of these sources for replacing the Russian crude.
Right. And Gaurav, when it comes to getting a comparable oil bargain, currently the reason why we're buying from Russia, and this is right now, the Russian crude is the biggest in India's crude import basket. Would it be possible for us to get comparable prices anywhere in the world, be it Africa, be it West Africa or the Middle East?
Rishit, I would like to believe in the diktat that customer is always right. And India is the customer here. So this, in fact, is an opportunity for the selling countries to vie for more share of the Indian market if there is a replacement that's coming up. So I would anticipate that there could be further negotiations and bargain on the table for multiple countries to look at the Indian market. And as I said, we've been doing business with many of them. There are enough options on the table.
Right. Prashant, when it comes to India's options, if there were sanctions, for example, Donald Trump is saying that there could be 500% tariffs on countries which buy Russian energy, countries like India and China. If that were to happen, would India have to stop imports from Russia altogether, or it can bring it down to, say, something like 10 to 15% or 20% and increase imports from countries like United States, Middle East, West Africa?
So see, if there is a very definitive big sanction tariff, then possibly India could reduce the proportion of the Russian crude. But what is also pertinent to note is that in case the Russian crude is, entirely priced out of the market because of sanctions or whatever reason, that accounts for about 7% of the global crude and petroleum products consumption. So where will the prices go? So that is the other factor. But yeah, in case we decide as a country to cut down the crude, there are several other options as well.
There are other options as well. If I can get you in, Gaurav, once again. Now, India has been diversifying its crude import basket. Overall, what kind of pressure would India be in terms of Russian crude oil being wiped out from the market, India not being allowed to buy Russian oil altogether?
If you look at the last 10 years or 15 years or 20 years average, we've bought enough crude from so many countries. The percentage of crude sometimes has gone much higher from West Asia, sometimes from South America, even Africa. So it's not that, we've not been in these kind of situations. Even if one portion of the crude supplies get completely wiped out, if at all, there are enough options in the market for us to keep feeding in the crude requirements. Having said that, Parikshit, what I would like to bring to the table is that India still imports more than 80%. At some point, it even got to 85, 86% of the crude requirements. In doing that, we are still hitting a very large import bill. Having said that, the current government, Honorable Prime Minister, and even the MOPNG Minister are opening up the Indian markets for much more exploration and development activities for extracting oil from India's own oceans, whether it's the Bay of Bengal side or the Arabian Sea side. So I, in fact, see an opportunity which could be a win-win, where a number of the Indian Bay of Bengal areas have been opened up from no-go zones to open E&P zones, where there is opportunity for US and India to, in fact, collaborate to search and extract that oil, which may be beneficial for both markets. So this could actually be an opportune time to do both, not just thinking short term, that how do we diversify and take care of our immediate needs, but also to really extend hands with each other and do much more together.
Right. Prashant, if I were to ask you, now we've been learning from sources that India's crude oil and energy imports from US have more than doubled in FY26, and Indian companies are likely to increase their crude oil imports from the United States by 150% year on year in FY26. If we speak about this full fiscal, what do you think would be the value of our imports from the United States? At the start of this year, Foreign Secretary Vikram Misri had said in February that India is likely to purchase $25 billion worth of oil and gas from the US. Would there be any estimate that you may have as to how we may finish the entire year in terms of our purchases from the US?
Certainly to reduce the budget deficit, to reduce the trade imbalance the surplus that we enjoy with US. Possibly one of the levers is to increase the energy purchases from them, including LNG and crude. I would not be able to pull out a number, but currently we are at about 6 to 8%, and that number can significantly increase. Additionally, a lot of our oil and gas companies are also looking at long-term LNG, and as we speak, US, there are about 6 to 7 projects that are coming up in the US. And US LNG being Henry Hub priced, is quite attractive vis-a-vis the Brent-priced LNG these days. So a lot of our companies are seriously looking at LNG deals with US companies also.
Right. What happens to the long-term contracts with Russian entities? If I were to put that question to Gaurav, what happens to that in the wake of sanctions? This month, we have seen a drop in imports from Russia, but it's still quite high, in the range of 35 to 36%. Going forward, what will happen to the long-term contracts if by Friday Donald Trump does announce those secondary sanctions?
Rishi, it's difficult to comment on long-term contracts which are one-on-one, government-to-government, or company-to-company on current basis. We'll have to get into details on evaluating what are the inbuilt penalties for such long-term contracts, or what are the flexibilities in providing volumes on such long-term contracts, immediate versus near future. So it may be a question of playing the balancing act on long-term contracts wherever applicable, but difficult to comment directly at the moment. Having said that, Parishit, what I would add is that this mutual win-win, which even Prashant spoke about, is generally possible in the energy sector for US and India. I spoke about the E&P aspect already. Prashant spoke about the gas, the LNG aspect. There is also the third aspect around renewables, electric vehicles, exchange of technology, and market access to all of that. And there is a fourth angle as well, where India is growing in terms of its need for data centers and data available within our national sovereignty. Number of US technology majors are buying that market into India. So I think there are multiple options on the table if we look at it as an energy win-win versus just oil in particular. There is enough to play around with.
Right. Thank you very much, Gaurav, Moda and Prashant, for joining us. So clearly an uncertain situation, but the answer would be diversification of crude imports, which India would be doing over the next few months. So we will have more long-term contracts with the US, but that doesn't mean the US can be the only supplier. We will have to ramp up significantly with the Middle East, from West Africa and other nations as well. We're taking a short break, but coming up, Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. A special conversation with Pham San Chao, CEO of VinFast Asia, on the company's India plan. Stay tuned. Welcome back. You are watching News Center. Vietnamese EV maker VinFast has opened its first assembly plant in Tamil Nadu. The company's first overseas plant is expected to generate over 3,500 jobs in the next 5 years. It is part of a 16,000 crore rupee investment pact inked between VinFast and the Tamil Nadu government. I caught up with Pham San Chao, CEO of VinFast Asia, and began by asking him about the company's investment commitment in Tamil Nadu.
We have a long-term commitment to invest in Tamil Nadu. We made a commitment during the summit, investment summit in Tamil Nadu last year. And our commitment is 16,000 crore. For the first stage is 4,000 crore in Tamil Nadu. And we have spent nearly half of that on this factory in order to make it happen today. So this is the first stage of our plan with 50,000 capacity per annum. And we are going to scale it to 150,000 car eventually, depending on the response for the market. But we are very optimistic about that.
Right. Now
And
you've got the VF7. Yeah, you've got the VF7 and VF6 coming up, and they will be manufactured at this facility. When does the commercial rollout begin? You've been inaugurating showrooms across the country. When does the sales officially begin?
Actually, I have opened a few showrooms in Surat, in Chennai, and eventually in other big cities like Cochin, Hyderabad, Bangalore, Kolkata, Delhi, Mumbai, Gurgaon. And we are going to launch the car eventually in few days, in which we are going to announce the features of the car and we announce the price. Then after that, we already opened online pre-booking. We have very impressive reservation. And after we announce the price, we start delivering the car to our dealers. Our customers. Because next week, we start delivering the car to our dealers already.
Right. So next week, you start deliveries to dealers. When can the customers expect it by?
So basically, the customer can receive the car end of this month or beginning of next month. So this is very positive. Now we are working with the state. We have received already the CMVR homologation certificate from RI. We have RI representative coming to attend the event today, and he hand over the certificate for me. And now next step, we work with the state level in order to get another certificate at the state level. So we deliver the cars to customers.
Right. Could you also give us a sense of how many showrooms do you target in terms of launches in India? How many showrooms by the end of this year and end of next year?
So we have signed agreement with 13 group of showrooms, and we are going to open 35 showrooms in 27 cities. At the moment, more applications are coming in. Many potential dealers are calling us to express their interest. So in this one, we are going to open a few dozens more. And until the end of the year, we hope we have 35 showrooms in 27 cities. And after that, we will scale up more.
Okay. I would also like to ask you whether the company is looking to take advantage of the scheme for promotion of manufacturing electric cars in India. That portal has opened up. Are you looking to apply to avail of some concessions through the scheme?
It depends on the schemes. For the old schemes, which I don't remember the name of the scheme, but the scheme that we have been working for quite 1 year with the Ministry of Industry is no longer available to us. That scheme is going to apply only for any OEM which have not made any investment in India, which don't have the factory in India. We, VinFast, have already the factory in India. We start rolling out our first Indian-made car, and we start delivering the car already. So it's no longer available for us. But other scheme, we are ready to look into that and ready to apply for the incentive from the federal government.
Right. But how do you see the electric vehicle ecosystem in India, the regulatory ecosystem? What would be your ask of the government?
So basically, we asked the government that now over the past 1 year, the two sides have been in discussions, and now you came up with a scheme, but the scheme is no longer available for VinFast because we already opened our factory and we roll out already. So we also put a request to the government of the central government to allow us to import 2,000 cars for taxi, which is under the new reduced basic import duties as an incentive for us. Because the car that we are going to import for our GSM operation is not the model that we are going to produce into Tuticorin yet. So that kind of scheme or incentive, we are requesting the government for the time being.
Okay, my final question to you would be, how do you see the competition in the India market from domestic EV players and also Tesla, which has now entered officially?
We believe that India is a very potential market. It's a growing market, emerging market. That's why it is a strategic market for us now. Therefore, we decided to move here very massively. That's why we have been able to build this factory within a span of 15 months. Within the 15 months. That's why we continue to do the same thing in the future.
All right, let's move on and get you some news from the telecom sector. Bharti Airtel's digital arm, Xtelify, has launched a new sovereign cloud service platform and an artificial intelligence-driven software suite for telecom players in the country. Ashmit Kumar caught up with the company's MD, Gopal Vittal, and began by asking him about Xtelify's new offering to customers.
So Xtelify is a 100% subsidiary, and it has all our 3,000 engineers work in Xtelify. All our digital applications are part of Xtelify. All our investments are now housed there, and we run one of the largest instances of our cloud, which has over 250 petabytes of data stored. Everything that we run runs off the cloud. We're extending the cloud because it's a telco-grade cloud. It's reliable. We also believe there's a need in the market for lowering the cost of ownership. We have heard that from many CIOs who have that as a pain point. And so we're now extending this cloud to them. In addition, we've been using a bunch of software platforms which we developed. They're homegrown software platforms for our own business needs, which deliver us improvement in business outcomes. We've also extended those software platforms to other companies in the world. We've already won 2 contracts, one with Singtel and the other with Globe. Of course, Airtel Africa, Indus Towers, the bank, our bank, all of them are already taking these platforms.
From a sectoral outlook, I know you're not sharing specific names of companies that you're in conversation with. From a sectoral outlook, which are the companies that you think can stand to benefit that you can partner with going forward on the cloud under Xtelify?
On the cloud, anyone who is looking to move to the cloud, or anyone who's looking to save some costs on the cloud, anyone who's looking to actually have a more sovereign cloud where the control plane resides in India, which is DPDPA compliant and is regulated, all of them would be target.
From your conversations, any particular sectors that you're focusing on? You mentioned banking.
At this point, we're talking to all. So the way we look at our business, we look at banking and financial services, we look at manufacturing and distribution, we look at technology companies, and then we've got the small and medium businesses. We're talking to everyone. Within this, there are about 50, 60 customers who've expressed great interest. So I can't announce it because they haven't given us a contract. So it won't be fair on them more than anything else.
Just one final question. This is clearly a commercial venture. You're not sharing numbers right now, but from a slightly mid to longer term perspective, what is the kind of revenue split that you'll want to look at between the telecom business and the cloud business?
Yeah, I think that would be a premature of me to answer, but I will say this. This is a large investment we made. This is a very credible and meaningful initiative for us. And if we don't make this work well, then obviously we'll be disappointed. So hopefully, a few years down the line, this should be a sizable revenue stream that we generate.
With that, it's a wrap on this edition of News Center. More news and updates continue right here.
JSW Cement, led by Parth Jindal, is eyeing the public markets and looking to raise 3,600 crores via its IPO. This is one of the most anticipated IPOs of 2025, and they have ambitious expansion plans, looking to increase or double their grinding capacity in the next few years. In this episode of IPO KYC, we decode the IPO, the strategy, the risks, and the man himself. Parth, thank you very much for speaking with us.
Thank you.
So your aspiration is to make JSW Cement a top-tier pan-India cement company. How does this IPO fit in your strategy and long-term vision?
No, absolutely. I think, over the years, JSW Cement has been growing steadily. In 2016, when I took over the business, we were a 6 million ton company. And over the last 9 years, we've tripled our capacity from 6 million to now over 20 million tons. At that time, we were primarily only in the south. Now we've entered the markets of the west and the east. And I think now that the company has grown to this size and scale, we are truly poised for our next phase of growth, which is to enter the markets of the north as well as the central parts of India. And the IPO and the proceeds of the IPO that we're getting is going to allow us to expand into the north and over time expand into the central part of India as well. So, I truly believe that in order to be relevant in the Indian cement industry, you need to be present across the country, because you never know which region is doing well, which region is doing badly. So in order to truly make a well-diversified and stable business model, being in different regions and all the regions of India is very important, and that's the ambition of the company.
So talking about your expansion plans, Parth, you're looking to increase your total grinding capacity to 42 million tons per annum and even double the clinker capacity. When do these capacities come on stream?
So at the moment, we are in phase 1 of our expansion, which is we are adding a grinding unit in Odisha, in Sambalpur, and we're adding our integrated unit in North India, in Rajasthan, in Nagaur. These two plants, although we have guided that they'll be ready at different times, I'm very confident that within this financial year, both of these plants will be up and running, which will take our capacity from 20.6 million tons to about 26 million tons. We have also started the groundwork for the other expansions that we have in place, which is some of them are brownfield in our existing locations. So Vijayanagar in Karnataka, we want to add 4 million tons of grinding there. Dolvi in Maharashtra, where JSW Steel has a large complex, we want to add 4 million tons there. And then our complex in central India, which is the mines we acquired from India Cement about 3 years ago in Hatta in Madhya Pradesh. So all these projects are primed and we can actually begin work very, very quickly. It's our endeavor, it's my endeavor, my aim to get to 41 million tons within 3 to 4 years. The sooner the better, but obviously the performance and the leverage needs to be in check, and we would modulate our growth based on our leverage.
Got that. And 60 million tons per annum, you've got that ambition too?
Yes, so within the existing locations, within the existing mining deposits that we have enough limestone and enough land, as well as enough fly ash as well as slag, which tied up to take our capacity to 60 million tons.
Okay.
So the way to think about us is today we're 20.6 million across 7 locations. These 7 locations themselves can go from 20.6 to 30 million tons. And then the balance 30 million tons would be coming from 3 different sites. Rajasthan and Nagaur, along with its split grinding units, would be 15 million tons. Central India, which is Madhya Pradesh and Uttar Pradesh, should be 10 million tons. And then Gulbarga cluster in Karnataka and a grinding unit in southern part of Maharashtra would be another 5 million tons. So this entire strategy is in place to 60 million tons, which we hope that once we get to 41, we will embark upon the journey from 41 to 60, which again should take another 3 to 4 years. So if all goes well, we could get to 60 million tons, sometime in the early part of next decade. And if it goes a little bit worse, then it'll be in the middle part of next decade.
Well hedged, Parth. So today, I think you're the 9th largest player by capacity.
Yes, right.
Can you get into the top 3, top 5, challenge the Shree Cements, Dalmia Cements of the world?
I think first of all, I think all the companies that are there in the cement industry have been around for a very, very long period of time. And they've all built fantastic businesses, whether it's Bangarji or whether it's Puneet Bhaiya, they've all built phenomenal businesses. And they all have their own growth plans. So I think the top 4 players of the country are well out of reach at the moment. And obviously they also are expanding.
Sure.
I think the 5th spot is up for grabs. And that's the aim, is to try and see how quickly we can get there. Having said that, you know, inorganic opportunities in the cement industry, as we've seen over the years, have come, and there's been a lot of consolidation. And one of the disadvantages of being in the cement industry is that the competitors that we deal with on a daily basis are all sitting on very strong balance sheets. So for them to acquire inorganically is far easier than for us at this stage to acquire. But obviously with the IPO coming in, with liquidity coming in, with currency being available, tomorrow if a very exciting opportunity comes in a market that is attractive, we could do a QIP, we could do a follow-on, we could do so many things which the group has done in the past, which will allow us to compete. But all said and done, my fundamental belief is that you need to be at least a 10% market share player across the country to be relevant. And I believe that, you know, last year the Indian cement industry consumed 435 million tons of cement. I believe over the next 5 to 6 years, this number will grow at a CAGR of about 6 to 7% in lockstep with GDP and get to about 750 million by 2030, 2031. So in order for us to have 10%, we would need to be selling 75 million, which is higher than our current plan, but still getting to about 55, 60 million tons of sales, 7 to 8% market share would be the first step, and then to get to that 10%. So I do think the cement industry, the consolidation wave will continue, and it will become an industry which is dominated by, you know, call it 6 to 7 players.
Yes. Got that. Just a quick word on your balance sheet. Your debt today is 4,200 crore. 520 crore of the IPO proceeds go in reducing your debt. What would the post-listing, you know, debt look like, and leverage ratios? You've got so much capex coming on stream. So how would the leverage ratios move?
No, I think if you look at our debt profile, last year due to the difficulties that the industry faced, our net debt to EBITDA almost touched 5 times, which is way above healthy level or a comfortable level for the company. It is my intention that over time to bring the debt as close to 2 times as possible, and not exceed 2.5 times. So this is not something that this may change from time to time given the dynamics, but in general being below 2.5 times net debt to EBITDA is the aim of the management.
Okay, got that. But now, considering your ambitious expansion plans, what is the total estimated capex outlay for you?
Yeah, so I'm not allowed to actually give the forward guidance in terms of capex, but what I can say is that building organically for JSW is significantly cheaper than building for any of our large competitors or in any of the acquisitions that are happening. So on average, the acquisitions have been happening at about $120, $130 per ton. Some of them even as high as $150 per ton. Our capex intensity for this phase of expansion is less than half of that.
Okay. So you're going to be building incremental capacity at 60, 70?
That's right. So close to that.
Close to that. Okay. What about the operating, the EBITDA, right, per ton? In FY25, it was depressed. I think it was sub 700. What is the number looking like in Q1?
Again, our Q1 results will be announced soon after the IPO. But I think the industry has seen a sharp increase in EBITDA per ton. I think the pricing power has come back into the industry, and all our competitors have announced their results at nearly 30 to 40% EBITDA improvements, both overall as well as on a per ton basis. So we would be in that ballpark for sure, and we would announce our results imminently after the IPO.
Got that. So the industry in Q1 on an average would be 1,000 rupees per ton?
That's right.
In terms of EBITDA?
That's right.
And you're saying you should be in line?
We are In and around that number.
In and
Again,
around
for
that.
us at JSW Cement, we have two distinct product lines. So we have our cement business and we have our GGBS business. And GGBS is primarily going into the ready-mix concrete industry, whereas cement is going into all sections of the construction ecosystem. So for us, both the GGBS side as well as the cement side, we saw an improvement in realizations. We saw a much bigger improvement on the cement side and a lower improvement on the GGBS side. But overall, at our size and scale, we would be very close to where the larger industry players have been because of our inherent advantage and profitability that we have in GGB.
So just, for the sake of numbers, let's assume in Q1 you're in line with the industry, and that's about 1,000 rupees in terms of operating EBITDA per ton. For the rest of the year, given the demand supply, the competitive intensity, how should the number, trend?
I think this year we're seeing a lot of consolidation play out, and a lot of capital has been deployed by the number one and number two player into the industry. So if you look at Ultratech, they acquired India Cement. You look at Adani's, they acquired Penna, they acquired Orient, they acquired Sanghi. And then we all know that there's a huge fight going on right now for the JP assets as well.
Yeah.
So after deploying so much capital, I think what we're seeing is that the number one and number two player are now really playing a very big role in keeping prices very stable. And obviously we as a ninth player in the industry, we are a price taker. So we follow what the leaders are doing in the industry. And we're seeing a lot of stability in the market. For JSW, as our volumes go up, our fixed cost absorption will continue to come down, and that will allow us to improve our profitability. So I would say Q1 was just the beginning. I'm very confident and very hopeful for the entire industry that this year will be a landmark year for the cement industry.
Okay, so competition is rational. And in the second half of the year, can we expect realizations to improve for the industry?
I think prices at this level are at a very healthy level.
Okay.
Now, I would not be one of the promoters in favor of any further price increase.
Got it.
I think if these prices can be stabilized and these prices can sustain, that in itself would be a huge achievement for the industry.
At these levels. Got it. So FY25 loss was an aberration? I mean, you should be profitable this year?
Yeah, absolutely. I think there were three accounting adjustments that led to this. One was obviously a large expense on account of the fair value adjustment of the CCPS that we have. So that obviously goes away with the IPO. Second was on the performance of our subsidiaries. So we had the Shiva Cement, which was loss-making. We had our Fujairah business, which didn't do well last year. And then we have our investment in JSW1. So I think on that, I think Shiva Cement, very hopeful that with the commissioning of the grinding unit at Sambalpur, which is part of Shiva Cement, it'll truly become a cement company from just being a clinker supplier, and that should improve its profitability. The second is Fujairah is doing extremely well now. I think the entire UAE region is doing extremely well due to what's happening geopolitically, and there's a huge thrust on real estate over there, which is allowing clinker prices and cement prices in the region to be strong. So we're seeing a very strong performance from our Fujairah business. And the losses at JSW1, it's a tech startup kind of a business, but they're coming down. And we expect that by Q4 of this year, JSW1 on a standalone basis will be profitable.
Okay. At the EBITDA level, it'll break even.
It'll break even, that's right. So that should help. So this and then the CCPS and ESOP adjustments all go away. So very, very confident that not only that we will be profitable, but that we'll be healthy and it'll be a good performance.
So Shiva Cement stays as an listed entity, or are you planning to merge it?
As of now, it remains a
separate listed entity.
It remains a separate listed
And what about plans, since now JSW1 will be profitable?
Yes.
It'll break even at the EBITDA line. You are looking to do an IPO and monetize it.
Yes.
What's the timeline for that?
I think, the first goal and the first stepping stone towards IPO is get the company to profitability.
Yeah. But you have a roadmap for that, a clear
so
line
we have
of
a
sight.
roadmap. We had the same roadmap last year, so we didn't get there. But although the management keeps talking about IPO and all, at least from the steer from my side is let's get the profitability going. Let's see 1 or 2 quarters of profitable performance, and then we'll take the next step. So hopefully, if that happens in Q4, then we could expect an IPO in the second half of next year. But first, we've got to hold our horses. We've got to deliver on the numbers.
On that note, we'll slip into a very short break. We'll come back with more from Parth Jindal. Don't go anywhere. Welcome back. You're watching IPO KYC. We're in conversation with Parth Jindal on the JSW Cement IPO. What is your group level capacity utilization? And now with new capacity coming on stream, will there be incremental downward pressure as these capacities ramp up? I mean, what's the capacity utilization ramp up looking like?
Yeah, so last year we were at about 63% on a capacity utilization metric. Now again, when you look at our capacity utilization, you got to look at 2 metrics, and the metric that we follow is one is the grinding capacity utilization, the second is the clinker capacity utilization. So our clinker capacity utilization was much higher at about 84% last year, and we expect that number to continuously inch up. Whereas our grinding capacity utilization is still, very similar to where it was last year. It's improving, but as we keep adding new capacity, maintaining it at around 70% also would be a good achievement till those capacities stabilize and mature. So In our existing grinding units, you'd see our capacity utilization being northwards of 80, but in any new one, it starts lower and then it goes up. So I think in general, being around 70% is a good net metric for us, and that's the target we have for the grinding, and being at 90% plus for the clinker. So again, one of the nuances for us is if you look at our clinker balancing, people say, oh, you're 20 million grinding, but you're only 6.5 million clinker. That doesn't make any sense. How can you sell so much cement? And the answer to that is we have GGBS, which is a big product line, which doesn't require any clinker. Last year, we sold about 5.2 million tons of GGBS. Our aim is to sell slightly more than that. Significantly more than that this year. So even if you just look at last year's numbers, if you remove the 5.2 million tons of GGBS from our grinding, so that makes it about 15 million tons of grinding. And for 15 million tons of grinding, having 6.5 million tons of clinker, because we're a slag cement player, where in slag you only need to add 35% of clinker, versus in fly ash you need to add almost 60% of clinker. So because our clinker factor is lower, last year our clinker factor was 47%. So at 6.5 million net, you can make 13 million tons of cement, and the balance we keep for GGBS. So that's how our balancing works. Now, that's okay in the current geography that we are, because these are, I would call them steel-dependent geographies, because the south is Vijayanagar, is co-located within Vijayanagar Steel Plant. The west is co-located for Dolvi Steel Plant. The east is co-located for, Jharsuguda, the famous BPSL, Bhushan Power and Steel Plant, and we have units. But as we go to north and central, there's no slag, there's no steel. That would be a very traditional model where we only have fly ash linkages, and you'll see our clinker factor slightly go up over the years.
So now, Bharat, let me get to acquisitions, right? You referred to it many times, and you also said it's cheaper for you to manufacture organically. There have been so many assets on the block. You seem to have missed out on a few. Is it the valuations holding you back? Was it because there is an IPO going on? Talk to us about the deals that you missed, and what are you in the fray for right now?
I think, like I said, we have to be very clear and very conscious of where we are in the industry. We are a 9th largest player. We are a medium-sized company with large ambitions, which JSW always has. Yeah. But if I, as JSW Cement, without support of the group, want to acquire any of these businesses, which an Ultratech wants, or an Adani wants, or a Shree wants, or a Dalmia wants, I know that I cannot outbid them, because they have more muscle power and they have bigger balance sheets. And that's why we have very clearly stayed away from these races. We went all in for Holcim. That was not Part Jindal alone, that was Sajan Jindal and the group going behind it. That was a totally different kettle of fish. After that, wherever cement had to bid, we've stayed away, because we know we can't compete, number one. Second, if you see the assets that are available, they're all in the south. And most of them, if you look at Sanghi, sure they have in the west, but coming into the south. You look at Orient, you look at Penna, you look at India Cement, they're all in the south. We already have enough capacity in the south, and we are actually looking to enter more attractive markets like the north, like central, like the northeast. So if an opportunity comes in one of these geographies, now that we're listed and have currency, we'll try and compete. But again, I want to be very clear and very categorical on this, is that if I am competing with any of the big boys...
You don't want the group backing you for...
I mean, that's a decision we'll take if an asset is that exciting, turn them around in the first place.
So which are the assets on the block now that you would be interested in?
No, not very much actually. There's not very much available at the moment that is public, and we're not even hearing anything, because there's
nothing that you're bidding for right now?
No, nothing. There are a few assets available in the south, but again, we don't want to go there.
Got that. So you said your aspiration is to be the 5th largest player by capacity. When do you think that will happen?
I think at 60 million tons we would be there or thereabouts. Obviously there are others growing. So JK is growing, Ramco is growing, Everyone Nuvoco is growing. Everyone wants to be there.
So between 2030 to 2035, do you think you can get?
I think so. I mean,
hopeful.
I hope so.
So this Axo deal in pain, since you brought it up, I mean, you won that, but you lost a few on the cement side, right? What has that taught you about deal making in India?
I think personal relationships are very important. One thing that I learned is that you have to build an equation with whoever is the seller, and they have to believe that their business, the right home for their business is you. And that's something that I've learned, the hard way, I would say. And I think the second thing is that, you have to take that bold step. You have to take that leap of faith. It may not make sense on paper. You may be overpaying. You may be paying more than what you want or what business school has taught you or what everyone has taught you. But if you have conviction and you have belief that this is the right business for you, then you have to take that leap of faith within reason, or you have to take that leap of faith and say, I'm leaving it. It doesn't make sense for me, I'm out. So having that conviction or courage is needed. Either to say yes, it's always, everyone applauds you for taking the decision to say yes, because you make headlines and you come in the news and everything. But it takes, I would say, even more courage to say no, because you'll be asked questions like, why did you lose out? Why did you leave it? Why did somebody else take it? So I think both require courage.
Okay, just one final question then. You spoke about the legacy that you're inheriting from your family, right? What's the one piece of advice that you learned from them that shaped the way you are doing business, and where you respectfully disagreed?
Yeah, I think the one thing that I've learned from my grandfather, from my uncle, from my father, is that always ask the question as to why you're doing something. Why does the world need another JSW Cement company or paint company or sports company or anything, EV company? Always solve that problem. Always solve that question, and how you're adding value to the lives of the Indian who you are serving. Second thing I've learned from them is sheer optimism about India. They are the biggest India bulls I've ever met, and that is infectious. When you're doing everything from a larger purpose. The purpose is not profit. The purpose is to build India. Everything that we do and everything that we want to do is to build a better India, so that India can challenge the rest of the world. And the third thing which I think respectfully disagreed on sometimes with my father is on leverage. Okay. Yeah, he wants to grow fast. He wants me to grow faster. He wants me to do more. He wants me to accelerate. And I've always told him, and we keep having this debate daily, is that I'm not ready. I mean, my company is not ready to take on so much leverage, or my company is not ready to to scale so quickly, and it'll all happen with time. And he's obviously got way more experience than me, and he's taken way bolder, way bigger decisions than I have ever taken. And he's put literally everything on the line. And whenever I ask him, I said, Dad, what if it had gone wrong when you took this decision? He says, I'll go back to Hisar. I don't care. I love Hisar, and I'll go back to Hisar. And I tell him that, Dad, I'm from Mumbai. I don't have anywhere to go. So I need to live here. So I'll grow at my pace. And he pushes me, and I listen to him to a degree, but sometimes we disagree on that.
Parth, but you yourself have big bets and bold ambitions, and the street's going to be watching this IPO very, very closely. Thank you very much for joining.
Thank you.
Thank you.
US President Donald Trump has hit India with a 25% tariff, and this is the shocker, a penalty for buying oil from Russia. But we don't know what that penalty amount is. Now, Trump, while calling India a friend in an otherwise very terse statement where he called India's tariffs most strenuous and India's non-trade barriers obnoxious, quote unquote, Trump followed this statement with another statement calling India and Russia, I quote, dead economies. The Indian government's reaction so far has been measured. Sources say many goods, including electronics and pharma, are likely to be exempt from the higher tariffs. This was in fact the case even in April when the Trump administration had first announced the set of tariffs. Now, the stock market seemed to be betting on the taco trade. Trump always chickens out, because we've seen a dramatic recovery and a rebound from the lows of the day. So how will this tariff tussle pan out for the markets and for the Indian economy at large? This is the editor's playbook. I'm Shireen Bhan. Joining me on the show today, my colleagues Parikshit Luthra, Prashant Nair, Nimesh Shah, Surabhi Upadhyay and Sriram Iyer. Guys, thanks very much for joining us. Before we begin, let's first listen into President Trump on the tariff imposition on India.
Well, we're negotiating right now, and it's also BRICS. You know, they have BRICS, which is basically a group of countries that are anti the United States, and India is a member of that, if you can believe it. It's an attack on the dollar, and we're not going to let anybody attack the dollar. So it's partially BRICS, and it's partially the trade situation. It's the deficit. We had a tremendous deficit. So, as you know, Prime Minister Modi is a friend of mine, but they don't do very much business in terms of business with us. They sell a lot to us, but we don't buy from them. You know why? Because the tariff is so high. They have one of the highest tariffs in the world. Now, they're willing to cut it very substantially, but we'll see what happens. We're talking to India now. We'll see what happens. It doesn't matter too much whether we have a deal or whether we charge them a certain tariff, but you'll know at the end of this week. August 1st is a very big day for this country because money is going to pour into the United States like we've never seen before.
Well, that's President Trump, and of course he's been posting pretty much overnight on Truth Social. But you know what President Trump said there? Not surprising. He's been calling out India for high tariffs, calling India the tariff king and so on and so forth for months, even before he was elected. So that's not new. What's also not new is President Trump going after the BRICS nations, saying that the BRICS countries and the BRICS grouping is anti-America, they're anti the dollar. We've heard that several times in the past, so that's not new either. What is, however, a cause for concern is the manner in which President Trump was tweeting or posting on Truth Social, the language that was being used in those posts. But more importantly, this business of a penalty, the penalty imposition is the new factor. The fact that there would be tariffs coming in because we hadn't been able to work out a deal by the 1st of August, I think everyone had pretty much factored that in. This penalty amount, which, by the way, hasn't been specified as of yet, is the one that's taken people by surprise. Now, Parikshit, let me start by talking to you because you've, of course, been in touch with sources in the government here in India, but also with people in the White House. Let's first address what the White House is saying, because all we know at this point in time, what is official, maybe not certain, but what is certainly official at this point in time is that 25% tariff imposition from the 1st of August, which President Trump has said is going to happen. What we don't know is what this penalty amount is likely to be. What does the White House say?
Well, the White House is clearly saying that the 1st August deadline is clear. The tariffs will kick in from there. So 25% immediately across the board is what the Indian exporters have to be ready for. Number two, what are the exemptions? All the exemptions that are continuing right now, such as steel and tariffs, which have a steel and aluminum, which have a 50% tariff. You've got autos, which have a 25% tariff. Those exemptions continue. Also for certain metals, pharmaceuticals, semiconductors, electronic items, which the US
laptops, smartphones.
Exactly. So those exemptions were earlier. Those exemptions continue
till the 14th of August.
For now, till anything changes further.
I mean, the earlier deadline was the 14th of August. So that's where we currently find ourselves.
Where we currently stand. And finally, the penalty has not been decided as yet. Currently, you don't have a tariff schedule. You only have an across-the-board 25% tariff, which the US is saying. And that leads to uncertainty because, you know, Russia-Ukraine talks are happening. Trump has said if that deadline, if within that deadline the war is not resolved, there will be secondary sanctions.
Yeah.
So there could be more coming India's way.
Well, you know, we will have to wait to see. But as you pointed out, at this point in time, the White House itself is saying that, look, penalties, we don't know just yet what the amount is going to be. But let's now talk about the Indian government, Parikshit. We saw that statement coming in from the government yesterday that they're assessing the situation and so on and so forth. And whatever is done in the nation's interest. What are you hearing at this point in time? What is the approach likely to be? The 6th round of negotiations were expected to take place with the US team coming to India in the second half of August. Does that stand? Is there expected to be any retaliation at this point in time? What are you hearing?
Shireen, it's quite clear we're not close to a trade deal at all. What Donald Trump's anger shows on Truth Social is his frustration with India. He's wanting access on agriculture and dairy, and India has said that we can't even bring that into the negotiating room. And clearly, Donald Trump is very upset with that. He wants an across-the-board deal with India, unprecedented access, major investment commitments, which India is not giving at this stage. Is India going to retaliate? Highly unlikely. One, because there is going to be more action from Donald Trump in the next few weeks. As I spoke about Russia, Ukraine, he will impose tariffs on economies which buy oil and defense equipment from
he
Russia.
said that, yeah.
So there is going to be more coming. So even if we do some sort of placating right now, we will again be hit by some sort of penalty 10 days later. So India right now is going to wait and watch. We've been told by government sources today we'll have to weather the storm.
Yeah, in fact, the term being used is India will not jump the gun.
Not jump the gun. And lastly, we now have to realize that what Donald Trump has done today with imposing a 25% tariff, and if he imposes a penalty, it's going to have a long-term implication. The next US president who comes will not reduce this tariff. That will be the beginning of the negotiation with the next US administration. This is a worry in the government.
Well, you know, it is a worry in the government, but also as we've heard several commentators say that, look, what these tariffs do in a multilateral system, in a system that's governed by the WTO, etc. These are unilateral tariffs that are being imposed by the force of an executive order. You know, we had several commerce secretaries and WTO envoys, former WTO envoys, calling these acts illegal, calling this trade anarchy. But this is the Trump era, and this is an era that we are going to have to navigate. And, you know, to your
End of multilateral institutions.
Well, I don't know, end of multilateral institutions per se at this point in time, but certainly the rules of the game have been upended. But, you know, here's the interesting thing, Parikshit, and I'll come to Surabhi to really understand what the impact is likely to be if it is what President Trump claims tariffs to be. What's interesting is that India and the US were expected to be the first off the block in terms of signing an agreement.
We gave a lot of concessions.
And we gave a lot of concessions.
The Google tax was removed.
Google tax, the digital tax
Tariffs
was removed.
on EVs, cars
Tariff
was
on
reduced.
EVs was reduced. Bourbon, whiskey. All of that was done even ahead of the Prime Minister's visit to Washington, D.C. in February. So India had made its intent on wanting to get an agreement done with the Trump administration very, very clear. And we put a lot of eggs on that table in that basket already, even ahead of the Prime Minister's visit. And here we are, where he signed deals with a whole host of countries, including, by the way, with Pakistan. That's the development that's taken place overnight. I mean, Pakistan has got a deal with the US. But Surabhi, let's talk about the world as it is. And it may change with a tweet. We don't know. But what are brokerages telling you at this point in time about the impact on the economy if the 25% tariff stays and we don't know what the penalty is?
No, absolutely. Just on the penalty and on Parikshit's point, because I've been following every single tweet wherever he's spoken about Russia, Ukraine, and how he'll penalize Russia's trading partners very carefully all through the week. And in one of those statements, he said, I can impose tariffs of up to 100% in terms of penalties with all those who are doing business with Russia. So let's see what he eventually, hands out to us. Now, just talking about the numbers. So why is this important? There is no denying it. The US is India's largest trading partner, and it has been so for the last 4 years in a row, ahead of China, ahead of UAE, and ahead of a lot of other geographies. The value of bilateral trade as of FY25 has crossed $130 billion. India is earning almost $90 billion in exporting goods to the US. So these are large numbers. You cannot ignore them entirely. If I just talk about now the GDP impact. So the numbers by themselves, absolute numbers are large. But as a percentage of GDP, we're a domestic story, right? And that's where there's some comfort coming in. As a percentage of GDP, US exports amount to about 2.1 to 2.2% as of the latest numbers. So this whole deficit business, which he keeps talking about, the deficit with India, and yes, there has been a deficit, no denying that. So as of the latest numbers, FY25 numbers available, we've exported goods worth almost 87 billion to the US. We've imported worth about 45 billion. That leaves a trade deficit for the US, surplus for us, of about 41 billion. And that's his problem. He wants to wipe that off. But it seems it's not just about the deficit. Now it's about geopolitics, it's about Russia, it's about so many other things. Quickly coming to the estimates. So if things stand at 25% tariff, then what could the implications be for Indian GDP? SBI, some of these estimates came in April because we were at 26%. Some are as of this morning, very, very new numbers. So SBI is saying a 20-25% tariff impact could result in about 50 basis points loss to GDP. They're saying every 1% rise in tariff leads to about 0.5% decline in our exports. Morgan Stanley sees a downside risk ranging between 30 to 60 basis points. Citi is again talking about 0.3 to 0.4% impact. And Nomura is the latest note I read as I walked in. Their estimate is 0.2, 2 percentage points, basically 0.2% sort of an impact to their estimates of 6.2% growth this year. So there is going to be an impact on individual sectors. Of course, it will play out a lot more. I mean, gems and jewelry, whether we're looking at pharma, and pharma is the big sword that's still hanging open. We don't know because that's one of our largest, export contributions.
And that's the one I was
talking about. Absolutely. No, pharma, just a quick point on that. As Parikshit was saying, as of now, it is exempt. And it's not just a concern for India, it's a concern for the global industry and for other countries as well, because, President Trump has spoken about, very high tariffs on pharma, but then he also talks about the fact that he'll give 18 months and so on and so forth. The next day, they talk about the fact that it's coming soon. So we don't really know, but what we do know that as of now, pharmaceuticals are exempt under the current regime, which was also made clear in April, and that is the expectation that it's going to go forward. Now, you wanted to make a point.
So pharma, yes. I think you guys have covered it pretty much. It's a big, sword that's hanging on us.
His last comment this week again was bring pharmaceuticals back to America. So
but the question,
I think, interpret it as what that will mean in terms of duties.
Absolutely. But see, essentially the market reaction kind of tells us a story. Even if you are saying 0.6%. 60,
roughly half a percent.
Anywhere between 20 basis points.
Market reaction is because of my green shirt, Sriram.
Absolutely.
I don't know what my black shirt is in protest of.
No, sorry.
Pista green, I might add, Prashant.
By the way, the first time I'm wearing it. And
we cited that in the morning today, 8 o'clock, that the biggest support the Bulls will get is from Prashant's shirt, and it's playing out.
Absolutely. And, thank you, Prashant. But see, think about it. 20 to 60 basis points, what we're talking about. Max from 18 to 20 billion or $21 billion is the net impact, which at the R scale doesn't look like a lot. But having said that, we were talking about this just before the show. Nimesh has a different take on why the market is up. I think
so basically one should not read too much into just one day of pullback, because it's an F1 expiry day, and also the Nifty long short position is extremely short by the FIs. It's the highest short in the system in the last 4 to 6 months. So clearly
the FIs expect this kind of an explosion?
Something negative can come.
So I think that's a good point, right? Did the FIs expect that these, what happened yesterday may have happened?
Exactly. Yeah. So today's pullback is largely because of technical reasons. So I won't read too much into it. But clearly,
it's possible that tomorrow they might dump the stocks.
Well, whether they will dump or not,
I'll give you a stat. FPI selling, which had stabilized in the last couple of months. July, we are back to selling. January was selling of almost 90,000 crores in a month. February was again selling. We stabilized next couple of months. And July, we are back down to net sales in the market of about 18,000 crores.
50% we give to Prashant for his green shirt and 50% for the technical reasons.
to this point about the markets, and I think the markets will do what the markets do on the back of many factors, not just this. But I think the larger issue is that, look, what happens to the US-India strategic partnership?
Absolutely.
I think that is the larger question, because this has been a relationship, by the way, which has bipartisan support, whether it was a Democrat administration or a Republican administration. India was seen as a natural ally, as a natural partner, as a strategic partnership. So what happens now to this partnership? I think it has implications beyond just the tariffs and so on and so forth. It has implications that go far deeper, and I think that is something that we are going to have to understand and
trust
really
will take a
grapple with,
big
and I
hit.
don't think we have the answers yet.
Yeah, I think
it's been happening
if you
from,
want
right
to
from
do a
Operation
deal, let's say,
Sindoor onwards,
there are multiple conversations that are open right now, right? Whether it is trade, whether it is FTA, whether it is FDI. Trump also wants our companies to invest there, and all of those things will happen. For all of that to happen, the most fundamental requirement is trust, and I think that has been shaken with yesterday's move. Everybody was saying that, India and US, like you said, we were the first to get off the block in trade talks. The Prime Minister went in February. But he wanted 4 things broadly, right? It's come out in the points that you guys made. One is that we should reduce our oil purchases from Russia and weapon purchases from Russia, and buy both of those things from US, not from Russia, less from Russia. I think we have broadly conceded to it. We can't go from 100 to 0.
No, but
there is a document in the US Congress.
Sourcing from Russia is the highest at 34%.
Correct, but it used to be 59% and 60%. The point
has come down, but still.
We are bringing it down, right? So it used to be 60-70%. It's now down to 36 as of 2024 data. There's a US Congress document showing 36%.
But may I say something on that? When we started in April, this was about trade, tariff, trade deficits. Then we were all arguing whether the use of this formula is correct or not. But over the course of the last 3-4 months, it seems to be beyond trade. Look at what he did with Brazil. It's got a quasi-political tone to it, that I'm putting tariffs because, what you're doing to the
So there are 2 things. We have to look
Here
at
it's
the
about
rate.
geopolitics, because you're doing business with Russia or,
So these are 2. I don't think Trump's the tariff rate and the narrative are linked. It's only linked in his own head and in his tweets. It's because he can tomorrow, like in the same tweet, he can say we are good friends and still I will do this to you. Right? And similarly, today you have a problem with us buying oil from Russia. 2 months ago, you didn't have a problem talking to Russia. And our Hardeep Singh Puri is on record multiple times on multiple forums saying we had the blessings of US. US said buy oil from Russia at not beyond a certain price. So that on a diplomatic level, there was that assent.
Forget all of that. This was the Trump regime. Mr. Trump, when he took office, what was the overtures? The overtures were being made to Russia. President Putin was his friend. Zelensky was almost the enemy. So so things
what
have
has happened
dramatically.
For all that, but US now, according to latest estimates, is collecting about $350 billion in new tariff revenue every year. $350 billion.
And this is something, Prashant, without much impact on the inflation in the last 3-4 months. Zero.
Consumer economy
Exactly.
is solid.
I think that inflation data we have to wait for the next one.
next couple of months of inflation.
Just a couple of points. I think what Parikshit said towards the end of his comments, which is that once tariffs go up, it's very difficult to come down. It's like taxes. Taxes go up. They don't come down. Same thing. A tariff is a tax at the end of the day. That is one. The second point is what Shireen said, which is that when all of this started in March or April, India was supposed to be at the front of the line. So, those graphics will come up on your screen. And I think, and I started this morning with that, which is that this is the disappointment. It's not, because the reciprocal tariff was 26. He said 25. 0.5%, 0.4%, we can nitpick. And those numbers are well known in terms of hit to economy expressed as a percentage of GDP. But the point is that we were supposed to have an advantage over some of the other competing countries, exporters into the US. So we don't have an advantage. Actually, we've gone the other side, right? Look at the table on your screen, EU, Japan, everybody between 15 and 20%, and we are 25 plus something. That something is a question mark.
Undefined.
But I don't want to leave it there. It's very easy to say, look at that number and say, well, we are worse off, etc., etc. So what I also did is I looked at what was the starting tariff rate before Trump came to power. At the end of 2024, what is the tariff rate? And that actually reveals the story. All these other countries, EU, Japan, Indonesia, Philippines, Vietnam, etc., guess what the average tariff? It's 1%, 2%, 3.5%, 0.8%, 4%. So the point I'm making is for all these countries, even as we say that, well, all these countries have got deals, we've not got a deal yet. And we've got a threat of 25%. All the effective tariff rate that they charged US imports into their countries was extremely low. Our effective rate, as the end of the same comparable period, our effective rate, what we charged US imports into India, was about 11.6, 11.7%. So much higher. And so, you know, every sort of soundbite that you hear, he says, well, you know, India is the highest tariff country. I think he said it 100, President Trump has said it 100 times since he's taken over.
Nimesh, let's break it down into sectors. And I go back again, as is, where is. If things stay as is, which are the sectors that will feel the heat?
Well, you know, Shireen, before I talk about the individual sectors, overall on the markets, as I explained, today was a technical factor for the markets to pull back. But, you know, now with this tariffs plus something which we don't know, it's only going to add to the uncertainty. Also, the fact that India is relatively underperforming the last 1 month and we are still expensive. So from a market perspective, there will be a overhang now as far as the tariffs are concerned. Now, coming to the individual sectors, we spoke about textile. That's going to be the biggest hit sector for us. Nearly 28% of the exports are to the US, and that will see an impact. And we are seeing on individual stocks as well that the textile space has seen a bit of a reaction today in the market. So that's the first big sector to watch out for. EMS, while, you know, Parikshit mentioned that it's been out of the gambit at right now. But again, you know, that's the fastest growing sector for India. Last year, we saw $40 billion of exports. Now, I think even if, you know, this is out of the tariff right now, it'll have a cap on the growth rate, and that will have an impact on the companies as well. So again, that's one sector to watch out on the negative side. Ports and logistics is an obvious thing. You know, there's going to be an impact on the overall volumes in the next few months. So that will have an impact on those companies as well. And autos, you know, again, that's the big sector. We gave up some of the things to the US, but still, auto is going to be a big auto components is going to be another sector which will be massively hit because of this tariff. So these are the 4-5 sectors which gets negatively impacted because of tariffs.
Auto we gave up for nothing.
We've got nothing.
We gave up for nothing because Musk ended up fighting with Trump. Now Trump doesn't feel satisfied with Tesla's entry.
So those are the 4 sectors. Now a bit of a neutral to not very negative. I would say cap goods is one. Steel and aluminium, everybody's spoken about it. Oil and gas also is something which doesn't get much impacted. And pharma we spoke about. It's not having a big impact on the pharma as well, at least now because it's been excluded. And we have a bit of a pricing power in pharma. So pharma wouldn't be that big impacted because of the tariffs. We need to see as to ultimately what's the hit will be tariff plus something which will
the hit will be more on the branded players, not generics.
Not on the generics.
Can I just ask one? I had a question for Shireen and Parikshit. That's a excellent roundup of what happened, what can happen, and who gets hurt. You know, as Surabhi said, that the surplus that we have is $40 billion, right?
$40 billion.
Around $41 billion, $42 billion is our trade surplus with the US.
Yeah. So the question is this. This all started by saying that, you know, we're running large deficits with countries. So ours is $40 billion as of last year. You know, we spent about $130 billion buying oil from outside last year. So is it possible that we kind of buy $40 billion worth of oil from the US? We've got to buy it from somewhere, right? And will that solve the problem? And it's just a...
No, the transportation cost will be very prohibitive. That's the problem.
And I guess that's where
bringing the oil from there...
Just 1 second. I'll get Parikshit to come in on this. But, you know, as Sriram pointed out, we have increased significantly. Just in the last 6 months, we've increased significantly our imports of energy from the US. I've had several conversations with the oil minister, Hardeep Puri, and he has made it very clear that India is happy to buy more from the US. There's absolutely no problem
so Shireen, if
buy more from the US and in buying more from the US.
If we do 40 billion,
the goalposts keep changing.
If we do 50, you know, if we do, we got to spend this money anyway. You buy it from, and if that amount solves this problem, then why not? I don't know if it's practical. As Sriram says, maybe it's too expensive.
One is can we, you know, and what that means in terms of costs and so on and so forth. But 2, you know, as we pointed out, we gave the US a lot of the stuff that the US was asking for. You know, Harley Davidson, cut. Mangoes, done. What is it called? Bourbon, done. We've done a lot of what the US was. Google tax, done.
On that point,
will the goalpost shift again? Is the question.
Because I'm just saying we can.
I mean, add to what Shireen is saying, Prashant. When it comes to energy, for that matter, when Trump was meeting Prime Minister Modi at the White House, post that, the Foreign Secretary had said that we are going to purchase $25 billion worth of oil and gas from the US. That was a very big announcement. J.D. Vance, when he was here in India, in Jaipur, when he was speaking, he said we want to be the #1 energy supplier and defense supplier. So India does not have much to offer. We're a small trading market. We're not among their top 5 trading partners. What can we give to them is large oil purchases, large defense purchases.
So Parikshit,
looking at long-term supplies of F-35s.
Even on defense, forget the F-35s.
We don't even want that.
Forget the F-35s for a second. But on the defense front as well, there has been significant movement, Parikshit. And you were talking to the defense secretary just last week on our program, and he was giving us a roadmap of what could be possible.
So 50
looking for something like a fighter jet program, Shireen. What that will do, it will give the US industry a 15 to 20-year roadmap to continue supplying to India.
But we're doing that for Boeing. I mean, look at the commercial orders. Indigo and Airbus, Indigo and Air India are the largest procurers from Boeing. The largest orders being placed by commercial
Whether
airlines.
it is Boeing or
just got the Apache helicopters for the Indian Army.
Order diya, uska amal to supply karo pehle.
He wants to sell India those F-35s, and India has a historical reluctance with the F-35s because a similar aircraft or earlier generations of that have gone to Pakistan. He's been dropping hints that we'll make it easy, buy this aircraft, because that's the next big purchase that India has to make for its future, for the next 20 to 50 years.
What is at hand is the 1st of August with a 25% tariff kicking in. We still don't have details or any clarity on what that penalty will be. Will the penalty kick in from the 1st of August or not? We don't know, and that is the big question that we need an answer to. India's position is don't jump the gun. We will have to wait to see whether there is going to be any formal response in terms of measures taken, whether we move the WTO or so on and so forth. I mean, those are all issues that are up for discussion. I would imagine there's a lot of conversation at the back end on that. But what is a fact is that there is a 25% tariff. What is still not a certainty is whether that 25% tariff with penalty comes in on the 1st of August. But we will, of course, be tracking this story here on CNBC TV18. Thank you to all of our viewers who joined us on CNBC TV18 Access. Thank you to all of our viewers who join us on CNBC TV18's YouTube channel and those who tune in to us on television. We will continue to bring you all the latest developments. But from Sriram, Nimesh, Surabhi, Prashant, Parikshit and myself, thanks very much for watching the Editor's Playbook.
Hello and welcome to Startup Street. I'm Shruti Mishra and with me is Arundhati Ramanan. These are the top headlines from the startup space. Policy Bazaar's Yashish Dahiya ABB Health will disrupt the hospital incentive structure by incentivizing hospital stay, narrow hospital networks with lower costs, easier claim settlements will be the future, claims the Policy Bazaar founder.
Mitigata, a cyber resilience platform, has raised $5.9 million in a Series A funding round led by Nexus Venture Partners with backing from existing VCs Titan Capital and Wave Ventures. The funding will accelerate the development of Mitigata's AI-powered security and risk management platform, enhance its suite of cyber resilience services, and scale operations across major Indian cities and international markets.
Raifa AI, a conversational AI platform building human-like voice AI solutions for enterprises, has raised $1.1 million in funding led by Seaborn Capital. The company will use this capital infusion to scale its operations in North America while advancing its conversational AI platform for call centers.
Logistics firm Delivery reported 5.6% increase in consolidated revenue to 2,294 crore rupees in Q1 FY26. The company's net profit surged 67.5% to 91 crore rupees versus 54.4 crore rupees in the same quarter last year.
Tesla has granted CEO Elon Musk 96 million shares worth about $29 billion, a move aimed at keeping the billionaire entrepreneur at the helm as he fights a court ruling that voided his original pay deal for being unfair to shareholders. Musk must pay Tesla $23.34 per share of restricted stock that vests, which is equal to the exercise price per share of the 2018 CEO award. Well, those were the headlines we've been tracking for you this evening. On What's Brewing today, Palo Alto-based cyber risk management firm SAFE has raised $70 million in Series C funding. The round was led by Avatar Ventures with participation from Susquehanna Asia Venture Capital, Next Equity Partners, Prosperity 7 Ventures, and existing investors including 8 Roads, John Chambers, and Sorensen Capital, among others. From pioneering cyber risk quantification to delivering fully autonomous third-party risk management, SAFE is now pushing the boundaries further. It has unveiled a fully autonomous continuous threat exposure management solution that aims to fast-track SAFE's bold vision of cyber AGI, or cybersecurity superintelligence, and cement its dominance in the fast-evolving cyber risk landscape. To talk to us about what this means for SAFE and the cybersecurity ecosystem at large, joining me now is its co-founder and CEO, Saket Modi. Saket, welcome back to Startup Street. Now, you've always positioned SAFE as more than just another cybersecurity tool. You are building a strategic intelligence layer. Tell us what this fundraise means for SAFE and how it fuels your larger vision to build cyber AGI.
Certainly, Shruti, first of all, it's an honor to be here with you. I've been on this show so many times with you.
Yes.
Every major milestone we've celebrated together, and it's such an honor to be back. So thank you so much for having me. To answer your question very objectively, SAFE from day zero has always thought about the fundamental problem of cybersecurity, which is how do you go ahead and take risk-based decisions to go ahead and either reduce the likelihood or the impact of a particular cyber risk scenario or a hack, in other words. And that's something what we've been doing from the very, very beginning. We started from a market called cyber risk quantification. We crushed that market. We are the number one in the world. Forrester recently, almost a month back, came out with a wave of the top platforms on cyber risk quantification in the world. And we're on the extreme top right, not just on the top right, but the extreme top right, which means we're the number one on the planet. An adjacent platform to that we launched 2 years back, which is called third-party risk management. And we launched as the first ever vendor, which does 100% autonomous third-party risk management. And again, out there, we are fast becoming the absolute undisputed champion of that market. As an extension of that, we actually announced the third module in our same platform 2 days back, and that is called Continuous Threat Exposure Management, CTEM. And we use the same playbook that we had in CRQ, Cyber Risk Quantification, and Third-Party Risk Management. Then how do you go ahead and deliver things 100% autonomous, end-to-end via agentic AI? So we put all of that together. This is all progressing towards our mission to achieve something called Cyber AGI, which is ultra intelligence, super intelligence for cybersecurity.
Sure.
So that's what we are heading towards, and that's where majority of our funding will be used for.
Yes. Yes, we'll delve deeper into that, Saket, but let's now talk about your big product reveal. You claim it is the world's first fully autonomous continuous threat exposure management solution. So help us understand why this is a game changer for enterprise cybersecurity. You've called traditional, CTEM tools black box and lacking transparency. So tell us how SAFE's model different and more actionable for risk and security leaders.
Yeah, so because we are champions of, you remember the first market which I spoke to you about, cyber risk quantification. That only happened because we use open standards like the FAIR model, like the attack MITRE framework, which is there, which is, by the way, the FAIR model, for example, is used by over 50% of Fortune 500 companies, majority of the government organizations around the world. Anybody can use it because it's an open standard. It's done via the FAIR Institute. So we have the commercial license to that, and we actually were the first companies to found the FAIR Institute. I sit on the board of directors out there, and of course today it's a much bigger movement than just SAFE by itself. We are applying the same degree of transparency to the CTEM market, which is basically vulnerability management, that all of the prioritization will be driven by open box, open standards, which is community driven rather than a group of smart people coming together and saying how the prioritization of issues should happen in an organization.
Okay, so from CRQ to TPRM and now CTEM, you're clearly building a layered long-term playbook, Saket. How do these pieces come together to drive SAFE, closer to its vision of cyber AGI that you were mentioning?
So if you take a step back there, Shruti, I mean, if you think about OpenAI, Google, Meta, and the list is long, there are enough companies out there which are trying to build what they call as AGI, which is artificial general intelligence. And remember, they will build this based on generically available data on the internet, on social media, et cetera, et cetera. And I think a lot of that will happen in the near future. But when that happens on data which is mile wide but inch deep, there will be AGI, in our view, which will be very, very super specialty. There will be a healthcare AGI, in other words, a doctor which can see any and every report and actually give a better analysis than any actual doctor, which will come, and that'll be health AGI. Similarly, in cybersecurity, there will be cyber AGI, which will promise the ultimate thing that cybersecurity is always promised. How can you make a company unhackable? How can you predict a hack and then detect if there's something going wrong and block it before anything goes wrong? And that is what we define as cyber AGI. And we will build cyber AGI is the commitment that we have to ourselves, most importantly, and then to our customers and investors and partners in the broader community.
All right, so Saket, tell us what's next on the innovation roadmap. Should we expect SAFE to venture beyond CTEM, or is the focus now on scaling this layer? And given you've posted triple-digit growth 3 years in a row, what is the revenue outlook moving forward?
Yeah, actually, Shruti, we launched the platform on your show in 2020, and 5 years, the average growth in ARR has been 120% every year, year over year. So we plan to continue the triple-digit growth in the near future. We are easily one of the fastest growing cybersecurity companies in the world. And we do it in a sustained way. We don't do it with burning crazy amounts of money. Our magic number, which talks about the sales and market efficiency, is more than 0.7, which easily makes us best in class for a company growing on triple-digit and at the same time being very, very efficient of growth. And that's really the reason why a lot of people today call as the funding winter, which is going on. Despite that, we were able to pull off a $70 million fundraise in a matter of a couple of months. So that talks about the strong first principles that we are building this company with.
Okay, one final question, and in 30 seconds, if you could answer that. What will it take for SAFE to actually achieve cyber AGI, and how close are you today to making that leap?
CRQ, when we talk about TPRM, CTEM, and there'll be multiple such blocks that we'll have to add, Shruti. So are we very, very close to cyber AGI? The answer is no. I would give it anywhere between 5 to 7 years from where we are, more around the 2030 to 2035 range. But we think we're extremely well positioned to go ahead and achieve that better than almost any vendor out there in cybersecurity.
Well, on that note, it's time for me to wrap up our conversation. Saket, many thanks for your time and for joining us on Startup Street today, and wish you the very best. And we'll, of course, keep tracking your journey for the next 5 to 7 years till you hit that mark. Thank you so much.
Keep coming back. Thank you.
On the investor eye, W Health Ventures is doubling down on building India's next generation of healthcare companies from the ground up. The early-stage VC firm has announced a $70 million second fund focused entirely on company creation, a hands-on model where startups are incubated from scratch to solve some of healthcare's toughest challenges. With its first fund, W Health backed 12 companies, including Beto, Visa, Milo, and Nivan, that now serve over 25 million patients globally. Fund 2 will focus on 2 proven themes: AI-powered B2B health tech and single specialty care platforms that fill critical gaps in India's healthcare system. Now, the first bet, Everhope Oncology. Joining me now to discuss this further is Pankaj Jethani, the managing partner at W Health Ventures. Pankaj, thank you so much for taking time out and being here with us on Startup Street. You know, you've just announced a $70 million fund too. What sort of sets this fund apart in India's growing healthcare investment landscape? And what's the kind of interest you're seeing for startups in India in this space?
Absolutely. Arundhati, thanks for having me on the show. I think the opportunity for healthcare in India and the US-India corridor or global corridor from India is incredible. We are seeing the healthcare market now being about $370 billion or so. But there is still a lot to be done in the sector. For every $100 that an American individual or patient spends on healthcare every year, an Indian would spend $2. Now, that means that there's still a lot of cash-up growth that needs to be happened just because we're not spending enough on healthcare. So that is the thesis of the firm. We are building some of these generational companies from scratch that should exist, but today they don't. And with the with the advent of both AI as well as a bunch of new single specialty models, we are seeing a lot of opportunities open up both in India as well as overseas. So lots of opportunity. The sector continues to grow 10-12% year on year. For the sector as large as healthcare to grow that quickly signals that there is a lot of opportunity. With the opportunity
continue.
No, with the opportunity are also large white spaces. I believe that in India, we're probably at the cusp of innovation in a lot of sectors, including financial services and commerce, etc. But when you think about healthcare, we are probably 10 to 15 years behind. So if you want to know the future of healthcare in India, you have a time machine, right? Just catch a plane and go towards the US or China. A lot of future care models have become apparent. And some of the reason why this market is growing so much, but there still are large white spaces, because building in healthcare is hard. It's a regulated industry. It is fairly complex to navigate. There's a lot of information asymmetry.
Sure.
And founders find it challenging to build. Yeah, sorry.
So it's challenging, and you're saying that, you know, there's so much space here to grow and there's a lot that needs to be done as well. You know, W Health takes a company creation approach, right? So how does that differ from traditional VC models, and why is it especially effective in this sector?
So the investment actually begins 18 months before the company is born. So we spend 12 to 18 months validating the concepts, identifying the white space, validating the concepts through a very structured research process where we have literally thousands of conversations and data points with patients, physicians, buyers, etc. 93% of the ideas get killed in this process. And the companies we eventually end up building are probably in the 8th or 9th iteration. So a lot of the early product and market fit research happens internally. At that point, we capitalize the business. We partner with exceptional founders. We get them on board and take them through the journey of both 0 to 1, right, building the company from scratch, as well as from 1 to 10 to scaling this company to, let's say, about 100 crore or so in revenue. So it's a very differentiated approach. We can't do this 25 to 30 times in a fund. We build 2 companies a year, and that's the thesis going forward as well.
So you want to build 2 companies a year, and Everhope Oncology is your first fund to investment, right? How does it sort of reflect your vision for next-gen healthcare in India? And how many companies are you looking to do this year? Another one that you're going to bet on this year?
No, absolutely. Definitely another company currently operating in stealth that we will announce very quickly in the US-India corridor. And then a couple of companies every year after that. Everhope kind of symbolizes the thesis going forward. So many of us know friends, family who get diagnosed with cancer in their 30s, 40s, or later, but being diagnosed very, very late in their journey. The cancer experience is very, very challenging. Even though outcomes have improved slightly over the last few decades, we are decades behind when it comes to oncology. An average pediatric cancer case, for example, a child with pediatric cancer has a survival rate of 40 to 50% in India, 5-year survival rate. The same number with almost the same drugs is 90% in the US. So with Everhope, the mandate is how do we bring modern, sophisticated oncology care to patients very, very close to their homes, right? Cancer is seen as a scary disease, and that's what we're trying to change with Everhope. With more empathetic, high-quality care, we're bringing in the world's best innovation for patients in India.
Right. So empathetic, high-quality care is what you're aiming to do with that particular bet. But your portfolio from Fund 1 has already reached about 25 million patients, right? Can you share what you've learned from these bets that's shaping Fund 2? If you could take us through the kind of returns you're seeing from Fund 1?
So we have a lot of interest from LPs and investors thanks to this differentiated model. When we are building companies as co-founders, we do, unlike other traditional venture capital funds, we do have a higher ownership. Follow-on investors are investing in the company, A, because of the traction, B, because of the founders, C, because of our involvement. And I think the experience from Fund 1 has been phenomenal. I think what we have seen is what are the mistakes commonly made in healthcare. We've spoken with over 2,500 healthcare companies in that journey. Where are the places where companies typically get stuck? What helps with growth, sales, marketing, both in India as well as in the US-India corridor? And I think what triumphs is giving patients a 10x better clinical solution, treating them like, sorry for the use of the word, treating them like humans, and treating them like what you would want your family to be treated. And if you do this consistently over and over again, patients will come. So there's no rocket science here. It's just providing empathetic, high-quality care, providing 10x better care, 10x better experience, and patients will come.
So making, care over there, healthcare care more human-centric at this point and giving them better quality of care. All right, Pankaj, thank you so much for joining us here on Startup Street, and we wish you all the best with this fund going forward.
Thank you, really. Thanks for your time, and thanks for having me.
Well, on that note, it's time for us to head into a short break. But coming up on the other side, a conversation with Swami Siva Subramanian, Vice President of Agentic AI, AWS on artificial intelligence, and a new approach to develop software using generative AI. That and more on the other side.
Welcome back. You're still with us on Startup Street. At its recently held AWS DaveSphere 2025 event in Bengaluru, AWS unveiled a new approach to develop software using generative AI, the AI-driven development lifecycle methodology designed to place artificial intelligence at the heart of software development. It also announced its AI native builders community, a peer-to-peer network of technology leaders united to share breakthroughs, avoid pitfalls, and accelerate the journey to AI native transformation. My colleague Ritu Singh caught up with Swami Sivasubramanian, VP of Agentic AI, on the sidelines of the event to talk about these new launches and more. Take a look.
It is an exciting time to be in the AI industry with the dawn of AI agents. Agentic AI is arguably one of the biggest transformation in the software industry since the dawn of internet.
Well, you've called agentic AI the most transformative change that we've seen since the dawn of the internet. That's quite the statement you're making. But what real business problems is Gen AI solving today, and how do you really distinguish between what's hype and what's reality on ground?
So one of the amazing things, since I have been talking to many customers in the past couple of days, and I see not just these agentic AI systems only being done by startups which are exploring new ideas, but also mainstream enterprises. Let me start out with actually an example of like Apollo Tires.
Okay.
They actually put AI agents in to solve something for the manufacturing with something called manufacturing reasoner.
Okay.
So now what essentially AI agents are doing is it is actually doing things like root cause analysis in the operations, and it is improving this RCA by 88%. So what used to take like 7 hours is decreased to less than 10 minutes.
Well, India is often seen as this digital growth engine, but how ready are Indian businesses to adopt Gen AI at scale? And also, what sort of gaps do you see, whether that is in infrastructure, data infrastructure, cloud maturity, or even digital talent?
First, the general problem in agentic era is that AI agent space itself is like very nascent. I mean, when you think about it, generative AI itself is a term that has been around only for 2 years, even though it feels like forever. So there is inherently now, there is a skills gap that exists. And this is an area where we have invested a lot in being able to actually get AI engineers to be ready. And this is where we also announced a new program where we are going to be training actually engineers, especially not just students, but also early career professionals to be AI ready. And we have a goal to the first year to train more than 2.7 million folks in the year one.
Well, I can't help but ask you, we've seen recently one of the largest IT companies in India, TCS, cutting off 2% of the jobs, not directly linked to Gen AI, of course, but because of the skill mismatch, so to speak. I want to understand, as Gen AI starts to solve more and more complex business problems, what sort of implications will that have when it comes to one job, and on the other hand, the cost structure of companies as well?
So it is now in such a world, then there are going to be actually changes in terms of how we do our day-to-day tasks in the business world. It can be like how a software developer builds systems to how a product manager actually does things, or a financial risk analyst does like underwriting or whatnot. But now what you need in such a future world is actually for them to be AI ready, so that they know that in a world that they are actually going to be equipped to do things 10x faster, so that they can actually now be even more productive. That's why the programs like what I talked about on being able to be AI ready from the get-go, whether you're a student or whatnot, is super important. But it's not just about AI. In such a world, you also want everybody to be also cloud and AI ready. This is where even in 2017, we announced that we wanted to skill everyone in cloud computing by 29 to 29 million people by 2025. And this year, we actually were able to surpass our goal and got to 31 million. And so the way you're going to enable and equip all of us in the future world is to be able to also be ready for this new era where the tools that we are going to use is going to change. And one of the things I always say is, when you look into when an era of this kind of massive transformation happens, and how to look at what is going to happen in the future, you got to be inspired by what happened in the past on similar such transformation. When the world moved from like manual switching or telephone networks to automated, or like when internet happened. We as humans fundamentally are creative problem solvers. And we transformed in terms of what we did, so that now we started operating at the next layer to solve the next set of creative problems. And this is going to be the same thing as long as we invest in solving that.
Well, if I just zoom out to what's happening globally, you know, the fragmentation, the different regulatory policies and environments, the geopolitical conflicts, how is AWS navigating all of this, and how is it shaping your product pipeline?
I mean, the policy landscape is something we monitor closely, and this is something we look at what it means for our customers. But policy landscape always is something.
Or the
constant.
geopolitical landscape, the race for sovereign AI capabilities. I mean, for each nation to build that.
I mean, when it comes to sovereign AI, it is not just about policy issue alone, but when you think of actually, for instance, what in India, there are some leading large language model startups like Sarvam and others. What they are able to do is actually now customize some of these models to specific Indian languages and dialects, and being able to do. And this is where we as AWS are also now enabling them to equip them with the state-of-the-art technology. So, and this is something we are actually not just doing in India, but also around the world. And this is an important one that we as an industry are going to be doing this over and over.
Well, with that, it's a wrap from both Arundhati and me, Shruti, on this edition of Startup Street. More news and updates coming up on the other side.
Welcome to Indianomics. The June CPI number coming in at a 6.5-year low of 2.1% has led to a few things. One, most economists have revised down their average CPI forecast for FY26, this year that is, to 3.2 to 3.3% against Reserve Bank's forecast of 3.7%. Second, many are penciling in another rate cut. Third, most are not expecting it in August itself. And fourth, above all, bankers and bond dealers are watching Reserve Bank's liquidity policy. How much liquidity Reserve Bank will add or remove from the system and when will determine bond yields and the rate cut transmission. Now, equity investors in banks are still penciling in about 12% credit growth on hopes of a 10% nominal GDP. That may be up for threat. And they're also penciling in an end to the rate cycle. These are what equity investors are penciling in. So today on Indianomics, we have three experts to help us understand how growth, inflation and liquidity may pan out. I have with me Saugata Bhattacharya, Senior Fellow at the CPR, Center for Policy Research, more importantly, MPC member. Neeraj Gambhir, the Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank, and Samiran Chakrabarti, Chief Economist at Citi India. Gentlemen, good morning and thank you very much for joining me in what's a very crucial conversation. Saugata, first your thoughts on the CPI number. Deflation in food inflation and core as well pretty much under control?
So hi, Lata. Thank you very much for having me on your show. So a couple of observations. Yes, the CPI food overall headline and food inflation numbers came in a little lower than what markets had been expecting, but this has begun to emerge as a trend for the last 3 or 4 CPI prints. We have seen this happening. This, to my mind, is very much a one-off. One, as everybody now already knows, I mean, this is partially due to the base effect of a very high inflation print, 5.1% in June of last year. So the next 2 inflation prints are likely to be higher headline prints. Overall, we are in a very good place, very good position in terms of inflation. As you mentioned, I think inflation for the year is likely to be lower than the current RBI forecast. So that definitely gives us room, gives room for the RBI, the MPC to continue with the easing cycle. It's just that the pace is unclear. On core inflation, which is what is probably important from a policy making point of view. I think the 4.55% that we have seen in June is likely to peak out, given the fact that base rates, the base effect of core inflation, has been increasing. So I mean, I don't expect a dramatic increase in core inflation, given the fundamentals that are driving core metals prices, commodities prices, etc., seem also to be in a good position. They are very unlikely, particularly crude prices, are unlikely to increase. So I think from the inflationary point of view, I think monetary policy is in a good position. But again, I mean, there are multiple other things to consider.
Okay. Well, Samiran, you're the person in the among the people I spoke to with the lowest inflation expectation for July. Your number is 1.1. So tell us your trajectory. Does it get much below what Reserve Bank has forecast in June?
Thanks, Lata. So yes, we are looking at a 1.5 kind of CPI for August, but this will be which will come out in August for the month of July. But this will probably be the trough on the inflation trajectory. We are now looking at the July-September quarter to be averaging about 1.9%. But at the same time, we think that all the stimulus that is going into the economy, that with a little bit lag will start impacting demand also. So we have actually built in a slightly higher momentum in core inflation for the last quarter of the year. And that's why our last quarter average headline CPI is marginally ahead of the RBI's current forecast at around 4.7%. Altogether, the full year average is about 3.2%. The critical part, which always is very difficult to forecast, is the vegetable price trajectory. But other than vegetable prices, I think most of the non-veggie food prices are behaving very, very in a very, very benign way. So given how the monsoon has panned out, we think that trend is going to continue as well. So overall, it seems to be, at least in the near term, a very low inflation path that we are going to follow.
Okay. Well, Neeraj, what are the markets expecting from Reserve Bank? If the number, as Samiran is putting it, is going to be 1 point something, maybe even lower than 1.5, will they go ahead and cut despite the neutral stance?
So I think given the inflation outcome and given what Samiran has said, I think the markets are broadly in line with the fact that the next reading is going to be a low reading, but after that we'll see some recovery in inflation numbers, some pull up in inflation numbers. But given the expected outcome on inflation, despite that, I don't think the markets are expecting a rate cut in August, as you yourself mentioned in the initial part of this program. The key reason is twofold. First is that Reserve Bank has already front-loaded a lot of monetary policy action. I think given what they did in the last policy, it was much more than what the market had expected. And I think with that size of monetary policy impetus given, I would guess the Reserve Bank would like to wait a little bit longer before taking the next step. Second is that the action on the liquidity front is also a little bit unclear. There is ample liquidity in the system. There is approximately 3 lakh crore surplus in the system currently. If Reserve Bank does not conduct variable rate reverse repo auctions, then all this liquidity will sit in the SDF, which is where the rate is 5.25. But if Reserve Bank continues to do VRRs and keeps on, it will effectively pull the overnight rate up towards the repo rate. So currently the market is expecting Reserve Bank to continue with the VRRs and pull the overnight towards the repo rate, which basically means that, there is an implied 25 basis point hike in the overnight rates, right? So these are the two forces which are kind of playing out, which is why you're seeing bond market to be very, very stable at this point in time.
Okay. Yeah, I agree. Moving more towards 5.4, actually, the call rate from below 5.25 some time back. Saugata, I'm going to ask you two quick questions because you're not going to be with us after the break. Our discussion will continue. One is, how should central bankers think of inflation? Should they think of the fact that all through 2025, we are going to have 3% or below inflation, which means the real rate is more than 250 basis points? Or should they think of the 1 year forward, in which case 1 year ahead you may have a 4% plus? What should be the standard way of thinking?
So, I think this question has been settled in multiple papers, theoretical, academic discussions, and Samiran put it very, very clearly that it's not just the next couple of sprints, the next quarter. You have to look at it over the course of the year, probably across the cycle. Again, I still go by the RBI's forecast, but even there, it does seem to be on an upward trajectory after, say, from the third quarter onwards. So obviously, this is not. You hear the argument that it's best to cut the policy rate before start with another easing, make another easing move before inflation starts moving upwards. I don't think that's a correct argument because obviously the monetary policy easing cycle, as the name implies, is over the course of the cycle.
Okay.
So you have to consider that. On top of that, you have to look at various other measures which might impinge on core and headline inflation going forward. The inflation growth trade-off, global uncertainty, volatility, etc. So I think caution that I at least particularly keep talking about. I think that needs to be very much in place in looking at the path of monetary policy.
Okay. Let me pack two quick questions before you leave us. One, do you personally think that there is space? Because if you look at current inflation, there seems to be a lot of space. If you look at 1 year ahead, you can even argue there is no space. And the governor's statements can be interpreted either way in his interview to me. That one question. And the other one, would growth move the RBI more? And are you worried about growth? In the sense, the WPI number came in at deflation. It came in at minus 0.3. So, is there a growth scare as well?
So again, growth is definitely the impulses that you see, the data, the high frequency data that you see, definitely suggests that some ambiguity on growth. It's not very clear. I still go by the 6.5%, the forecast for FY26 growth. If we actually do grow at 6.5%, I think we are okay in this current market with the amount of elevated uncertainty that still remains. We have no idea where the overall tariff situation is going, where the trade situation is going. I think we are in a good position in terms of growth. Of course, we need to support growth given the space that the inflation trajectory even over the course of the year provides. But I think at this point in time, as Neeraj mentioned, I think the liquidity support that the RBI has provided, I think that's a far more critical thing in terms of looking at transmission, in terms of credit growth. In terms of credit growth, which is an important part of the monetary policy cycle target, the objective, I need to point out that it's not just bank credit. The overall flow of resources in the corporate sector, that's very, very, the amount of money that's been raised to the corporate bond market, I think is very, very, very high this time and is expected to remain high. Transmission has been faster in the corporate bond market. So, we need to look at the overall flow of credit, not just from the bank credit side.
Fair point. So you see space for a further fall in rates?
In short, yes. Yes, I see space, but that obviously depends on multiple factors going forward, particularly inflation.
Okay. Well, thanks a lot for that, Saugata. We'll take your leave. Neeraj, Samiran, please stay on. Quick break, and we are back with more questions. Welcome back to Internomics. This one has been triggered by the ultra low or unexpectedly low CPI number that we got for June of 2.1, with a large part of the economists community now expecting the full year inflation to be as low as 1990 levels, 3.2%. The resultant impact on what RBI might do in terms of liquidity and rates is what we are discussing. We had Saugata Bhattacharya, the MPC member, plus Neeraj Gambhir and Samiran Chakrabarti speaking to us. Neeraj and Samiran, thank you very much for staying on. Samiran, if you can analyze the impact on credit growth, do you think that the Reserve Bank needs to do more in terms of both liquidity and rates to push credit growth? There are a lot of people who are expecting only single digits. Can Reserve Bank make a difference with liquidity?
So it boils down to how you were looking at credit growth, whether you were looking at it from the demand side or you were looking at it from the supply side. Our sense is that the demand side is still weak on the credit growth front, and that's because of two broad reasons. One is that the interest sensitivity of segments of credit demand is often low. There are only a handful of them where the interest rate sensitivity shows up in a big way. And the second is, as Saugata was mentioning, the borrowers are looking at alternative sources of funding, including corporate bond, ECBs, et cetera, as well as a large chunk of equity funding, which is replacing probably debt funding. So I think the demand side would not be the trigger for credit growth to improve, but we should not be ignoring the supply side. There is substantial amount of liquidity that has been given to the banking system. At some point of time, the banks will try to offload this liquidity onto the system. This can happen through the NBFCs who have a larger feet on the street. So through the supply side, the first trigger for credit growth could come in. So I will not be surprised if the credit growth numbers inch up to 12-13% at the back end of the year when the full effect of this monetary transmission takes shape.
Okay. What's your sense, Neeraj? I mean, put on your banker's hat and think, what will a punishing amount of liquidity? Every day, bankers forced to give money to the Reserve Bank at 5/4 or even maybe if there is a rate cut at 5% to RBI. Would that be trigger enough to force bankers to lend? In the last cycle, of course, it was very long ago, in the 2000 to 2004 rate cutting cycle, you did not see credit offtake up until 2004. It took 4 years. And then, of course, credit growth jumped to 25%. But rates falling from some 10% to 6.5% did not increase credit growth. Bankers remained cautious or borrowers remained cautious. What's your sense now?
So my sense is that hoping that this dose of liquidity and the rate cuts that Reserve Bank has done, coupled with the fact that government is doing spending on the capital side, there is some front loading of subsidies. So there is a push towards increasing sort of demand, even though I agree with Samiran, the demand side is looking a bit weak. I think all of these factors will combine to give us a better outcome on credit in the second half of this year. Currently, the credit growth is at about 9 or 10%, somewhere in between. And we will slowly inch up towards 12%. I still don't see it going significantly beyond 12-13% for this year because the demand from large corporates, the demand from overall corporate sector still continues to be somewhat weak. Now, when will monetary policy deliver? I think it's an open question. There is no clear timeline. I've seen at least 4-5 cycles now. Each cycle is very different. And the drivers of credit growth in each cycle are also very different. I think if you remember between 2012 to 2014, the big driver was infra spending, right? So between 2017-18 to 2020, the driver was retail lending. So every time we've seen a slightly different driver of credit growth. We'll have to see this time around in the revival sort of leg of credit, which sort of segments play their bigger than usual part in terms of driving it back. But I think I would expect that as liquidity settles down in the system, as the rates settle down in the system, they have done to a large extent on the lending side, but also from banks' perspective, the cost of funds steadily comes down. There will be some impetus to bring the credit growth back towards 12-13% numbers by the end of this year.
Okay. A two-part question for you, Samir. And actually, I'll put it in two separate questions. One, this 12-13% number is coming into question more because now the nominal GDP is going to be very low. If we are going with a 3.2% CPI and a lower WPI, then the nominal GDP perhaps will not even touch 9. It could be even sub 9. And then the credit growth, if it is 1.1 times nominal GDP or something like that, we may not get beyond, maybe barely make it to double digit. Is that an argument?
So first, we are not talking of kind of average credit growth here. We are talking more about what the credit growth would be, exit credit growth type of thing. And that, to some extent, will benefit from a bit of base effect of last year when in the latter part of the year, the credit growth actually tapered off. So from there, the favorable base should help. And, there are times when the system is trying to push higher credit. It's not for the first time that we will be seeing that credit growth will be substantially higher than that mechanical rule of X times nominal GDP growth. It could possibly be the case, but my bigger worry actually is that to what extent the non-banking channels of credit and equity would drive the financing rather than the banking credit. As Neeraj said, that there could be different pockets of credit that could emerge, not the traditional ones.
No, fair point. NBFCs are more nimble. And since there's a banking system is actually negative year-on-year terms in terms of their loans to NBFCs, maybe that route will fire. But Samir, a more general question on growth. The Reserve Bank can be moved to cut if it genuinely perceives danger to growth. Is the 6.5 in danger? Is even 6.3 in danger in terms of growth rate?
Right now, for the April-June quarter high-frequency data, I think we are tracking somewhere around 6.5 only on GDP growth. We will get to see the corporate results now, which have a large bearing on the final GDP number. So we might have tweaked the number a little bit here and there to adjust for it. The open question is that when this tariff-related uncertainty settles down and whether the average tariffs settle down at 20% for US or at 25%, depending upon that, we might see the global headwinds. We have to consider that to what extent that creates a downward bias. But at the same time, I think the markets are generally underappreciating the size of the stimulus. There's a 30 basis point of GDP coming out of tax cut. Our estimate is 40 basis point of GDP is the immediate impact of the 100 basis point rate cut on household borrowing. And then there could be about 30 basis point more coming out of higher credit growth. So altogether, about 1% of GDP, monetary and fiscal stimulus is there in the system. So that should show up in numbers at the latter part of the year is what our call is. So not thinking that the growth outlook is necessarily very bearish.
Okay. There have been economists who are telling me that even in Q1, while latter part, even in Q1, if the normal GDP is C plus G plus I plus net exports, especially service exports have done well. Goods exports were flat even last year. So in terms of input into GDP, exports have not taken away anything, plus government spending much better than last year. So we could get a good growth number. And therefore, we are coming to Neeraj's forecast or the bond market's forecast. If the expectation is that growth is not under threat and the RBI argues in its own mind that when I go to the August policy, I will have a July CPI which will be 1.1 if you're right, Samiran. So there will be more pressure on me in August, so why should there'll be more pressure on me in October, so why give away the rate cut now? So be that as it may, Neeraj, if there is no rate cut in the August policy, but the governor sounds dovish, saying that, if inflation surprises on the downside, etc., how will the bond markets react? Because bond markets have been, completely ignoring any chances of rate cut or low inflation. They're still sitting at 6.3, a good 15 basis points higher than the low before the June policy. Do you see any fall in bond yields?
Okay, let me just answer this in terms of what the expectation of bond market from MPC is. I think the base case or the general expectation is for no rate cut in August. Obviously, the tonality of the MPC and the language around the forward-looking view on inflation, the forward-looking view on growth is what the market will be watching out for. And I think given what we've seen in terms of data and given the commentary that even Samiran talked about, I think there is a case that you could build a case for an October rate cut. But I think between August and October also we'll have some more data. So my guess is that the Reserve Bank would likely wait until October, see data between July, August and October and see how things are playing out, particularly on the growth fund, before taking a call on the October rate cut. As far as bond market is concerned, unless and until it gets a very clear signal from Reserve Bank that the next rate cut is going to happen, I don't expect a meaningful slide in bond yields. I think we will be in a very range-bound mode, around 6.25% to 6.3%. All the positives have been discounted. Good liquidity has been discounted. If anything, the overnight rates are now going to inch up towards 5.5 possibly. So I don't see a significant positive momentum, but at the same point in time, no reason for yields to actually go up from where we are right now.
Okay. Well, we'll have to leave it at that. I might just tell you that there's one more positive. One person told me before, when I was preparing for this interview, that the borrowing calendar for the next second half may have much fewer 30 to 50 year tenor because, you're getting such an attractive rate at the lower end. The government may rethink, or the RBI may advise it to bring it down. Then there is a bit of a rally, perhaps, at the steeper end of the curve. Let's wait and see. Many moving parts here. Samiran, Neeraj, thank you very much for continuing with this conversation and helping our understanding of what to expect from the Reserve Bank in terms of inflation and growth numbers, as well as how the bond market will behave. That's it on this edition of Indianomics. Thanks for watching.
Let's talk money.
Hello and welcome to this week's edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, it's been a news and noise-heavy first half of the calendar year. Markets have been volatile, yet resilient. They've been dealing with all the war and tariff developments that have been thrown around. But one thing that investors have perhaps rediscovered in 2025 is that making money is not a straight line process. So it's a good time to revisit some of the ground rules of portfolio planning and also talk about why a portfolio shouldn't be too skewed towards any one particular asset class, even if that asset class is equity. Today on the show, I have with me Alek Yadav of Sanctum Wealth, who will tell us the 5 mistakes to avoid in our portfolio. And of course, then he'll also shine a light on how hybrid funds perhaps can help us enhance overall returns just that little bit. Alek, great to have you back on the show. So thank you so much for being here.
Thank you so much. Thanks for having me again.
So I want to start with a dipstick mood check first.
Yeah.
Because this has been, like I said, it's been so noisy, right? All kinds of news.
Yeah.
And you don't know if tariff and Mr. Trump is telling you that the whole world has to be reset and geopolitics. What is the feedback you've received from clients? What are they saying? Are they still buying every dip?
Sure. Yeah. So I think there's a little bit of concern that is there amongst investors as well. So they're afraid from committing too much of capital at this point of time. However, what has happened is that the last quarter was such a one-way run, that they're also fearful of missing out on the rally. So I think most of them are staggering, and that's what we're suggesting clients, that instead of fully staying away from equity, stagger the money over a period of time so that you get participation, and if there is a correction in the market for whatever reason, then that could be an opportune time to add more to equities.
So there is fear of missing out, but there's also fear of participation. So it's like, twin fears working together.
Exactly.
But in generally, I mean, as a house call right now, when you talk about any broad portfolio advice, so I know it'll be different for different individuals, but generally, are you fully overweight on equity? Is it more equity skewed? Gold has done so well. So I think people are just asking themselves these questions: that where should I be? Where should my money be?
So we have been overweight gold for a while. For actually the last 2 years, actually went overweight when Ukraine and Russia crisis broke out in 2022, and we've been overweight in gold since then. Now I think we're starting to book a little bit of profit because it's been a stellar rally for gold. So we're booking a little bit of profit. We're adding a little bit to equities. If you look at Indian markets, things have only improved. The macro environment has become better. The government is starting to spend. RBI has cut rates by more than 1%, and is also supporting liquidity by doing open market operations. So the overall macroeconomic environment in India is improving. On the other hand, the earnings sort of bottomed out in the last quarter. I think the expectation is that they will keep improving quarter on quarter, and the second half of this financial year should be a better year. And that's why we're saying that slowly, gradually add to equities and don't miss out on the rally. If there is correction for whatever reason, it is likely to emanate from global market risk. Use that opportunity to add to equities.
So equity would be the one big asset class that you're advising that investors should they should be putting in their money. What else, just in terms of asset classes?
So that's one. Gold, we still have some allocation. We're not fully taking out.
How much?
Generally, our model portfolio allocation is about 10%. We were right now at closer to 12%, slightly overweight on gold.
The RBI's Monetary Policy Committee meeting from April 4th to 6th has suddenly become very important, especially after the tariff blow from the United States. As always, CNBC-TV18's Citizens Monetary Policy Committee is meeting to deliberate on the issues that the Reserve Bank's MPC will deliberate. I have with me the chairman of our committee, Dr. Pranab Sen, and members Soumyakanti Ghosh, Sajid Chinoy, Samiran Chakraborty, and Sonal Verma. Gentlemen and Sonal, thank you very much indeed for your time. As I said, it's the global situation that's most important. So, Sajid, let me start with you on that issue. We have this tariff blow and we have this very weak jobs data. We also have the most important player in the global scene literally changing the rules every night over with a tweet. So at such a situation, what should the MPC be prepared in terms of global impulses?
Thank you, Lata. I think it's important to recognize that the global economy is at a very critical inflection point. One can look at the first half of the year and get lulled into complacency because growth has been surprisingly strong in the first half of the year. Second quarter global growth is tracking 2.5%, which is above trend. But that strength is deceptive because it's being driven by transitory factors. One of the reasons that growth has been resilient the first 6 months is because there's been record volumes of front-loading exports to the US in anticipation of higher tariffs. We've seen lots of transshipment where Chinese exports to the US have actually gone through third countries in Asia with lower tariffs. We've seen China's policy stimulus being front-loaded this year. And most importantly, the actual realized tariff rate in the US in June has been less than 10% because it takes time for the final rate to go up. So we've seen an effective rate of only 10%, whereas given the slew of announcements made in the last 48 hours, the effective rate is going to settle somewhere closer to 18 or 20%. So expect to see over the next few months a meaningful increase in the effective rate that US consumers feel. Now, already we've begun to see that below this, strength on the surface, there are cracks emerging. You spoke about the jobs report. What was most important is the last 3 months now, US private hiring is only averaging 52,000 jobs per month. That's clearly sending you a signal that US businesses are already being impacted by the uncertainty that you alluded to, and hiring has reached a stall speed. When these tariff rates go up from 10 to 18, that's going to be a substantial purchasing power squeeze. So my message is, don't be fooled by the strength of the US, of the global economy in the first half and the US economy in the first half. The second half is going to be much weaker. I'll end by saying, however, this means that central bank easing will be brought forward. We now expect that the Fed will, most likely move in September itself. And remember, even though US inflation may go up, the rest of the world is going to be beset with more disinflation. Think of a dam where the US puts on a tariff wall. It's like a dam, and the water that used to go to the US and now is blocked is going to flood the rest of the world. So the Chinese excess capacity will go to other parts of the world, be disinflationary. And the fact that you have lower growth prospects, lower inflation, and a weaker dollar should pave the way for central banks around the world as well to begin easing in response to the growth shock that's coming.
Okay. Growth shock. Let me toss that to Soumya. Soumya, can you parse that for the Indian economy? At the moment, we have not seen very weak growth numbers when you look at some of the PMI numbers. But the tax data that came in last week, it came in a couple of days back, did not look too good. I think tax collections have been negative on personal income tax, understandably, even corporate income tax, very, very weak. So is there more growth weakness that we should prepare for?
Yeah, I think, Lata, just to take it a little bit forward with the Sajid's argument, yes, the growth has been weak, and continuing the same vein what Sajid said about the global growth. I think for Indian economy, if you look into the trends as of today, I think it will throw up two contrasting trends. While the first quarter GDP number, which is going to be announced towards the end of August, could actually surprisingly see a strong number. But that will be more of a statistical artifact, because what has happened is that in the last couple of months, there has been a significant deceleration in prices. So that could actually pull down the deflator, and you could see a peculiar situation where the nominal growth and the GDP growth and the real GDP growth could actually converge. But that, in essence, is not the story. We can actually get a very different set of numbers going forward if you look into the momentum, if you look into the momentum of the two-wheeler sales, if you look into the momentum of the electricity consumption, if you look into the momentum of the corporate results, if you look into the GST collections, all numbers are actually showing a significant deceleration trend. And the important point is that in tandem with the global growth numbers, which will look better in the first half, Indian growth numbers will also look better possibly in the first quarter, maybe a little more in the next 3 months. But the second half is actually going to be diametrically divergent. So in my sense, I think if we are looking into the data, we should be very clear that this will be a story of two halves. The first half could be strong, but because of reasons which could be statistical artifact or otherwise, and the second half could be relatively weak compared to the first half. So looking forward, I think there is going to be some impact on the growth given the way things have been unfolding.
Okay. So even if not inflation, growth could be a reason for the Reserve Bank to go soft. That's your point, right? Sonal, let me get the inflation numbers out. I did a poll, and now the new number seems to be even below 3% average for the year. So does that give the Reserve Bank, a clear elbow room to cut?
Yeah, Lata, I think the balance of risk, both to growth and inflation projections of the RBI are clearly to the downside. And on inflation specifically, our own projection is for a 2.8% for FY26. I think if we break up inflation into the food versus the core trajectory, the core underlying trends, so stripping out the impact of the commodities like gold, petrol, diesel, the underlying momentum has actually been around 3.5% for the last 24 months. This is the longest stretch of soft, subdued core we've seen for a while. And given the forward outlook on Chinese excess capacity or the domestic demand pressures, we do think this is going to stay benign. Now, on the inflation front as well, what we are basically seeing is both on vegetable prices, despite the sequential increase, and on pulses, the deflation actually continue going forward. So when we combine the overall prospects, we do think that the risk is that inflation will in fact undershoot the 2%, the lower bound for most part of this calendar year, and for the full financial year actually be less than 3%, as you said. The final point I do want to flag is, obviously, from a monetary policy perspective, is the forward trajectory on inflation that is important. And the 1 year forward inflation, at a number of, let's say 4.5% would suggest that we are close to target. But we need to keep in mind that part of the uptick in inflation 1 year forward is also because of adverse base effect. And the underlying momentum is actually very benign. And I would say the momentum is actually in the 3.5% to 4% range. So both the near-term undershoot and the 1 year forward actually do suggest that there is space and elbow room, as you said, to cut rates.
This is going to be the polemics of the Reserve Bank's internal discussion. When the governor spoke to our channel, spoke to me, he kept referring to the inflation outlook. Likewise, in a subsequent public discourse as well, he is worried about the inflation going forward. So, Samiran, that's question to you. It is very clear from our poll and from what all of you are saying, inflation is going to average below 3%. But should the RBI look at the current inflation or look at the year ahead inflation? As Sonal is pointing out, that has its own pitfalls. You tell us.
In a sense, the kind of summer decline in inflation has been much more than what was anticipated before. And the RBI's projection of 3.7% in the June policy needs to be lowered substantially, and we'll have to see how much RBI lowers it. But the debate really is not only about the timing of the decline in inflation today versus how the inflation is going to look 9-12 months ahead, but also about what is causing this inflation to fall. So at the moment, it appears that most of the inflation fall is coming from food prices, although it's quite broad-based across cereals, as well as the summer seasonal increase in vegetable prices has been much less. But it's always very unclear that how and when these shocks can come back. We have built in significant buffers in our food inflation projection for the rest of the year. And on the other hand, core inflation, which has been running extremely low for almost 2 years now, even if we assume some upside to that, will probably reach somewhere around 4.5% inflation for the Jan-March quarter. But we must also understand that the current inflation is benefiting from significant favorable base. Similarly, that Jan-March quarter inflation will suffer from unfavorable base. So you adjust for base, then actually inflation could be just about 4%. So the added twist in the whole issue is that we might have a new inflation series sometime early next year. So it's becoming extremely difficult to have a projection of 9 to 12 months ahead inflation in a very reasonable way. So I suspect in the current circumstances, tracking something like an average inflation is a better idea, and RBI will have to take a call where that average inflation is going to be and then try to calculate some sort of a real rate out of it.
Oh, you have a point. We quite forgot about the new series that will hit us. And so this 1 year forward, we'll have to take into account something which we don't even know, how it will pan out, because food weightage will go down in that series, at least by a few percentage points in terms of weight. Dr. Sen, the other big question is, if you are going to cut, is it better to cut in August or in October? Is it better to wait?
Well, this is the thing. The point that Sajid that made, which is you're seeing a huge amount of global uncertainty. Now, in a context of that kind, the question is, we don't have much ammunition left in our belts. So the question really is that do you take action now preemptively, or do you wait to see how things pan out in the relatively near future, next couple of months? Because Mr. Trump is going to be making calls on a daily basis, as he's been doing in the last few days. So things can change quite dramatically. And therefore, at the moment, we've just done a large rate cut in June. I think we should be a little cautious in terms of reacting at the moment, because there are too many uncertainties that's being caused by Mr. Trump's style of functioning. So I would say that it's probably better to hold off a little bit, because there's still time for the last rate cut to play itself out in the market.
Okay. Well, I'll want more opinions on that. Let me take a quick break. We are back with more questions, also questions on liquidity and where the Reserve Bank should keep the call rate. Back in a jiffy.